since the start of the year. Yesterday, Hershey CEO Michelle Buck said earnings growth will be flat this year because of the historically high cocoa prices.
Coming up, we are going to talk about who is paying that $7 million price tag for a 30-second Super Bowl spot this weekend, and who are the potential winners and losers of the ad game this Sunday. All that and more right after this. Welcome back to Squawk Box. The Super Bowl is not just a championship football game. It's also one of the biggest, if not the biggest day for advertising. Top brands paying about $7 million for a 30-second commercial that could be seen by more than 100 million viewers. From the ads pre-released, our next guest's favorites are Uber Eats, Booking.com, and Dove. Joining us right now is Marcus Collins, University of Michigan marketing professor for the culture author as well. Good morning to you. Let's talk about these ads, and let's talk about whether, in the end, it is worth it, Marcus.
Sure. Well, first of all, good morning. Thanks for having me. Of course, it's worth it, depending on how you define worth it. If you think of the Super Bowl as a moment that I'm going to present my ad and it's going to immediately turn into consumption, I think that those chances are quite unlikely. However, if you see the Super Bowl as a media moment where everyone's watching shoulder to shoulder, and I can create a catalyst that gets people talking, that gets my brand and its context in the cultural zeitgeist that govern how people behave, well, that's a win because we understand the value and the influence of culture and how those things drive consumption.
Talking about culture, and I want to talk about a couple of these ads, but one of the things that's fascinating this particular year is just the onslaught of celebrities that have been hired by these companies to market their wares. It seems like we've squeezed in, packed in more celebrities than ever before. And in truth, celebrities of a particular generation. What do you make of that?
Well, celebrities provide additional media, and they allow us to invest ourselves into a spot, into an ad, because we have some relationship with the celebrity. Not only that, but the celebrity provides context. So if I'm setting up a joke, if I'm setting up a premise, the celebrity puts that premise in a context where the audience can get involved very quickly. I think the idea of having celebrities that are from yesteryear, that are in some ways kind of nostalgic, allows for a bigger door to invite more people to be a part of it, to see themselves in it. I think when you use people who are much more recent, they help provide a sense of recency for people who are perhaps more used to understanding the celebrity of an influencer, to see their favorite influencer on screen goes, oh, you get it, you're one of us. And as a result, they feel more connected to the brand.
Okay, so Marcus, let's talk about one of the ads that we've been running while you've been speaking. I don't know if you've been able to see it, is the Uber Eats ad with Jennifer Aniston, David Schwimmer. You got Beckham in there, got a whole bunch of folks. You like that ad a lot. Why?
I thought it did a really good job of playing on this notion of forgetting, right? If you forget a thing, Uber Eats got you. And it provides context with something that's more recent, i.e., the meme of David Beckham and his wife, something that's a bit more nostalgic, like Friends, and something that is contextual to the game, like Usher. And then having people we don't know to just provide a round sense of what's this ad is trying to communicate and the value proposition that Uber Eats provides. It's funny, I think it's contextual, and I think it's quite relevant.
Okay, you like Dove. Why do you like Dove?
Because this is Dove doing what it's always done, preaching the gospel. Dove has been a brand that is inconspicuous, but very forthright and very consistent about how it sees the world. Dove believes in providing self-esteem and providing a sense of confidence, especially for women. And here's Dove using this big media moment contextually relative to the game, saying that girls need to feel more confidence so that they stay in sports. This is Dove being consistent in their brand, but also ensuring that their message is aligned with the contextual moment that we're observing, sports.
Marcus, is there any commercial that you haven't seen yet that we don't know about? Is there going to be a surprise ad that might show up this weekend?
Oh, yeah, definitely. I mean, there's a lot of brands who are keeping it close to the vest so that they have a bit of drama, a bit of theater when the big game shows up. Right. Some other brands we see now are using early stage presenting of their ads so they get more media wattage, i.e. we're talking about these brands today. But some brands want to wait until the massive moment that they can splash and get the more bang for their buck, at least with regards to getting our attention.
Marcus, is it going to be a little bit surreal seeing like Travis Kelce in 10 different ads and then they cut back to the game and then he's like catching a pass? I mean, that's never happened. And Patrick as well.
Yeah, I mean, it's going to be like the Tide ad. It's like the Super Bowl is a massive Tide ad. It's
They're
like
both. They're starring in the Super Bowl, the ads and the Super Bowl.
But there's no ad with Taylor in it, I don't think.
Is she going to make it, Marcus? Have you done the math? You'll get sued if you try and follow her playing. You can't do. I don't know if we can even talk about her being back. She's going to make it.
She's going to be there. Marcus, I want to thank you. By the way, talking about good looks, he's got a good, I don't know if you have good lighting or a good camera setup. What kind of rig you got going on over there? It's set up in a good way.
I want to make sure that I show up, man. This is a big deal. Being with you guys this morning. I want to bring my Sunday best.
Kind of looks like a studio.
So for those directors out there, what did you do? Is that on? That's not on a laptop, is it?
This is on my laptop. I'm using a DSLR camera. I'm in my office at the Ross School of Business, University of Michigan. This is just how I show up in the morning.
Okay, shout out. Nice to see you, sir. Enjoy the game. Thank you.
Thank you so much.
Coming up later in the show, we're going to talk Super Bowl betting with FanDuel CEO Amy Howell. That's coming up in the 8 o'clock hour. Squawk Box coming right back.
NBC.
Good morning. Futures in the green on this pre-Super Bowl Friday. And the S&P 500 crossing over the 5,000 point level for the first time ever. We're going to read the charts coming up with the one and only Katie Stockton straight ahead. Plus, investors traveling away from Expedia this morning. The stock tumbling after its earnings and guidance. Plus, its CEO is now stepping down. We're going to get an update on today's big move. And President Biden defending his mental fitness. What this could mean for the race for a second term. All of this as the second hour of Squawk Box begins right now.
Welcome back to Squawk Box here on CNBC Live from the NASDAQ market site in Times Square. I'm Joe Kernan along with Andrew Ross Sorkin and Melissa Lee. Becky obviously is off today. Here are the futures, and there are some notable things happening. You see at this point the S&P's called up about 9. I think it closed at 97, something like 49.97. So that'll put us, we did cross above 5,000 yesterday, but we will be there, looks like, unless something changes. Between now and the open. As I said, the S&P managed to do that yesterday, not for very long, the 5,000 milestone, briefly before the closing bell, but fell back slightly to close just a couple of points shy. Other things happening, maybe treasuries, we've seen a little backup in the 10-year yield, 4.16 this morning. We can check out oil, which no one can really explain why oil is still at $70 or wherever. $76. So it's in a trading range, I guess, but a lot of, I mean, in a very dangerous world, kind of interesting. We're just in, it's still down in the mid-70s. And then we wanted to mention Bitcoin, which was 43,000 a couple of days ago. Remember the ETF came out, it was about 49, traded as high as 49. The excitement, I don't know whether it waned, but it did go down below 43,000 for a little while. Today, it is up another $1,700. That's another almost 4% move. It was up yesterday, so back to the low 47,000s.
Check out shares of PepsiCo. The beverage and snack giant reporting results in just the last hour. Adjusted earnings of $1.78 a share, beating Wall Street estimates by 6 cents. Revenue, though, came in below the street's expectation. Frito-Lay North America was also a miss. The revenues there slipped 3%. Beverages also slipped. Quaker Oats was a huge decline versus what was expected, which was up 3%. So we're watching PepsiCo shares down by 1.6% in the pre-market session.
Yes. I don't know whether it's not a zero-sum game. It doesn't mean Coke's doing better, and they're different companies, really. But I do think Pepsi on the Super Bowl. I can't help it.
Because as you
Super Bowl
say,
weekend.
You like everything with toes.
Anything ending in
That's the only
toes.
company
Is there
that
anything
sells
with
things toes.
something ending in toes that you don't like,
Tostitos.
except smelly toes or something?
I'm a Tostitos guy. You know,
Tostitos, Doritos, Cheetos, Fritos. It goes on and
but
on and
Tostitos
on.
are at the top of the list.
They are. They're phenomenal.
Yes. Tostitos are the win for the win.
Just plain Tostitos.
Yes.
I don't know. That's
With some good salsa.
They've done
and
some.
guac.
You know, I know you like innovation in AI and all that stuff, but the
ones that are
innovation
little
in
cups.
innovation in Fritos has been pretty staggering for the last couple of years.
What, like barbecue?
Chili cheese,
chili cheese.
twisty, honey barbecue, some really good stuff. Good stuff. Good for you too. Take a look at.
I'm a classic kind of guy. I just like the.
You like the Tostitos? You put salsa on them, right?
I like.
From a jar, like from a...
Yeah, but
Hot-
I'm not. And
hot, mild,
but
or
talking
medium?
About hot, but talking about the innovation.
Restaurant
I
style?
never loved the chip that became like a cup.
scoop.
The scooper.
Why?
I don't
that
like
not
those
good?
either.
I don't know. I just like the regular chip.
I don't need
Again,
more.
classic.
You know, the scoops can avoid double dipping though, because you get enough on the first one.
Maybe scoops for a party setting, flat ones for personal use.
That's a good. We'd solve a lot of problems here.
Right here.
Let's take a look at the technicals. Join us now, Katie Stockton, Fairlead Strategies founder, managing partner, and a CNBC contributor, and she actually admits that she contributes here. 5,000. Is that a resistance level now?
No.
What's the resistance level in
Well,
S&P?
I looked back at past sort of round numbers like this in a very non-scientific study and found that it did not act as resistance in the past. So 4,000 kind of blew right through that. 3,000 did the same. So I don't think it's a really big threshold except psychologically. Although I have to say, remember when Treasury yields inched up around 5%? That did become a resistance level, of course, for yield. So there are times at which those round numbers matter a whole lot, but in this case, I don't think so. we still have such strong momentum behind the market across time frames, and I think that's what we want to respect.
It's been confounding a little bit. I wonder about sentiment. Is it positive now? Because all last year it was negative, and we love walls of worry and things like that. Sentiment gets too positive, you have to worry. But lately there's been, I will say, like negative news in the market just seems to melt up by the end of the session. Like 150 points on the Dow is just like, the Dow seems to be good for that almost every day for the last 6 weeks.
You know, I think you can see that the sentiment isn't overwhelmingly bullish in the small caps, right? Or surrounding the small caps. That you all have been showing a lot of guests that talk about breadth being so negative. Quite frankly, it's really not that bad. We've seen digestion in those breadth metrics, which is very natural after a very, very strong breadth surge in Q4. So that bearishness, that bearish camp is sort of gravitating towards the area of the market that's not working, which has been small caps, but really only for a few weeks. And I think that within the next week or so, we will see Treasury yields probably top out in this oversold sort of relief rally that they've had, and that could occur to the benefit of the small caps. And all of a sudden, we'll look back and say, well, that's a pretty good entry.
The Magnificent Seven went to the Sexy Six, to the Fantastic Five, or was it Fantastic? What's the superhero?
I have no idea what you're talking about. I think
the Magnificent.
Biggest market cap companies in the market. Just
some of them have fought. We had you weren't here. We had the discussion earlier this week that it's no longer 7 stocks. What do we decide on? There's 4 or 5 now, Andrew, in the Magnificent Seven.
The Fancy Four.
Fancy four.
Fancy Four.
Does that matter? We've dropped out. The leadership is narrowed, hasn't it?
We still have very good leadership, but what we've seen is expansion in leadership on the sector front, especially. If you look at the top sectors year to date, it includes healthcare. And that's sort of a new sort of arrival on that front. So as long as we have that breadth expansion on the sector front, I think it's an uptrend that can sustain itself. Financials have really kicked in. Again, the bearish camp is gravitating towards the regional banks and the pullback there. But if you look at the broader financial benchmarks, they're still very, very strong.
I mean, the market has continued to trade higher as that really dovish scenario that 6 weeks ago people were talking, 7 cuts starting in March. That's off the table. And you saw Jay Powell on 60 Minutes. The market's continued to trade higher. What does it say about the 10-year? What's the... Is 4.5 in the cards or 3.5?
I would say low 3s is very doable from a technical perspective. I don't know why, and that's the hard part.
It's just that the jobs market is so strong and the GDP numbers are so strong. I don't know why yields would go down.
So for me, from my perspective, there's a very meaningful loss of upside momentum that we've seen there. I don't think this is a secular downshift. I think we've seen a secular upshift.
In yields.
In yields, right? I think this is something that could be impactful this year, maybe some, into next year to some degree, based on our indicators. That loss of long-term upside momentum is such that it could be maybe 9, 12 months before we get sort of a low in yield. So we're seeing this as corrective, but something that should persist. And if support, which is roughly about 3.8 to 3.9 right now, is broken, then the low 3s would be.
Well, unless we get a really more inverted yield curve, then the short end is going to have to come down, and we're going to have the cuts that are now off the table. So they could be back on the table, in your view?
Well, I don't know again, but
It's good to be a technician.
I know
things are terrible.
That's what I mean.
Right,
So the recession's off the table now, unless now one can happen since no one's expecting it.
I just look at it from a technical perspective, from a trend following perspective, and it's been really helpful over time to judge these momentum shifts, and it's a pretty meaningful one at that. 5% psychologically significant, that makes sense as well. So we want to, sort of view this relief rally that we have seen in yields as something that will be temporary, somewhat fleeting. The resistance for the 10-year is roughly 435 to 440. So below that level, we're looking for them to roll.
So at 25,000 on Bitcoin, you said, well, it looks like we do 30, and then if we get through 30, 36 is next, and we get through 36, and it all happened leading up to the ETF, which happened at about 47,000. What was that for the last month after the ETFs? Is some selling on the news, consolidation?
There was definitely a sell the news event there, and we got a proper pullback out of the cryptocurrencies more broadly. And actually, we saw that shift, remember, into Ether in relative terms. I thought that was interesting. both Ether and Bitcoin have avoided what could have been reversals of their intermediate term uptrends, not the long-term improvement that's preserved, but they were testing some support just really over the past few days. So this rebound that we've seen preserves that support and tells us that risk-on sentiment is still very alive and well in that space.
Is copper interesting now? What's happening?
I want it to be interesting, and I'm watching a long-term triangle formation that looks like it's trying to resolve to the upside. The long-term metrics have improved to some degree, but it's really not a confirmed breakout or anything decisive yet that we've seen. So we're watching and waiting to see how that triangle resolves.
Katie, I'm curious, we've been through much of earnings season, and it is not uncommon nowadays to see huge spikes on the back of news. And I'm wondering what your take is on this, and if there's any sort of significance. It seems to happen across, you had Meta, you had GM, you had Expedia last night. It seems like every single night there's these ARM, of course, massive moves.
And Cloudflare, I think, today.
Right.
It is wild. So the uptrends have given way to gaps up. And usually when you see a gap up in a strong uptrend, it can be exhaustive. But what we've seen from this market is that the gaps are being preserved. So Meta is a great example of that. It hasn't fallen back into the earnings-driven gap up. And that suggests that momentum's strong and that prices can go higher. So we like to look at that gap after an earnings report or something
What
of
about
that
Tesla
nature
or Apple?
as support.
Tesla or Apple? That's why I was asking.
Tesla's a
that.
breakdown. So
Breakdown.
so if any would get knocked out of that
That's what I mean, yeah.
magnificent 7, right?
Sexy 6? Or
There you
can you get, is it 5? Are there 2 that are out? How's
no.
Apple?
Fancy 4, fancy 5.
I think we're at 6 still. I like sexy 6. Just
Sexy
be able to
6.
use the word sex. What about Apple? Apple going to lead us higher?
So Apple is, of all of them, sort of disadvantaged from an intermediate term momentum perspective. We're bullish short-term Apple. There's an oversold upturn that we want to take advantage of. If it can get through the final resistance, which is about 198 on the chart, that would be a major breakout. But if we can take a moment and look outside of the U.S., look at Japan right now. Look at Europe on the verge of new all-time highs. So the breadth has been such that not only has it expanded from those mega caps to other sectors and stocks of the market, but also overseas, which I think is a good thing.
It's kind of nice to be able to just talk technicals. I thought you were going to say something about like the economies of Europe and Japan, but you didn't. You're just talking about just going to be, and that's safer. You don't really have to. Fundamentals are
non-controversial.
I was thinking Sexy 6 may not be family friendly, so I consulted my friends at ChatGPT, which I like to do.
Yeah.
They like the Sassy 6.
Sassy 6 is good.
The Swanky 6.
Swanky 6.
The Sensational 6.
Do you really think sexy is
Stellar 6.
Does sexy have a bad connotation?
Sizzling 6.
If you keep
I like
rebalancing this,
sensational.
if they all break down at some point, what do you call them?
I
They're
haven't
just stocks. They're
They
not
are.
magnificent. They're not sexy. They're not sassy. They are stocks, and they perform as they do. And when they stop performing, then what do you do?
Not fun.
What a party pooper.
Sorry.
On a Friday.
On a Friday,
on
on
a
the
Super
Super
Bowl
Bowl.
Friday.
Come on.
I think, she's NFL, no fun league. I think sexy's okay in that
I think
connotation.
sensational is the word.
Sensational?
Yeah,
Sensational.
I like
Sensational
that.
6.
definitely
Sensational, but if you
qualifies as
sensationalize
sensational.
something, you go, well, Melissa just said it.
How about the
Casting
Sassy
judgment
6?
on
The
a group of
Sassy
stocks.
6. The Sassy 6, they got a little sass.
Never heard a laugh from you like that ever in the history of Squawk Box.
little sass.
God,
Friday
I hope
morning.
that's on tape. That's going to be your highlight
We
reel.
got a little bit of sass on a Friday morning, people.
12 years. I like to take some credit for this.
You've been waiting
I'd like
for me
to
to laugh on
12
the show.
years out of the shell after 12 years. Maybe it's you. I don't know.
There it is.
That was good.
I'm thrilled.
Can you handle the tease?
I don't know if I can.
The terrific tease?
Coming up thank you. When we come back, the White House putting more money to work for the CHIPS Act. We're going to talk to the former White House CHIPS coordinator about the latest investment and what it means for future production on U.S. soil. That and so much more. Beautiful shot of the White House live this morning. A lot going on in that building this morning and last night. We'll talk about it when we come back.
download the app.
Welcome back to Squawk Box. The White House announcing this morning its plan to invest $5 billion to get the National Semiconductor Technology Center off the ground. The intent to bolster U.S. national security and secure semiconductor jobs. Joins us right now former White House CHIPS coordinator Ronnie Chatterjee. He's a professor at Duke University. Good morning to you. Ronnie, it's funny because I don't know if another headline has effectively overtaken this one. We're talking about $5 billion. And of course, the Wall Street Journal this morning reporting that Sam Altman is looking for $5 to $7 trillion. And it all sort of, on a relative basis, you say to yourself, well, what's really happening here? How important is what's happening this morning from the White House?
Both fives are important, the $5 billion and the $5 trillion. Let's start with the $5 billion. The National Semiconductor Technology Center is going to be a big effort around research and development by the U.S. government, private sector, other public sector organizations like national labs to get together and make sure that we're not just leading in the current generation of chips, but we're leading in the next generation as well. So what you're seeing today is the construction of a public-private partnership. You got the Department of Energy, the Department of Commerce, the Department of Defense, all at the table with private industry to make sure that we're leading in the next generation of chips. We have to design new chips, we have to prototype them, we have to pilot them to make sure we're not just leading with the fabs that are being built today, but we're leading tomorrow in this.
How much money of the $5 billion, do we understand really how it's being spent? I think there are a lot of people who say $5 billion, a lot of money. And, the private sector, I don't know if you think they're doing a good or a bad job, but this is clearly going to be something separate from that.
So you're right. The private sector, since the CHIPS Act was announced, has invested about $200 billion in private investment in building fabs and R&D all around the United States. So we're seeing that. Private capital is going to drive the success of the CHIPS Act. And I think in the first year, you've seen evidence of that. But you also need a government commitment to get all the stakeholders together to figure out what is the path for research and development? What are the new chips we're going to develop? How are we going to package them? What kinds of products are they going to go into? And getting us on the same page with a center like this is really important, even though the actual dollar amount is much less than the private sector investment would be, or with the OpenAI initiative that you mentioned earlier.
The news that Sam Altman, though, is pursuing this much money shows, Ronnie, that money is flowing to where there is innovation, right? The fact that he can have and try and raise that order of magnitude to build fabs that will make AI chips shows that there is that demand. And on the other side, you had Intel delaying the completion of its $20 billion Ohio plant because of the downturn in the industry. So is there a danger here that we're subsidizing the wrong things instead of paying attention to what market forces are telling us?
Well, what I see is the market telling us that there's a massive opportunity in the United States. That's where you've seen $200 billion of investment in the U.S. When it comes to AI chips, we're going to need new fabs and we're going to need designs. And I think Altman's announcement today reflects that. But I think a lot of that is going to be designed and manufactured in the United States. Of course, other countries around the world are going to play a role, and you're going to see these new chip ventures. To me, it shows there's a promising bet on the industry here in the United States in what has always been a global industry and will continue to be a global industry.
Ronnie, I got a question for you. If Sam Altman is successful in raising, I don't know if he's going to raise $5-7 trillion on moment one, but let's say he actually raises even $500 billion, which would be a remarkable amount of money, or more. Is that something that would concern you? I mean, as a policymaker, given you talk about concentration, I know there's lots of folks who are trying to compete in this space, but if scale is becoming about capital even more than anything else, what does that mean to the larger sort of state of play here?
So artificial intelligence at a high level is based on three things. You need the people, you need the data, and you need the chips. And so I see Altman's announcement today to be firmly about the chips piece of it. And I think this is why I'm glad we passed the CHIPS Act in August of 2022 to put America on solid footing. We have to see where the money's going to come from, where the fabs are going to be built, also where the chips are going to be designed. But I think more competition in the industry at the end of the day and more production of these kinds of chips is going to benefit consumers and benefit people across all industries. So I'm watching to see, like everyone else, but from a policymaker's perspective, this is exactly what the CHIPS Act is all about. We're trying to make sure the United States has a stronghold in the industries of the future to make sure that innovation and jobs are here.
What I'm asking is, in a day and age where the Department of Justice and Lena Khan are worried about concentration and power, if you look at Sam Altman in success, somebody who would control compute power of this magnitude that we're talking about, plus control one of the most powerful large language models and probably be able to generate an even larger and more successful large language model on top of those chips, both of those things together, does that change anybody's equation about how they're thinking about these things? Right now, the chip guys have been over here, the software AI guys have been separated. There hasn't been enough chips to begin with. If someone corners the market on the chips and has the model, what does that mean?
Well, I think you will have to look at the details of how this venture comes out. But I think already, even in AI, you're seeing a distribution of a lot of different companies. NVIDIA is obviously leading the world designing chips, but those chips are made by TSMC, which is investing in the United States and Arizona. So I think it'll be interesting to see how the configuration comes together. But even if OpenAI is successful in this raise or they create a new chip venture, I imagine a lot of firms are going to be involved in that ecosystem, including a lot of firms investing and based in the United States of America.
Okay. Ronnie, it's great to see you this morning. Thanks for your perspective and insight on all of it. Appreciate it.
Thanks for having me.
Coming up, Expedia, Take-Two, and Pinterest all on the move this morning. We'll get a rundown on those names next. And later, FanDuel CEO Amy Rowe joins us from Sin City with a rundown, the sports gambling fever that is gripping the nation. Swapbox is coming right back.
Time now for today's Aflac trivia question. Like father, like son, Christian McCaffrey and Ed McCaffrey can make Super Bowl history as the second duo to hoist the Lombardi Trophy for the same team. Who was the first father-son duo to achieve this goal? The answer when Squawk Box returns. NBC. And now, the answer to today's Aflac trivia question. Like father, like son, Christian McCaffrey and Ed McCaffrey can make Super Bowl history as the second duo to hoist the Lombardi Trophy for the same team. Who was the first father-son duo to achieve this goal? The answer? Steve and Zach DiBiase. Both won the Super Bowl as members of the New York Giants.
And welcome back to Squawk Box. I'm Dominic Chu. Here are today's morning movers for this Friday. Let's get you caught up on some of the earnings pre-market action. We'll start off with shares of Expedia. They're down roughly 15%, just around 60,000 shares of extended hours volume. after the online travel booking company behind its namesake platform, also other brands like Hotels.com, Vrbo, and Orbitz, actually reported better than expected profits and revenues, but gross bookings and growth in room nights came in below forecast last quarter. Expedia also said that CEO Peter Kern, who's been at the helm since 2020, will step down and be replaced by its current head of enterprise, Ariane Gorin, effective on May 13th, so on balance down 15%. Next up, you've got shares of Take-Two Interactive, which are down 8%, just around 7,000 or so shares of volume. This is the video game publisher behind blockbuster titles like Grand Theft Auto, also Red Dead Redemption. It reported earnings that were just shy of estimates, with some debate about comparability, but revenues as measured by bookings were in line with estimates. Its current quarter bookings forecast fell shy of expectations. Now, we will get more on that story when CEO Strauss Zelnick joins Money Movers later on this morning in the 11 a.m. Eastern Time hour to talk about those results. And we'll end on shares of Pinterest, which are down 9% on over 250,000 shares of volume. This is the image-driven social media company reporting better than expected profits on less than expected revenues. Growth in monthly active users actually better than forecast, but its current quarter revenue forecast was viewed as disappointing. Shares, by the way, were down nearly 30% at one point late yesterday, but paired those losses after Pinterest announced a partnership agreement with Google related to third-party ads. So those shares now down 9%, pairing a lot of losses, Joe. I'll send things back over to you.
Yeah, Dom, are you comfortable? Are you comfortable being
No.
the favorite? And it's weird because you're a 2-point favorite, but 71% of those bets are on Kansas City. 65% of the money line bets are on Kansas City, and then sort of evenly split on the over and the under. I would think it'd be high scoring. Maybe it won't be high scoring.
So the interesting part is the line hasn't really moved that much between the 2.5 to maybe 1 to 1.5 during the course of the last couple of weeks. I just have bad memories because the last time that we were favored against a staunch AFC opponent was on Christmas weekend, right, when we played against the Ravens, and we kind of know what happened there. But I think that there's going to be some symmetry, I'm hoping, because if the script writers do it right, they would make Lamar Jackson the NFL MVP, which he got last night, and somehow Brock Purdy would become the Super Bowl MVP after the Niners beat the Chiefs. So I'm thinking if the script writers have it their way, I'm hoping that's the outcome.
Kelsey is such an out in Mahomes, so outsized in terms of their possible influence. I think he really has promised her that he's going to win, and I would not discount. You
want to say her name? I'll say her name.
Taylor Swift. I would not discount how much he's going to want to win so that he doesn't disappoint, and he definitely doesn't want her to be branded as be blamed if Kansas City doesn't win. So I don't know. I don't know. I'm not going to tell you who I'm picking, Dom. I wanted to pick the 49ers, but I don't know. I can get better odds on the Chiefs.
I'll tell you what, at 2 points, it's almost like a pick'em game. I'm going to make a prediction as much as these things can go. I will say 27-24 Niners. That's my prediction.
I mean, McCaffrey is so amazing, and Debo and Purdy, when push comes to shove,
2 comeback wins in the playoffs. I think it's good.
But the defense, did you watch? The Detroit Lions look like the greatest offensive team in the world running in that first half. How crappy is your defense?
You know what? They tightened up when they should have in the second half, and I'm hoping that it doesn't go that way this time around, but, they'll rise to the challenge no matter what. Jed York has built a good team out there with Kyle Shanahan and John Lynch, so I'm confident. How about that?
Are you?
A little bit. I'm cautiously optimistic, to use a CNBC term.
Optimistically cautious. Cautiously. All right. Thank you, Dom. Be fun to watch. Coming up, China facing some economic challenges, and its relationship with the U.S. has been strained. Are the world's 2 largest economies headed for a decoupling? The Wall Street Journal's Greg Yip is going to dig into that next. And President Biden defending his memory after the special counsel's latest report. We're going to talk to pollsters from both sides of the aisle about what this could mean for his pursuit for a second term. Is Frank Luntz on one side of the aisle or other flirting? Frank Luntz on one side. Squawk Box will be right.
Mexico has outpaced China for the first time in 20 years to become the top source of imports for the U.S., according to the Commerce Department. Our next guest's new piece is focused on the U.S.-China trade relationship and whether steeper tariff hikes would officially decouple the world's two largest economies. Let's bring in Greg If, the Wall Street Journal's deputy economics editor and chief economics commentator. Greg, great to see you.
Thanks for having me.
The U.S. deficit, the trade deficit with China, fell to its lowest in a decade or so. So haven't we decoupled to a great degree, or you're saying not so much? The numbers don't really tell the story.
No, they really don't, because a couple of things happened. So that once Trump put on the tariffs and Biden kept the tariffs, there was a lot of pressure on manufacturers, both Chinese and Western manufacturers, to move their supply chains to avoid those tariffs. And so what you saw was a lot of assembly moving to places like Vietnam and Mexico. And so what you saw as the deficit with China decreased, the deficit with Vietnam and Mexico went up. And so a lot of the value that's coming in, we classify those as imports from Vietnam and Mexico. A lot of that value is actually added in China. I mean, if you look at, for example, solar panels that we might be getting from another country, a lot of the solar cells are made in China. If you look at laptop imports from Vietnam, McKinsey has a report that shows for every dollar increase that we in imports of U.S. imports of laptops from Vietnam, there was a $1 increase in Vietnamese imports of laptop parts from China. So in some sense, there's a little bit of kind of like this, a shell game going on here. The other thing that's going on, as you guys have talked about in the past, is that there's this de minimis loophole in U.S. trade law. A package worth less than $800 can come into the U.S. duty-free. And the number of such packages from China has just exploded since the tariffs came in.
Yeah, I mean, I'm sure everybody knows about Temu and Shein. Those are just two examples of those companies using the exception. In your piece, though, you talk about what President Trump is proposing, and that is to actually decouple and to use a 60% tariff. Does that work? Does the U.S. have the appetite for that? I mean, fortunately, inflation is coming down, but 60% tariff could mean an inflationary impact on prices.
Yeah, so we saw what a 25% tariff did, so we can predict a few of the things that a 60% tariff would do. So first of all, as I mentioned, a lot of American importers ended up paying the tariff because China is the only supplier. So that will be passed through to American customers. That will have an inflationary impact. There might be some minor substitution towards U.S. producers. Mostly what you'll see is more diversion to other countries, whether it's Southeast Asia, whether it's North Africa, whether it's Latin America. You'll probably see even more aggressive use of the de minimis exception. Now, I don't want to say that nothing will happen. Over time, yes, more and more production will be outsourced to other countries. You know how in India, for example, Apple is steadily building up their supply chain there. So even if only a tiny portion of their iPhone value comes from India now, that proportion will grow. But it's kind of like floodwaters. I mean, China is flooding the world with cheap exports, and it's very difficult. It's like floodwaters, they will find a way into our market and other markets. It's very hard to keep it out.
From the China side of things, given where their economy is right now, and that is struggling, with the government doing everything they can to sort of prop it up, what would this mean to that side of the equation? Because that could then have ripple effects in other places, especially Europe.
Right. Well, the first thing is Beijing's not going to take this sitting down, lying down. They didn't last time, and they won't this time. So they'll hit the U.S. with higher tariffs. That will extract the cost on the U.S. economy and the producers who sell to China. And the other thing they'll do, because they did this in 2018, is they'll depreciate their currency. And so if we hit them with a higher tariff, Chinese products will become commensurately cheaper as the currency goes down, and that neutralizes the tariff to some extent. And even if it doesn't keep even if it keeps some Chinese products out of the United States, it means that even more Chinese products will go into third markets. And you can sort of imagine a scenario where the U.S. Ends up being this island, this autarky almost, where Americans pay high prices to keep Chinese stuff out, but Chinese brands and Chinese products become to even increasingly dominate everybody else's market.
Greg, a lot of things to think about. Thank you so much. Fascinating.
All right, thanks for having me.
Coming up, a Canadian company shorted by Muddy Waters responds to allegations of accounting manipulation. Got that earlier this week on the show. That's coming up next. And the Senate passed round one of a bill, just round one, to fund Ukraine and Israel. Senator Michael Bennett of Colorado will join us at 8:30 a.m. Eastern Time. Squawk Box coming right back. Welcome back to Squawk Box. Yesterday, Carson Block of Muddy Waters Research announced a short position in Fairfax Financial Holdings, alleging accounting manipulation. Fairfax, a Canadian company primarily in the property and casualty insurance business. Well, Fairfax issued a statement. Here's part of it. Fairfax disagrees with the allegations and insinuations contained in the report and would like to assure all shareholders that Fairfax has prepared its financial statements and reporting in accordance with all applicable accounting principles. The stock fell nearly 11% on the Toronto Stock Exchange. The company is expected to release fourth quarter and full year results next Thursday. It's going to hold a news conference on Friday, February 16th.
Coming up next, President Biden responding to a report questioning his mental fitness in a late evening press conference. What this means for his campaign for a second term. Squawk Box coming right back.
Will.com.
I know what the hell I'm doing. I've been president. I put this country back on its feet. I'm the most qualified person in this country to be president of the United States and finish the job I started.
That's President Biden responding to questions about his mental fitness following special counsel Robert Hur's report, which portrayed the president as having, quote, diminished faculties. Maybe I'm having my own diminished faculties at an advancing age. Joining us right now is Frank Lund, strategist and pollster with FIL Inc. Also Jeff Harwitz of Hart Research. He's a Democratic pollster. Good morning to both of you. Let's just to get your initial reactions, both to what the special counsel said itself, and then this sort of impromptu press conference that we saw after. Frank?
Well, Andrew, we've been through this before. I'm old enough to remember Ronald Reagan in the end of his administration. And he was significantly younger than Joe Biden at this point, and he wasn't asking for re-election. at this point. What the special prosecutor said was to say that no charges should be filed. It was devoid of politics, of partisanship. He simply made an observation about the president and his capabilities. And the irony is that the president, Joe Biden, proved it in that press conference by how he responded to reporter questions. Even if you like the guy, even if you support Joe Biden, you can see it in everything that he does. And Andrew, your focus group last week said the same thing. It's not just about age, it's also about where things will go in the years to follow. So it's pretty indicting.
Jeff, indicting or not indicting?
Look, the big story from yesterday, as Frank rightfully pointed out here, is that a Trump-appointed attorney made a determination that President Biden shouldn't be charged with mishandling documents. That was his charge. The investigation is over. That's very different from what we're seeing, and as the attorney mentioned with Donald Trump's case, which is ongoing and includes obstruction of justice, which is not something that Joe Biden was accused of. So that's a fundamental difference, and that was really what the attorney was tasked with. The unfortunate reality here is that then the attorney donned his medical robe, which he does not have a degree for, is not qualified to address, was not his charge, and did a political hit job on Joe Biden, which is the unfortunate part here and where some people are focused. And I think we should be very mindful of why he did that. And the unfortunate reality is, in today's MAGA Republican Party with Donald Trump, it's not good enough to tell the truth. You have to please Donald Trump.
Yeah. Here's the thing I can't figure out. Just walk me through the Democrat positioning here. Because even if you think it's a hit job, let's just say it is a hit job. But at the same time, you know, there are moments where you see the president where he does seem, to be honest with you, frailer than you'd want him to be. And it appears that the Democrats and the Republicans, by the way, are playing chicken with each other, with two candidates that maybe neither side are particularly thrilled about, though it appears that there's a base on the Republican side that does seem to be a super supporter of Trump, and that the Democrats are unwilling to run anybody else, in large part because the president is the president, and here we are. But there is a question mark, and when you see people, Democrats, go online or come on television and say that they think that this president isn't up to the job, what should other Democrats be saying?
Well, look, there are concerns, as we've highlighted in our own NBC poll, that voters do have concerns about Joe Biden's age. It's also true that even among those who have major concerns about Joe Biden's age, he's getting a significant proportion of those voters who are voting for him, and which is unlike those who have major concerns about Trump and his criminal cases, that far fewer of those voters are voting for him. So yes, there are concerns. Yes, Joe Biden is going to have to address them. He is going to have to show that he's engaged and vigorous in defending his record and making the contrast here between the future of America that he wants and Donald Trump wants. That's all true. And he's going to have to do that. And I think, yes, last night was a start, and he needs to be better. But last night was a good start to that.
By the way, last night,
Frank, hold on. Jeff, I don't envy your position. I really don't. I know what you got to do. But do you remember Baghdad Bob? I mean, it doesn't help anyone when you say like that he's not a medical doctor. I'm not a medical doctor. Do you think any of us need to be medical doctors to see what's happening with the president? I mean, you're stuck with him. I understand that. But that doesn't mean you need to look into the camera and just say, the bottom line, the only story yesterday is that the special counsel is different than Trump, and they didn't get to do that. People just roll their eyes. It doesn't get you anywhere. You got to not, Frank, is it me or I mean, is that what pollsters do? The pigs and the lipstick and everything else?
Well, look, if I may, since you direct this to me, look, voters, as I just mentioned in the poll, voters are concerned about Joe Biden's age, and he needs to demonstrate that he's up to the job. Just as Ronald Reagan.
It's impossible to demonstrate that. He's going to be president 3, 4, 5 years from now in a world with Vladimir Putin and President Xi. And go ahead, Frank.
People make decisions watching this show about the future of their money, about the future of politics. Last night, he got the leader of Mexico and the leader of Egypt wrong. Every time he speaks, he gets something wrong. We have nothing against him, but it's our job as pollsters to reflect exactly what's going on. And these questions this morning have not been about Donald Trump. And I'm sorry that my Democratic partisan colleague has instantly turned it into politics. The question is Joe Biden capable of running this country for the next 5 years? He makes so many mistakes, so many more than Ronald Reagan did. And I remember the charge against Reagan in 1984, just put them up side by side. And you see the difference between Joe Biden, and you're asking to give him 5 more years? The Hart people did an excellent NBC poll, and it demonstrated just how many people are concerned.
But Frank, part of the problem is that life is relative, and the choice is, and this is it. The choice, you could say that you don't think he's up for it for the next 5 years, but there's other people who look at former President Trump and say that that's an existential threat to democracy and to the world.
Still rather have Biden, right?
That's why, by the way, that's why Americans are so angry. That's why Americans are so frustrated with the future. That's why there's the possibility of a third-party candidate. Because the public is saying, I don't like this guy. I'm afraid of this guy. I need something else.
Yeah, and look, Joe Biden is not the first president to mix up the names of foreign leaders. He's not going to be the last. I would say that also, again, this is, as we talked about, there is a contrast here. And Joe Biden also knows the difference between Nikki Haley and Nancy Pelosi. So there's a difference here. And voters are going to be making a decision here on the candidates who are on the ballot. And that is a choice between Joe Biden, where he's taking the country, and where Donald Trump wants to take the country back to.
Your poll, I read your poll. It is a great poll. The difference between people concerned about Joe Biden and his age and Donald Trump and his age is like this. Come on, Hart people. You're supposed to be the honest broker here. Acknowledge what your own poll said, and it was proven last night. Am I accurate?
Frank, yes, that is true that more people are concerned about Biden's age than Trump's age. It is also, I'd love to finish my thought. It is also true that those who have major concerns about Joe Biden are still voting for him in a way that those who have major concerns about Trump's both age and his trials are not. And the other truth in that poll that we conducted is that if Trump is found guilty, that there's a significant shift to Biden. So those things also matter in the poll, and I think all that context matters.
Joe is right. I don't envy your position. You're trying to fall into a Democratic position on a show that is nonpartisan. The fact is, there's a reason why Trump is winning in almost every survey right now, and that difference is 3 or 4 points. And the reason is that Joe Biden is frightening.
We got to go. We're going to continue this conversation. We'll have to have you both of you back. Jeff, I appreciate it. Frank, I appreciate it. And there's a lot more context and other things to talk about, and we'll try to do that hopefully very, very soon. Thank you, guys. Have a great weekend. Enjoy the game.
Coming up, we get ready for the kickoff of the trading day, plus the countdown to the big game. Plenty of time to get your bets in. FanDuel CEO will join us live from Las Vegas to give us a pregame report on this weekend's sports betting surge. Squawk Box returns in just moments.
possibly have.
Good morning. S&P 500 5K. The index breached that level for the first time yesterday, almost 3 years after it first crossed 4,000. And the futures are now pointing to more gains where it would be above 5,000 if it were to close out the Friday session there. Consumer spending in focus. New results out from PepsiCo. We'll bring you the details. And betting on the big game. As the sports and media worlds turn their attention to Las Vegas and the Super Bowl, we're going to talk about the explosion of sports gambling with the CEO of FanDuel. Final hour of Squawk Box begins right now.
Good morning and welcome to Squawk Box right here on CNBC. We're live at the NASDAQ market site in Times Square. I'm Andrew Ross Sorkin along with Joe Kernan and Melissa Lee. Becky is on assignment. Let's show you the U.S. equity futures an hour before, an hour and a half before we're set to open. Dow Jones looking like it'll open up about 42 points higher. Got the NASDAQ on the move as well, 48 points higher. And the S&P 500 looking to open, we'll call it 9 points higher. The S&P topping 5,000. That happened very briefly right before the close yesterday, though. It fell back and officially ended the day at 4,997 and change. Let's show you Treasury yields as well this morning as we all try to make sense of what Jay Powell is up to. 10-year note at 4.179. I should say the 2 years at 4.486. Melissa.
Shares of snack and soda giant PepsiCo lower in the pre-market after earnings. The company posting mixed fourth quarter results. Adjusted earnings per share were above estimates, but revenues came in a bit light. Revenue fell for the first time in more than 3 years, and volumes, which strip out pricing and currency changes, slid during the quarter. On the guidance side, Pepsi says it expects fiscal 2024 core earnings per share of $8.15, a penny above expectations. It also raised its annual dividend 7%. Stock is down 1.4% right now.
Among today's other top business stories, the White House announcing it is allocating $5 billion more in funding from the CHIPS and Science Act. This is meant for workforce development and training and to help set up a public-private partnership that's going to lead to the creation of a national semiconductor technology center. Awards for big-name companies like Intel and Taiwan Semi are still on the way. The Commerce Department saying those should arrive in about 6 to 8 weeks. And speaking of chips, here's a headline for you. OpenAI CEO Sam Altman reportedly wants to shake up that industry in a very big way. The Wall Street Journal reporting that Altman now speaking to investors about an effort to increase global chip building capacity. The cost, the price tag, how much he's looking to raise, potentially as much as $7 trillion. That's with a T, $trillion. The drive would be a boon for Altman's own company and its appetite for top-of-the-line computing technology and processing power. The Journal saying Altman has spoken with investors from the United Arab Emirates, that government, as well as many others. And yet another chip story that we're also watching this morning. We're watching shares of ARM Holdings. Take a look at this. It is jumping 48% yesterday. That came on better than expected earnings and strong profit forecast for the current quarter. Since it went public in September, ARM shares have now more than doubled in price. What you laughing at?
Well, I mean, we know that some of those Middle Eastern companies are, they're oil rich. But, I need 5 to 7 trillion. I'm talking to the UAE. Well, I mean, we don't have 5 to 7 trillion, do we?
No.
Nothing close.
Nope.
I mean, I just think it's funny to say, well, he wants to raise 5 to 7 trillion. He's even talking to the United Arab Emirates about what would they be good for? What would they be good for out of the 5 to 7 trillion? I mean, are we talking about a billion? What's that, 1 gazillionth of 7 trillion? What's a billion? Is that 7,000 billion?
Well, you need a few of them.
It's 7 trillion is 7,000 billion, Andrew?
Yeah, supposedly.
7.
I mean, you look,
It's you need scientific notation.
Your point is that it's unlikely.
No, I just think it's funny to say, well, Sam's serious about this. He's even talking to the UAE. I know they got a lot of oil money, but 5 to 7 trillion, you're talking, that would be a global initiative that would need a consortium of the richest countries in the world to get anywhere close to that. What's our debt now? 33 trillion, right? 33, 34.
Right.
So, I mean, that's almost a quarter of our entire built-up debt. Now, with under 90 minutes to go before the opening bell on Wall Street, let's get over to our senior markets commentator, Mike Santoli. I've been underestimating the UAE. I think, Mike. I had no idea.
Yeah.
If you need 5 to 7 key, you go to the UAE.
My guess is it's not all up front. Hey, we have $6 trillion of money market assets right now, so maybe we can cover the majority of if we get agreement on that. So we'll see. Look, in terms of the S&P 500, we're talking about big numbers. Yeah, 5,000 is interesting, maybe not technically or fundamentally particularly relevant, but the angle of approach to me is significant. You're up almost 22% from the intraday low. Late October, so it's just a bit over 3 months ago. It has gotten just a little bit stretched relative to its 200-day average. Back in July, we had a similar percentage above trend. The thing is, when you get overbought, and this is just a statistical reading of it being a little bit overbought, it means the underlying trend is strong, even if you're going to cool off a little bit. So when you get these kind of bursts higher, it usually doesn't mean an absolute top, but often does say, got to cool off, maybe flatten out just a little bit. We'll see if that does happen at some point. Looks like we're going to open above 5,000 today. Take a look, though, at the eco-weighted version of the S&P. Everyone complaining this is a very top-heavy move, very narrow leadership, just the trillion-dollar-plus market cap companies. Not really the case. You see the eco-weight S&P now, of course, it's not as impressive a surge. This is a 1 year, but unlike the previous times when you got to these levels at the upper end of this range and kind of reverse quickly, it's just kind of churning around, going sideways, doing okay right here. It's about a little over flat year to date. It's still up 19% from the lows. So the average stock is hanging in there, even as you've seen Treasury yields shift higher a little bit over the last few weeks. Now, industrials is another pocket of strength that is somewhat getting obscured by the focus on the things like the Magnificent Seven. This, again, is a 1 year. It's industrials. There's nothing magnificent in the leadership here. It just shows you this market is being able to embrace a decent economy, a stronger than expected economy with a capex boom alongside it, Joe. So some bullish signs, although at some point you would imagine latter half of February sometimes is choppy. You might have a little bit of give back, but probably not the big one if we do get a pullback.
Mike, Barron's used to have the Super Bowl indicator all the time. What happened? How many did it got it wrong just too many times? Do we want the 49ers as an NFC team if we're bullish? Should we be open for them?
It's changed so many times. Initially, it was an original NFL franchise, not even just NFC. Most of the time, that's what overlaps. But I think the problem is somebody came up with the Super Bowl indicator when you'd only had about 12 or 14 Super Bowls. And so therefore it wasn't exactly the biggest sample size. You had a pretty good, pretty good record. And then it just sort of, as a larger sample size came in, it was
irrelevant. That was just my way of getting to ask you what is your prediction and what's the final score?
I have no prediction. I like the fact that the spread's been tightening up. It basically just means it's a pick 'em. And you can go from there. So I know this. I know the stats models seem to prefer San Francisco, but maybe not in the second half if it's a close game.
And if Taylor makes it,
right? Can't even. And how do you even quantify it? Right?
I don't know. I got to talk to that kid who's tracking her jets.
Yeah.
See if she's leaving in time. Think she'll do one less encore?
This is what I was saying. I was saying if you had bought tickets to that concert,
because her mind would be elsewhere.
But I said on the whole time, she's going to be like,
did.
"Am I making it? Am I going to make this?
Don't you think she's a professional? She can.
Yeah, she's amazing.
Multitask.
She's amazing.
When you're sitting here, do you think about your mind preoccupied?
Preoccupied all the time. He thinks I don't listen to a word he says.
He doesn't. But that's deliberate.
In general, no matter even if your day is empty.
Right. That's deliberate.
That's deliberate.
Thanks,
Mike.
Yeah. Thanks, Mike.
All right, let's get to the broader economy now. Joining us here on set, Kamal Srikumar, president at Srikumar Global Strategy. Sri, great to see you.
Good to be here, Melissa.
So you actually think the first cut could happen in the April-May meeting, but it's not because inflation is going down, it's because of commercial real estate?
Exactly. I have been talking on the show, Melissa, about a credit event shock that is coming. I had put out 3-4 different factors. But now increasingly it seems to be coming from the financial sector, the banking sector. And even Janet Yellen, the Treasury Secretary, who until recently has repeatedly claimed that the banking system is sound, has given way to talking about her concern about commercial real estate. Yesterday, she told the Senate Banking Committee she is very worried about non-bank mortgage lenders. So you have, I think, what I call a CRE tsunami that is coming. The timing, you may disagree. You may say it's not 2 months, it's 4 months, but somewhere in the first half of the year. That's why I picked the May-June meetings for
Right.
when the rates would be cut.
So you're not necessarily highlighting what's going on with New York Community Bank Corp, which was a surprise and generally perceived as idiosyncratic and specific to that particular bank. You're saying that there's something beyond that. It's not going to be in the public markets. It's these private lenders that are going to be the source of the problem.
Exactly. I do not think it is just idiosyncratic. And yesterday, Janet Yellen made a point of saying she did not think it was systemic. And I have been saying for the past year it is systemic. And it has been building up. And I think we are reaching crescendo right now.
Is there a trigger that you see? Because we've seen or sort of forecasted that there would be issues with commercial real estate for quite some time, but there hasn't been that trigger. And I'm wondering, there was an article on Bloomberg this morning, or maybe it was last night, effectively saying that there could be ripples from China's need to sell some of these assets that they hold around the world.
Right. And again, yes, that is quite possible, but I wouldn't venture a guess, Melissa, as to where it's going to come from. But the China impact could be significant. We saw what happened in China with Evergrande and the liquidation. The property sector there is in deep dive. And to the extent there are sales which are going to elsewhere in the world, and the commercial real estate problem is also now in Europe, it is in Japan. So that's why I think it is systemic, and I don't know where the Treasury Secretary can say she doesn't think it is systemic.
Yeah, we saw a couple of banks in Europe having to mark down their portfolios.
Precisely.
Surprisingly, that didn't really have much of an impact here in the United States. It sort of happened, and then we all here moved on. I'm wondering then, if this is a tsunami, is this insulated within the economy, or does this have spillover effect across the economy?
It depends on how they handle it. And my guess is that if they do it earlier rather than later, which means cut rates faster and switch over from quantitative tightening to quantitative easing, in other words, don't act like you did in September 2008, allowing Lehman Brothers to go bankrupt. Supposing you had acted in July, August of 2008, and you had taken the essential steps, the drop would not have been as severe as it turned out to be. So perhaps they learned a lesson. They will cut the rates faster. They will switch over to providing liquidity faster. We already had one more experience with September 2019, where overnight rates shot up because of quantitative tightening. So they have a lot of experience. So I'm hopeful they'll act fast, Melissa, in which case you can limit the fallout on the rest of the economy.
So if the cutting path for you starts earlier than what some others are expecting, I'm wondering, Sri, if you think is the end point going to be the same? What is your forecast at the end of the year for where rates end up?
Once the rate cuts take place, and if it is taking place due to a credit event, two things happen. The cuts are substantial, and two, they happen very fast. And if that was happening, I would look for 6 to 8 cuts, or the equivalent of 50 basis point cut. If you call it 2 cuts as 50, 1 cut of 50 equals 2 of 25, some of that happening if the credit event in fact does take out to be very significant.
So if that happens and they do it swiftly, does that also shelter the economy from feeling what would have otherwise been a sharper tick up in, say, unemployment?
It would. In other words, we had a severe problem in 2008. And I think they keep repeatedly, both Jerome Powell and Yellen have said this is not 2008, this is a much smaller problem. They can make it a much smaller problem if they react faster, and in which case the increase in unemployment rate would not be as much. There is a cost. You're going to give up your fight against inflation, and that typically is what happens with the Fed. They keep fighting, and they find that they cannot at some stage continue with it, and inflation shoots up and they quit.
So by end of year, rates will be lower.
Lower.
And inflation will be higher.
Higher than where it is today.
Right. Sri, always good to see you.
Thank you. Great to be back. Thank you all very much for having me.
Okay, coming up on the other side of this, with the Super Bowl just 2 days away, the sports betting industry has never been bigger. Contessa Brewer is live this morning in Las Vegas ahead of the game, and he's going to bring us a special interview right after this. Welcome back to Squawk. I want to show you the futures right now. We still got a little over an hour to go before market's set to open, but higher it will, about 60 points higher right about now. NASDAQ would open up 47 points higher. You look at the S&P 500 looking to open about 10 points higher. So if you're betting, here you go.
Let's
talk about betting.
Contessa, she's in the city a lot, it seems like. She's got a pretty good gig. 2 days to go before the Super Bowl. Bettors all over the country are scanning the available wagers. Contessa Brewer joins us now with a special guest. You're smart, Contessa. What a good beat.
From my second home, Las Vegas. I keep trying to get them to open a bureau here, but so far no luck on that. Okay, so with me today, they say $23.1 billion will be bet by Americans on the Super Bowl in all kinds of ways. That includes like casual wagers with friends. How much of that goes to the commercial sports books? With me now, Amy Howe, the CEO of FanDuel, which is the nation's market share leader. Give me a sense of how much you're seeing for this Super Bowl in Las Vegas with these teams compared to past Super Bowls.
Yeah, I mean, listen, we're just coming off phenomenal momentum last year. We just listed on the New York Stock Exchange last week, which was very exciting. Every year, new records are being set in the Super Bowl, and this year will be no exception. There's so much excitement this year around the player props in particular, lots of activity around Travis Kelce and Mahomes as MVP and Christian McCaffrey, but there's really something for everyone. So FanDuel this year has 600 pre-live markets. We have a really fun twist on Super Bowl, the classic Super Bowl squares. And there's some new markets, fastest ball carrier. So there's literally something for everybody to bet on this year. And don't forget to go in and place your prediction on whether Rob Gronkowski is going to make the kick of destiny. He's doing his redemption kick, as you know.
I understand about the Super Bowl ads that FanDuel has bought, that there had to be some adjustments because of the death of Carl Weathers, who was featured in your ads.
Yeah, it's been a really emotional week for the entire team. You know, Carl Weathers was beloved by the entire entertainment and sports industry, and we worked with his family, and Rob is going to do the kick. He's going to do it right before the kickoff of the Super Bowl, and Carl Weathers' family has agreed to have him featured in the ad, and so it'll be a great moment to really honor the life of Carl Weathers.
You had mentioned all the bets coming in for Travis Kelce and Patrick Mahomes and Christian. I'm wondering how much Taylor Swift is driving women into sports betting. We know that there's been an impact on engagement and viewership for the NFL.
Well, there's no doubt the Swift effect is real. You know, since she's been on the scene, the volume of bets on Travis Kelce has literally doubled. We're heading into the Super Bowl. He is the most popular for first touchdown of the game, most popular for MVP. But what we're seeing is a lot of women coming onto the platform, right? The great thing about the Super Bowl is we have millions of new recreational users, and a lot of those are women. You know, almost 35% of our activations are women, and there's no doubt that this effect has helped.
Here's the crazy thing. The American Gaming Association is predicting that 1 in 4 Americans is going to bet on the Super Bowl. A lot of that is going to legal sports books across the nation. And yet the 2 Super Bowl teams are from states where gambling is not legal. Not only that, here's the Super Bowl in Las Vegas. Eilers & Krejcik, which is a big industry research agency, says 13% of the total amount wagered in the United States comes from Nevada, where you can't bet on FanDuel. When will you be in Nevada?
Well, we're cautiously optimistic that one day we can. We do have a great sportsbook here with our Boyd partner at the Fremont Casino. But listen, I think it's a great reminder. We still, you know, in 5 years, we've come a long way in opening up the U.S. market and regulating it and providing a safe, haven for consumers to bet legally. But we still have a long way to go, right? California, 13% of the population, hope to be in Nevada someday. But we still also have Florida and Texas. So there's a lot of hard work to do. But you know, so far, 5 years in, we're protecting consumers, and we're doing exactly what was intended, is to also help provide great revenue back to the states.
Florida right now does offer sports gambling, of course, but only through Hard Rock, which has pretty much the monopoly on the whole state. So that provides some additional competition. Speaking of which, there's a lot of elbowing for market share right now. FanDuel in the lead. DraftKings has gained some ground, but you've got newcomers. ESPN Bets has just relaunched from Penn Entertainment. Give me a sense of how much market share matters in this race towards total addressable market.
Well, listen, we're coming off of Q4. We were the first operator in the U.S. to be profitable for the for the full year. And listen, that's a huge inflection point for the company. We're demonstrating that we can build a profitable model. But in the end, we also know that scale matters. So we do focus on profit share, but it's a combination of both of those things. And we're going to stay focused on what we know works.
The almost 2 weeks since Flutter has launched on the New York Stock Exchange, have you seen a difference in the kinds of questions people want to talk to you about? I mean, is 2 weeks enough for you to see, oh, it does make a difference for FanDuel?
Well, there's been unbelievable receptivity from investors. And I think finally, you know, the Flutter is the largest global gaming company in the world. And so now U.S. investors in particular have an opportunity to get access to the largest and most profitable U.S. company. But they're also getting access to some of the global leading brands, right, that are growing, very cash accretive. So this is a great opportunity for you investors to buy in. And for us, you know, it elevates our profile and gives us an opportunity to make sure that, you know, we can get access to the best capital markets in the world, so we can keep innovating and giving consumers a great proposition.
Listen, we know that the NFL puts special rules on the players for the Super Bowl teams. No gambling at all. No slots, no blackjack, nothing until after the game is over on Sunday. I know integrity has been a really strong mission of yours. You have teenage sons. but the Keyshawn Booty investigation, which FanDuel turned into Louisiana, has brought, again, a new questions and new concerns about integrity for the sport. Give me a sense of where FanDuel stands going into Super Bowl now about making sure the game and the betting are all above board.
It's a really important topic, and as one of the 3 official sportsbook partners for the NFL, we work very closely with them to shape and enforce their policies. And listen, I think these are a great example of the regulated marketplace working exactly as it was intended, right? We're working with law enforcement, state regulators, and the NFL to make sure that if we see any problematic behavior, we can identify and correct it. What we're doing is not easy. We're bringing an illicit market into the light, and so there's going to be some growing pains, but make no mistake, in the end, the transparency and the enforcement is absolutely going to protect the integrity of this game.
Amy, I really appreciate you getting up very early in Las Vegas. And by the way,
still
you guys,
dark out.
It is so cold.
It's a little
right
chilly
here, even though we're in the desert. Like it's desert cold. There's shivering going on here, Melissa.
No need to make up an excuse to wear leather, Contessa. Thank you. Coming up, the Senate moving forward on a nearly $100 billion international aid package. In just a few minutes, we'll head to Washington to speak with Colorado Senator Michael Bennet, one of Ukraine's biggest backers in Congress. But first, as we head to break, check out shares of some of the key cryptocurrency-focused names like Coinbase and MicroStrategy. Coinbase, by the way, this gain pre-market is on top of an 8% gain in yesterday's regular session. We're seeing these gains at the same time. Bitcoin has topped $47,000. Stay tuned. You're watching Squawk Box on CNBC.
.com.
Shares of Pinterest are sharply lower. Earnings of 53 cents a share beat estimates by 2 cents, but revenue fell short. Monthly active users rose 11% to $498 million, beating estimates, but average revenue per user was $2, and that was 5 cents below estimates. The current quarter forecast came in weaker than expected. The stock initially sank as much as 28% in after-hours trading, but rebounded after CEO Bill Reddy announced a third-party app integration with Google. During the analyst call, the stock down 8.4%.
Coming up, some takeaways from a high-profile Senate hearing on the cost of drugs in America. Former FDA Commissioner Dr. Scott Gottlieb is back. He's going to join us with his thoughts on all of it. But next, we're going to speak with Colorado Democratic Senator Michael Bennet on the big Ukraine aid bill that just passed his chamber. And a reminder, as we head to a break, you can get the best of Squawk in our daily podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. We're coming right back.
Or download the app.
Welcome back to Squawk Box right here on CNBC. We're looking at futures that are much higher this morning. Still got an hour to go, but right now Dow up about 162 points, NASDAQ up about 105 points, the S&P 500 up 25 points.
The Senate advancing a $95 billion aid package for Ukraine, Israel, and Taiwan. The vote to begin debate was 67 in favor and 32 against, but final passage isn't guaranteed, especially if the Senate leaves Washington for its next recess without approving the measure. It's also not clear which way the House would vote or if border negotiations would again become mixed up in all this. Joining us now, Colorado Democratic Senator Michael Bennet, one of Ukraine's key supporters in Congress. Is there still the opportunity? It's very arcane, a lot of the way things work, Senator. Are there opportunity for amendments for this to include border provisions at this stage?
Arcane is a polite word for a total mess, but there is the opportunity for amendments. We have to negotiate those out at this stage, and that's what's going on during the course of the day. This is always a little bit of a fight between people that want to go home, people that want to get amendments. My view is that we can't leave until we've fulfilled our responsibilities to Ukraine, to NATO, and to democracies all over the world. And I think we're off to a very good start finally with a big bipartisan procedural vote. But as you said, that's not a guarantee of success. We should stay here to the weekend and make sure we get it done.
Senator, do you get the impression that that Ukraine is just barely holding on here without further aid? I've read articles that the stockpile of usable ammunition and the like, that it's really dangerously low. How bad is it right now?
They're out of bullets. That's the way to think about it. They're rationing ammunition. 2 years ago, when Putin invaded them, nobody thought that they would succeed the way they have, and they have astonished the world. They've taken back half of the territory that Putin took from them. They've won battle after battle after battle. They have pushed Putin's navy basically out of the Black Sea without even having a navy of their own, which has been critical for grain shipments from Ukraine to the rest of the world. I mean, this really is a nation full of MacGyvers who started this war fighting Putin barehanded and have fought him basically to a draw at this point. If we don't supply these weapons, they're going to lose this war, and that's going to entangle us, I think, into Putin's ambition for Eastern Europe and Xi's ambition for Taiwan. We should be supporting the Ukrainians because they have been courageous in the face of tyranny and they're fighting not just for Ukraine, but for democracy.
Senator, were you able to watch the Tucker Carlson interview of Vladimir Putin, and did that inform your opinion in any way about what were you impressed? I don't know if you've seen it or not, but I know we had a president that looked into his soul once, and I don't know, totally misread what was there. Yeah. But did you get to what were your thoughts after seeing it?
I have not watched that interview. I think I'm more informed by the years and years that I've spent on the Intelligence Committee looking at the intelligence, both ours, the Europeans, the Asians' intelligence about Putin than watching Tucker Carlson interview this tyrant. But Putin's invasion of Ukraine is the first time since the New World Order, or since the post-World War order was established after World War II. We can't let it stand. The Ukrainian people have shown that there are still people in this world that will give their lives for democracy. And I think at this point, Putin knows he's having real trouble on the battlefield. His army has, in many ways, collapsed under the pressure of Ukraine. The battlefield he's counting on winning on is the battlefield of division in our political system, the battlefield on Capitol Hill, and we just cannot allow that to happen. I am amazed and really deeply pleased that after months and months and months of people drawing lines in the sand here, we got 67 votes to move this bill forward. That's more than 2/3 of the Senate. I hope we can hang in there with a vote that's that big, not just for Ukraine, but for Israel, for Taiwan as well, for the humanitarian aid for Gaza, and that we can send a very strong bipartisan message to the House that this country is not going to cut and run on democracy. We're not going to cut and run on the obligations that we have to NATO and to the rest of the free world, and that the United States, even if we have some political dysfunction, can overcome that in the interests of our kids and our grandkids.
There are, we had Afghanistan and Iraq, so there's this taste, I think, in certain Americans' mouths about what exactly we want to be in the world right now. But it's almost a catch-22 in what we're seeing. So, we don't want to spend a bunch of money on other countries if we don't secure our own border. But then once that gets included, we don't want to secure our own, or we don't even want to do anything because we want to let President Trump deal with that. So it's almost a catch-22. I don't know what the path forward is, Senator.
Well, there is a path forward. And first of all, let me just say, in months of working on this, you're the first person to raise Afghanistan and Iraq in this context. And I think it is so important because it is on the minds of the American people. We've sort of somehow skipped over that step. The reality is we spent 20 years fighting 2 wars in the Middle East that didn't make any sense. The American people look at that and they say, man, that doesn't feel like a great use of the resources of this country. And I think the evidence is very clear that they're right about that conclusion. That's why we better be sure about what we're doing in this case. You know, what we have are the Ukrainian people that are not asking us to supply soldiers, not asking the American people to lose our lives. They are asking us to supply them with weapons. They are asking us to supply them with intelligence. And by the way, we're doing it for less than, 0.4% of our GDP, a very small part of our defense budget. And if we had set out to try to weaken Putin's army in the way that Ukraine has done, or reestablish our position vis-a-vis Xi Jinping, I would argue we could not have done it more cheaply than Ukraine has done it. And Ukraine has the receipts because they've won battle after battle after battle, as I've said. So I do think the question that you pose is an excellent one, and we should be asking it every time we're in a situation like this. I also believe, I happen to believe, that we have to address the border in this country. The American people don't want chaos on our southern border. I think it turned out to be too complicated for us to do it at the same time we were trying to pass this bill, but we've got to get to that. The American people want not, as I said, they don't want chaos at the border, but they also, and this is equally as important, they want a functioning immigration system because they know that a third of the economic growth of this country over the last century has come from immigration. And it's a huge advantage that we have that Beijing doesn't have. There is nobody crawling on their hands and knees across the Gobi Desert to get to Beijing. People still want to come to this country because we have the rule of law, because we have civil liberties. And we have to preserve that, we have to enhance that. And it's not only about securing the border, it's also making sure we're driving economic growth in this country.
Right. Then we got the only democracy in the Middle East that needs it too. So it all kind of makes sense. All right, Senator, thank you. And I don't know, you may never go home. If you're going to wait to do something before you go on recess, I don't know. Good luck anyway. But settle in for at least a Super Bowl this weekend, because you're not going anywhere.
We should settle in for at least a Super Bowl and whatever it takes after that. Thanks for having me.
All right, thank you. You're welcome.
We do want to check out the futures. We did see a leg higher after the CPI revisions were released. This is a widely anticipated release. This will reflect seasonal adjustments, and it came in unrevised for December core at 0.3%. That was a sigh of relief. There was some concern that revisions would be higher and would sort of throw a wrench into the disinflation story that has been unfolding here. So we do have the S&P 500 up by 16 right now. We had seen the gains up as much as 22, but right now we're firmly above that 5,000 mark at the open. Coming up, the U.S. Senate digging into the high and frequently unaffordable costs of drugs in America. After a break, we'll talk potential remedies with former FDA Commissioner Dr. Scott Gottlieb. Stay tuned. We'll be right back.
Welcome back to Squawk Box. Drug pricing in focus on Capitol Hill. Senators criticizing the CEOs of Johnson & Johnson, Merck, Bristol Myers Squibb during a hearing of the Health and Education Committee. Lawmakers said that the high cost of prescription drugs in America means many people can't afford the medications they need. Our next guest says there are a number of easy reforms that Congress can enact if it can simply get beyond a focus on price controls. Joining us right now, Dr. Scott Gottlieb, former FDA commissioner, CBC contributor. He serves on the boards of Pfizer and Illumina. So you might be talking, I don't know if you're speaking you're talking your book or talking against your book, Scott, but how would you do it?
Well, look, clearly the high prices pressure consumers. There's no question about that. But what we need to recognize also in the marketplace is that many consumers now are underinsured for drugs. What we've seen over the last decade is the advent of closed drug formularies in health plans where more and more drugs are completely uncovered. Fully 50% of all single-source brand-name drugs are uncovered. So there's no coverage provided by the health insurance plan, not even co-insurance. That's a relatively new phenomenon in the marketplace. It really started with the Affordable Care Act, and now it's seeped into commercial insurance plans. And so that's a large reason why consumers increasingly feel the bite from drug costs. Last year, actually, in 2023, was the first year where net and list prices came down in modern times. So drug price inflation has moderated. You know, if I was trying to lower prices, I'd look for places.
Scott, don't you think there's an argument to be made that actually because the prices are high and the customer is feeling it, that actually prices have come down because, when you have insurance, it oftentimes just becomes a runaway in terms of pricing the actual drugs, no?
Well, look, there is rebating in the marketplace. So the companies do discount to try to get onto formularies, but they pay those discounts in the form of back-ended rebates, which are really fungible dollars that health plans use to cross-subsidize the cost of the insurance, the premiums, and not necessarily flow back to the consumers who are out of pocket for the drug costs. So there's a lot of things in the marketplace where consumers are disadvantaged. They're uncovered for an increasingly large share of their drugs, in part because of the higher prices. Plans use exclusions on formularies as a way to try to extract discounts and avoid high-priced drugs. And then when the drug companies do discount, rather than paying those discounts in forms that benefit the consumers who are actually picking up the drug at a pharmacy counter, they're paid in the form of rebates that the health plans use to try to buy down the cost of premiums across the entire plan. So the patients who need the drugs and who need high-cost drugs really are disadvantaged in this scheme. Now, there are things, to get back to your point at the top, there are things I think you can do to make the market much more competitive. You can allow biosimilars to be fully interchangeable, so that's a true generic market. I think there needs to be a focus on places where it's hard to get generics into the market, where there's barriers to generic entry, and those still exist. I think you can introduce competitive bidding inside the Medicare Part B plan, so Medicare isn't just a price taker on injectable drugs, but can do things like create formularies and competitively bid for those drugs like it does in the Part D plan. So there are ways, I think, to make the market more competitive and try to push down the price of drugs and increase competition for these branded companies. I think we also, finally, I would just point out, need to look at second-to-market innovation. With a lot of these branded categories now, once a drug comes onto the market, many times these markets are too small to sustain second-to-market innovation, so other drug companies will pull out of these categories because of the high cost of getting that second-to-market drug onto the market. I think we need to look at ways to try to make that process more efficient so that we instigate competition within some of these small drug categories, which are increasing the focus of drug makers.
I mean, we often talk about competition being part of the problem, but we often talk about the elasticity and these sort of agents that are sort of taking a piece of everything, and also the sort of lack of transparency around pricing that allows this sort of remarkable elasticity. What do you think is the underlying problem?
Well, the fully loaded cost of getting a single patient into a clinical trial for a complex drug like a cell therapy could literally be $1 million. That's an actual figure. So the cost of drug development has gone up exorbitantly. At the same time that drug makers are forced to provide discounts in more aspects of the market, 340B, Medicaid, and at the same time that their patent windows have been narrowed. The IRA does that. It's effectively a loss of exclusivity on drugs. And so what drug makers have to do to recoup those high costs of development and also pay for the risk that they're taking is spread out the revenue that they're going to achieve over a small number of patients. And those unfortunately end up being commercially insured patients who are paying the highest prices because of the discounting across the market. So thinking that forced and mandated discounts and price controls in one aspect of the market don't affect pricing in other aspects of the market and push up pricing elsewhere. We just can't think that way anymore. It is having that effect. So there's a lot of distortions in this market that are pushing up these high prices. The final point I'll make, you know, the drug makers aren't just facing headwinds in the US, they're facing a lot of headwinds in Europe right now. There's new legislation there that would reduce patent windows from 10 to 8 years and force drug makers to launch in every EU country, even those where they get very bad pricing that is ultimately used as a reference price. And Europe's increasingly an unattractive market for US drug makers. And so there are a lot of revenue pressures on the drug makers now. They need to get the drugs onto the market and ramp sales much more quickly because their patent windows are going to expire sooner. And that means investing more money in each drug that comes to the market, taking fewer shots on goal. And that's going to be a problem in the future.
Scott, always want to thank you for your insights on all of this. It's fascinating stuff, and hopefully we'll get prices down one of these days, but I'm not as hopeful as I wish I could be. Thanks. Enjoy the game on Sunday.
Coming up, we'll talk markets and get you ready for the opening bell on Wall Street now, just over a half an hour away. Stay tuned. You're watching Squawk Box on CNBC.
And comfort.
Investors are getting ready for the last trading day of the week after the S&P did breach 5,000 for the first time. Looks like it's going to be there this morning on the open. Joining us now, Surat Sethi, DCLA portfolio manager and a CNBC contributor. Surat, you don't think the market is necessarily severely overvalued or undervalued? Kind of like it's sort of right where it is.
Yeah, and I think, you definitely have the pockets of overvaluation, and then you've got the other areas, the, small caps and some of the value stocks that haven't come back. But I definitely think there are opportunities in the market. You just have to be fairly diversified at this point. And Joe, credit is not bad either. I mean, spreads are really tight, so they're actually indicating to the market that they don't really see anything down the hatch that's going to make this market too shaky. Now, yeah, we have commercial real estate, but that seems to be pretty fairly discounted at this point.
So what are the pockets of where you're seeing some value remaining, where undervalued?
So I would go to commodities, basic materials, look at companies like copper, steel, aluminum. And it's not a question of inflation, it's just a question of supply and demand. So a Freeport or a Tech Resources or a Cleveland Cliffs. Then I would look at the staples area. I mean, you look at, you know, the beer companies or just some of the food companies that have pricing that actually are trading in below market multiples. And then I look at utilities, and utilities have just been hurt because rates are where they are. But the earnings growth, especially companies like AES or Edison, are 8 to 10%, trading at 12 times earnings. So you can put capital to work. It's just that the market has favored growth so much that I think it's okay to be in other areas. And not to say you don't have to be in growth, you can be, but look at the other areas as well.
Why do you think the market shrugged off the sort of the pivot on the other pivot that we saw from the Fed, that rate cuts, it could be fewer and they could be later in the year than before? But you're looking at that chart right there. If someone told you that, you certainly can't see it from what we're looking at in the S&P.
Yeah, I think the market basically said, hey, listen, if the Fed is not going to cut rates now, it means that they're seeing a couple of things, which is that growth is still good. So if growth is still good, the longer we go, because we know most recessions are caused by the Fed acts either too early or acts too aggressively. So I think if earnings can still be strong, I think that's really good. And they're watching inflation. And I think that's going to be important. We saw the number today getting better for December. And I think you have that, and it's kind of that classic Fed put now. Because if they see something and they do it in time, I think that's going to help the market. But if they went too early, then most investors would say, wait, there's something that we're really missing. So you're kind of in that sweet spot. So I think that's where valuations really matter at this point. And chasing kind of the leg that we had in the last 18 months, I think most of that party's over. So now you really have to say, how are we going to make money down the road? And I think earnings growth, cash flow is really important.
Think that there's anything that can happen between now and November that would really scare the markets? I don't know why the market's not scared already. I mean, as Americans, we're kind of scared at what's happening. Does the market ever sit up and take notice, or it really doesn't matter what Washington does?
Well, I think at this point, something out of left field will have to come, and you already look at what's going on geopolitically and with what's going on, in D.C. So it would have to be something really out of left field. Oil's at 70, input prices coming down. So, but you could. I mean, look, in 2022, market dropped and then came back last year. So I think staying in the market, but understanding where you're invested, Joe, is going to be one of the most important things, I think, for the next probably 6 to 12 months.
All right, Surat, what are you gonna have on Super Bowl Sunday? Drinks, chips, chicken wings? What do you think? What do you plan?
I don't know. I think it'll be an interesting day just to see how many people are going to be watching, and I think probably one of the most fun Super Bowls out there.
I think it's going to be good too. Thanks, Surat. Enjoy.
Thanks, Joe.
Make sure you join us next week.
Enjoy Sunday.
Post Super Bowl. Squawk on the Street.
How many people are not going to work on Monday?
What is it?
Because of the
It's a
Super Bowl on Sunday. That's a big thing, People say
bad
they're
productivity.
sick. They say they're sucks.
I'm going to be dead.
I'll be here.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. Future's pretty solid here. S&P looks to reclaim 5K after yesterday's pop. Those CPI revisions relatively painless. Two-year yield drops to 4.43. Russell Futures up 1%. Our roadmap begins with a chips-fueled rally. The S&P is poised to open above 5K. NVIDIA, the biggest driver on the year. More gains expected at the open.
Plus, we're keeping an eye on corporate results, of course. Pepsi's revenue sliding for the first time in nearly 4 years. Expedia is blaming Boeing's 737 groundings for headwinds. And boy, were there headwinds. Pinterest seeing pressures on ads. And of course, it is Super Bowl weekend. Near record ad revenue is expected. And the game, of course, may also get a little boost from somebody named Taylor Swift.
It's hackneyed stuff. You come in at first. 5:59. The people that tell me this from people came to the bar and told me that. That's information.
What?
The Taylor Swift thing. You got to have another angle.
That's the only time in the show when I actually read something that's there. Okay?
Hey, I just wanted to start early in needling you because you spend the whole show needling me. I figure I get the little needle at the beginning and then we're ready to roll.
All right, we are ready to roll.
Okay.
Now I'm ready to roll.
I bet you are.
Yeah.
Let's begin with the markets. Above 5K yesterday for a brief moment. We're going to try to do it again today, Jim. People were sort of worried about these CPI revisions.
Well, yeah, okay.
December actually trimmed down a 10.
Right, but it's funny. I mean, I can't tell you how many people told me if we don't go over this and hold it, well, this could be back in the wilderness, the 2021 wilderness. Now, David, this is just, I know this is not the Dow, so it's actually just more important than S&P.
Yes.
But I mean, this is not, look, you could call, I don't know, Dave Tepper and take it over 5,000, right? Hey, Tepper, take it over 5,000.
Yeah.
I mean, this is not Dave Tepper being a very big hedge fund manager who also owns the Carolina Panthers.
Yes.
But, I mean, you could take this up, so let's just not make it so it's make or break, okay?
Okay, that's fine with me. I'm in agreement.
Good, okay.
There you go.
And tonight I have Cloudflare. See it?
Who do you have?
I have Cloudflare. So
Nice.
good night. Oh, I have to do it.
Jim, last night Goldman puts up a chart looking at eras in which you had an S&P all-time high and the Russell in a bear market. Happened in 95, and S&P continued to outperform a month, 3 months, 12 months out.
That was that strange period where interest rates go higher and the S&P still did well, and it was a very counterintuitive moment. I've always felt that it had much more to do with the x86 Wintel, because it was really just kind of a cool moment. Now look at this. This is so incredible. Now, if you look at, of course I'm going to give them.
Come on, give it to me.
What was one of the top 5 that moved the S&P from S&P 4,000 to 5,000? The outlier, not tech, not pharma.
Not pharma.
Yep.
And not tech.
Yeah. Builders first source.
Yes, that is the weird one. In the top, yeah.
Oh,
I
never would have gotten that one.
Floor and Decor, Builders first source. I'm going to take you. Going to blow your mind.
Is that the decking? What do they got?
Yeah, well, they have everything.
Yeah.
Yeah, I mean, like they're like mini Home Depot. Home Depot, by the way, we had Masco upgrades. We had tremendous numbers from ASIC, and we had terrific numbers from Trek. And yet people they don't want to buy Home Depot. I think it's a big mistake. But this Builders Force, so David, this is an exciting place.
Wow. I didn't know. See?
We got some, even though Mohawk guided below, Jim, they do think the industry's at a low. We got a little M&A between Owens Corning and Masonite.
Masonite. Masonite was one of these very controversial companies when people did when it came public. It real popped. I remember the CEO is a terrific guy. It's just changed, and this is creating this is a powerhouse. Owens Corning Masonite. It's a powerhouse.
And it's a good premium since we've gotten to it. Remember, Masonite was actually trying to buy PGT Innovations. And then that got away from them, and a company called Miter bought them, but they were in a fight there. I don't believe that many had expected, perhaps, that Masonite would then immediately turn to put itself on the block. But frankly, I haven't covered it that closely. But to your point, $133 a share, and that is a 38% premium to right where the stock was yesterday. So
this is the stuff
we're not talking about a large deal here, guys.
No,
a little over three, almost $4 billion total.
It's the tenor of things.
Yeah.
Like, you come in and Masonite you owned Masonite yesterday, and you're like, I got the stock. What do I do with it? And then, boom, you're slammed upside the head with a bid. This is our market.
Yeah, we haven't had that much. I mean, where are we? Early Feb? We haven't had that much M&A to speak of. We've had some. We saw Catalan as being one of the leaders, of course. That was a deal from earlier this week.
I just find
we've had some. We've had a pace of deal making, but not, frankly, far off from what we saw last year. And last year was not a good year when it comes to volume.
Last year we had an agency, a run-amok rogue agency that's blocking everything.
We'll see. I keep hearing everybody wants to talk big game about big stuff they're working on, and maybe it'll get to the finish line.
Yes, I'm hearing similar.
A 50 billion one or this, but they seem to run into the same issues that would have plagued a deal in the past, which is not about regulatory as much as social issues and price, which are difficult things to negotiate. That said, regulatory, I don't want to imply that it's not still an issue, Jim. But Mina Khan is still on that job.
Yes, she is. Yes, she is. And we're going to talk about, say, Pinterest. We talk about a firm. And when you listen to these companies, they almost feel like that they should be merging. That the standalone is not powerful enough. They don't have the scale. And there, I think they would hit the radar screen of Mina Khan.
Right.
I mean, because Pinterest, Look, I think Bill Reddy's really good. I don't think the quarter was nearly as bad as people thought. I think that they fled from the quarter because they feared it was going to be a snap. These guys have an Alphabet, Google deal. They've got an Amazon deal. They have a huge presence in 80% of their business is international, but only 20% of their clicks to buy are international. They can fix that. Bill Reddy can fix it. That interview was terrific last night.
Yeah, Q1 revenue guide does disappoint. There were some questions, Jim, about the Amazon partnership not yielding as many benefits as you might have thought at one point.
I did. I felt that, and I think that when you do a deal with Amazon, remember they do deals with a lot of people, and you tend not to win. Amazon tends to win on those deals. That's why I like the Shopify deals. I always feel Shopify are win-win, so to speak. Yeah.
Meantime, you mentioned NVIDIA and what an engine it's been for the market overall.
Yes.
Some pieces today about how it's threatening to overtake Amazon as the number 4 largest market cap.
We talked about that a bit yesterday.
Well, yeah, but there's new news here. They're going to do customized chips.
The Reuters story that I think Carl was just about to get to.
Which could be bad. You know, Marvell is the one, Marvell Tech, which I like very much, is one that customizes it. And then Mike Chappell Trust owns Broadcom, and people may see that Broadcom is a loser in this customization. I caution people to sell those stocks because they're really good. Broadcom is better than Marvell because Marvell's got this optical thing, and there could be lumpiness, and they would tell you that. But I think that NVIDIA, once again,
well, what do you make of the
when
Reuters?
you listen to Sam
Jim,
Altman,
as well as you know this company, what do you make of this Reuters story that talks about how they're going to try and help some of these companies make, again, sort of these more exclusive chips? New business unit focused on designing bespoke chips for cloud computing firms and others.
Just, you know, look, Jensen Huang wants to, he comes in peace to all potential customers, and I think that, remember, he has the best relationship with Taiwan Semi. They'll get that done. Jensen, you can't get in the way of Jensen right now. Let this thing go higher. Let it go higher. Because when you talk to, like, I'm on a conference call with the fellow who runs GE Healthcare, and what does he want to talk about? AI. And is there AI? Yes.
I mean, I think some would argue that the two most incredible charts of the week are TSM and ARM.
TSM broke out so big. ARM, I had a nice talk with Renee. I mean, I have to like Renee.
You seem to think it wasn't a short squeeze yesterday, but everybody else seems to think it was, because the float is very small. As we pointed out, SoftBank controls most of the shares. They're not a seller at this point, is he clearly. I think the lockup is soon.
Mid-March, March 13th.
Why would you think it was not in part a short squeeze? A 60% move. Come on.
Well, okay, so you clearly did not watch my show from last night.
I did not watch your show.
Where I talked about how you had to take some profits because when the lockup expires, the stock's going to go down because there clearly was not enough supply, and that's why the stock was driven higher.
Oh, okay. Because yesterday you said it wasn't a short squeeze.
Well, I didn't know.
So you
it was
revised your
up
opinion.
there. I didn't think that, unlike Disney, it would stay. I mean, Disney just kept going higher. I thought ARM would stop, and ARM did not stop. But there is apparently no indication yet that there might be a sweetheart lockup ending. And I also want to know, remember, there's these anchor tenants that they brought in
that
a lot of hedge funds thought were phony.
That's right.
And instead of made a lot of money, you know, Intel is an anchor tenant.
They were. I'm glad. Actually, I'd forgotten about that. But yes,
remember, they're
talking about a company that went public at 51 not that long ago.
Right.
Of course, one of the bigger IPOs of last year. And is now more than double.
Yeah. But your point about breakouts, I mean, we can talk about chips all day long, but Disney arguably won, Jim. Hershey this week, kind of breaking out of a pretty ugly trend.
Yep. Look, I go over Disney pretty closely. There are some real wins. There are some real wins in the Disney company. What? Did I...
I don't even need to say anything. He can just feel my piercing gaze as I look at the side of his head.
I did not want to get in the crosshairs of you immediately. I think that there's some positives in Disney. I'm not going to overlook that. And I would start, by the way, just so we know, that there is this Netflix comparison may not be as, maybe a little more fatuous.
The what comparison?
The Netflix thing.
You mean in terms of
the
passwords?
Yeah. The margins, they have a 10-year head start on Disney.
Yes, they do.
It's not they have a 4-year head start.
And a technology head start is certainly what you'll hear as well, often. Yes.
So, I mean, I think we have to drop that analogy. A lot of people use that constantly and went away from it. And I understand why Bob Iger would sound frustrated about that, because it is first of all, comparisons are odious, as our mothers told us. But it's just like, whenever you mention Netflix, it's kind of like, okay, so Disney missed out. All right, enough.
But is there any reason to think that password share revenue gains would be any different at Disney than they were at Netflix?
Just, you do have the younger cohort tends not to have their own houses and.
You mean kids, little kids.
I mean, we have a lot of younger cohort stuff. Remember Snap. When you look at Snap, they could have like 2 billion people who are 12, and they don't have 10 cents to buy anything. Oh, 10 cent. Forgot that. We haven't mentioned 10 cent or Shein, so we obviously don't know what we're doing.
That may be true.
I got some more stuff from Shein yesterday.
You got more actual clothing?
For my wife that I bought like about a month ago. Just be careful. I'm telling you, it's not. You wore Ralph Lauren yesterday. I don't want you to confuse Ralph Lauren with up $25.
You don't have to worry. I don't buy anything.
Who buys your stuff?
I don't know.
Who bought that TJX shirt?
This was, came to the house. I don't know. It wasn't bought by me.
It came in the mail from
by the way,
the clothes fairy.
It's not even signature.
TJX, really?
It's not even signature. The Kirkland signature look. You have it coming. I mean, look at that thing.
You don't like this shirt?
No.
It's nice.
It's pretty
Nice
easy.
Friday. Yeah, no.
Collarless.
Come on, collarless. I got to have a little color.
You know, someone just said in my Your Raw stores, and I'm coloring with Burlington. Now, I don't know if you've ever been to Burlington. I had like a fist fight with Burlington.
I've
the
never
guy.
been there.
We were fighting
Never
over
been
a
there.
T-shirt
I won't go.
that said was like, I'm Taylor Swift's boyfriend.
When we come back, a lot of earnings movers to get to. We'll get to Pinterest, Expedia, Take-Two, Affirm, Pepsi, of course, upgrade of United Airlines today. And, of course, we'll talk the Super Bowl after a break.
Yep. Good morning, retail traders. Netflix is up. PLTR 2451, new high, 2522. NVIDIA just hit my resistance again. Double top, new high, or double top. Tesla pins yesterday. By WM, new high. SPY broke 500. Coin, Mr. had a good day today. MSTR. Big pop on Bitcoin. Bank of America was down yesterday. CMG had that big run. Chipotle. Down $70.
5.
Welcome back to
Pins.
Squawk on the Street. This weekend's Super Bowl is not only the biggest day for football, also the biggest for the ad industry. New data out of B of A today shows the jump in figures surrounding the game. A 30-second ad back at Super Bowl.
I never did enjoy the ads at all. Like some people, they're just like glued to the couch, watching the ads. I'm going, God, I actually got out of there and got some fresh air. But I always thought it was amusing and laughable.
No one has rebelled against the price of entertainment. And it is probably unfortunate because that does price out people. I'm hoping that, I know that the Vision Pro costs so much money, but it's a great way to watch a concert. So I think that we'll be okay there. Now, when I look, PepsiCo not doing the sponsorship, it's Apple. PepsiCo will have a number of ads, but the winner already,
KO.
I know, it's the Elf Beauty ad with Judge Judy. It's not even
I thought you were going to say maybe Uber or...
No, it's the Elf ad with Judge Judy, and David's going to come in here. Can I do a spoiler alert? Are you allowed to do that?
Sure.
It ends with "You're a putz."
Really?
Yes.
So you've seen the ad?
Well, you're a tough guy,
No,
Jim.
I have no knowledge whatsoever. I'm like the guy who from Davidson who said there was no tech innovation, and then he saw the Vision Pro and said there is tech innovation.
Judge Judy is a powerhouse. Most likely been the highest paid person on television. People don't realize for, I don't even know how many years.
So she's a Joe Rogan?
And huge huge deal with Amazon.
Right.
For her new shows and then syndicating them back. Tribunal Justice, by the way, as well. I'm doing Judy. Fall 2026 syndication launch.
Did you see the ad?
Justice clears 95%.
Taramin, by the way.
Do not mess with Judge Judy.
No, Taramin from Elf. I mean, you have to look at that stock. It's one of the greatest performers of our time. And their ads are always very piercing, and people look at them. And I think their ad, we're all going to come in here and say, I cannot believe it, that Elf Beauty had the best ad. It's funny.
Meanwhile, Jim, a lot of focus on the cost of food, drinks, party favors, for example.
Jets.
We're expected to spend $17 billion. Wings are actually down year on year.
I know.
But a basket of items like chips and salsa is up about the same amount.
I went and got a loan from JP Morgan because I'm using a Whole Foods basket for a Super Bowl.
Okay. Oh, that's expensive. Yeah. I get it.
You see, he wrecked my whole timing. I had everything. You're supposed to go like ba-dum-bum or something,
I'm sorry. I was looking up something. I was trying to stay on top of some
the
actual
railroad
news
guys like your
today.
shirt.
Oh.
He's got a good railroad guy, but
There
like
are a
in his
lot
shirt.
of people who like
a railroad CEO commented positively on your
my
shirt.
dress today, and they think that you were just being mean.
Well, I tell you, what you really want is that railroad cohort to just come right down and say, he's the best looking guy on TV.
You got a mad dash you want to start thinking about? Why don't you do that, okay?
I will.
Okay, good.
I will.
We'll get Kramer's Mad Dash. We'll also get your updated pick for this weekend because the line's pretty tight.
Yes, it is. That's why you don't even want to take the points.
Futures hanging in there.
I forgot one of the best performers for last year's Marathon Pete, and you wonder why. Versatility.
We're back in a moment.
Well, looks like I forgot to turn on. I had YouTube on.
Ooh.
We got 8 minutes left.
NBC.
All right, we're having a Black Friday here. We got about 7 minutes before we get to an opening bell. Let's talk for the Mad Dash Expedia.
Yeah.
But we get to it. We may come back to it because the stock is not looking good.
Right. Now, first of all, I will tell you that one of the better CEOs that people are unsung is a guy named Peter Kern. And I've loved him. He's doing Expedia. He did when I did the Space Needle in Seattle. He's best been fat. Well, he's retiring. And that was very unexpected.
Yes, it was.
Very. Now, David, he
Also,
dropped...
we should point out, Ariane Gorin will be the new CEO effective May 13th of this year.
So we didn't know
Yesterday
that.
was a
And
really,
lot of
really
us in the
weird
company
day.
I've gotten used to talking
So
to
we'll see
Peter
what happens
and
today.
Just hearing about the engine. There's Expedia, and Verbo's doing really well. But it turns out you're reading in like the 5th paragraph, and he goes, in the 4th quarter, we saw strong revenue and EBITDA performance, right? So far, so good. But we did see some softness in gross bookings.
And costs come down for their debt, a little bit more time for them to turn profitability. I mean, it's a kind of a lower quality trade, I guess, is one way to put it.
We still like high quality across the board, definitely. And when you think about fixed income, we're definitely in the high quality space. We do see that companies that are not as high quality have extended themselves on the debt side. And so I think what we definitely want to see is high quality for sure in fixed income.
Okay, so even when we shift down the market cap scale, we have to still try and retain the qualities of good
Quality and
financial
profitability.
characteristics.
Yeah, so even looking at small cap, looking to see that those companies are profitable.
So is it a stock-specific type of investment then, instead of just buying a big index, instead of just buying the pure Russell then? Are there funds or active management choices that have to go into that?
Yeah, I definitely think it is a stock pickers market right
Yep.
now.
26
not
4
an
more
index
minutes
market.
left.
I would say that across the board, across the capitalization structure, we're looking at specific names. We're looking at active management, not a passive management style.
Henry, one more thing for you that's on the calendar. Of course, the election coming in November. Chit-chat is already building. Twitter timeline's already getting kind of insufferable. How do we manage that as investors?
Well, I think investors need to keep their politics out of their portfolios because that doesn't tend to work that well.
Very good.
What I will say is election years tend to be good years for the market. We don't expect this year to be any different. So we do think that between now and the end of the year, we end higher in the markets. That's not going to be a straight line, but focus on the end game. So we would look at the end of the year versus now being higher.
Great stuff, Lorraine. Good conversation. A lot of good details in there. Appreciate the help.
Thanks so much.
Q pulled back.
Gilbert, CEO at Wealthwise Financial. Good start for our session here today. Small caps.
We got Bob at
maybe
70.78.
Big policy reversal. And that notion of interest rate cuts is kind of lingering with some tension in the market this morning as bonds do now seem to pick a direction. Yields pushing back higher after this morning's CPI revisions. We have a lot of earnings ahead of us, but that strong bounce in the Russell is starting to fade a tad here. As Kev mentioned at the top of our show, we need to watch the dollar today, and the greenback is trying to move higher here. So a little bit of risk has come out of the market. Even Bitcoin took a bit of a smack there in the last 30 minutes as a bond started selling off. So we'll be right back.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning fee.
let's get to Pepsi, topping earnings estimates, but revenue sliding for the first time in nearly 4 years, Jim, exactly like McDonald's the other day.
Well, I think that that Raymond LaGuardia, who's the excellent CEO, give you, by the way, a very nice dividend boost, did talk to me about the idea that maybe there are some people switching from work from home who are going to the office. They tend to buy a smaller bag, David, at the office than they do buy the big chip bag. Here I'm speaking, of course, of Frito-Lay. Quaker did have a one-time recall that I think also hurt them. They did take share. And where, if you look
Spies at the 200 on the 5-minute.
Hershey, okay, or Campbell's, they're doing much better. And I did the head-to-head on
Then
that.
we got
so, I know I'm being very forgiving.
Okay, here we go. Spy.
Well, we had an opportunity yesterday to ask both the CEOs of Kellanova and Hershey's about their response to GLP-1s.
12.
And, you know, they're saying they're monitoring it. They're modeling for it.
500 strike.
They're not really worried about it.
But Raymond's not even worried about it in the intermediate term. So
3 Black Crows.
I know this is a great company, great stock. I know that it's going to be down. I'm not
Order in.
But inflation's coming down for them. Wages, okay. Transport coming down. Raw materials, there's still some ag, oats, wheat, corn. But this is a good company. Supply chain will be better. That was 2019 in every single way. But this work from home has been a boon for them, and that is.
Let's get the opening bell here in the CNBC Real-Time Exchange. With a big board, it's Mexico discount retail.
Okay, here we go.
3B celebrating an IPO at the NASDAQ. Metagenome, a genetics medicine company, also celebrating an IPO.
Oh my God! Well, you know, Illumina reported. Of course, we know that Illumina is when you think about that Scott Gottlieb. Illumina doesn't. They buy a lot of equipment. As soon as you have a biotech that comes public, they write a check. And Illumina did not disappoint horribly this time. I'm used to them disappointing horribly, but the way to play all of these is to buy Danaher or buy TMO. Both of them, just you write a check to them as soon as you get the money in.
There's S&P 5K once again, Jim.
Oh, there you go.
A lot of discussion about what it's going to take the next couple weeks to maintain it. CPI Tuesday,
right,
and then NVIDIA earnings the week after.
You know, NVIDIA earnings, I urge people to recognize when NVIDIA reports, you have to look at where NVIDIA's multiple was. You look back, you see that, oh my God, NVIDIA was really selling at 16 times earnings. The fantastic, wonderful Colette Kress, the CFO, does a remarkable job on the call. Certain times you have CFOs who are so strong. David, Hugh Johnson handled the expense side of the Disney call. I thought he did a good job.
Well, I think they're quite happy with having Mr. Johnson in that role. Somebody who's, you know, well respected on Wall Street.
But we don't talk enough about dynamite CFOs who really do the narrative, and I should do something on that. Because there's just people who can tell a story so clear. And then Ashkenazi and Lilly. I mean, unbelievable. No hype. Really understands the numbers. Eli Lilly is going to get this Alzheimer's drug. It's going to be approved this first quarter. In order to get it, you have to use a GE Healthcare to get insurance. I believe you have to get a GE Healthcare contrast to see how your brain, how much plaque your brain has. You're not just going to get it.
CFOs are a big part of the United Airlines upgrade today over at Evercore. They say he comes from a equity background, might understand
I took
the
that on
correlation
5-minute.
between returns and valuation, and they say we're starting to hear that.
Well, it's about time. I mean, actually, the airlines, the one I want is like American, which, oh my God, these have not done well. Even though we sit here and talk about travel and leisure until Expedia dropped the bomb, that it's been just a boon. You travel, leisure, and expensive dinners and Taylor Swift. Now, Taylor Swift, Dan,
They get out at 110.
State of California's GDP, Taylor Swift. Where are we here?
Taylor Swift.
Taylor Swift?
Yeah.
Lisa, now, I mean, so
Don't just ride the
a
index,
driver
seek to
stops me and
outperform
goes, hey,
it
look,
with Fidelity
are they
Active
going to get married?
ETFs.
And I'm like thinking it was like some royal couple. Are they going to get married? I mean, this is the way our country is a strange country.
It is a strange country. Roger Goodell actually talked about the effect that Taylor Swift is expected
We are
to
not
have
obviously
on
impressed
the
today. We're
game
live in
Sunday. I think we have that sound. Take a listen.
over here in the back.
Having the Taylor Swift effect
is also a positive. Listen, they're both Travis and Taylor are wonderful young people. They seem very happy. She knows great entertainment, and I think that's why she loves NFL football. But I think it's great to have her a part of it. Obviously, it creates a buzz. It creates another group of young fans, particularly young women, that are interested in seeing, why is she going to this game? Why is she interested in this game? Besides Travis, she is a football fan, and I think that's great for us.
I'm going to go ahead and take it.
Heavily, DraftKings, heavily. Because I think you have a whole new group of people, and if you got to go to, I don't want to encourage gambling because there's people who spend too much money.
Yes.
But if you go to the site, Jason Ramos has a lot of the CEO. They do a lot of kind of really fun things to open the account about who's first to do this or first to do that. And I urge
There's
people,
115.
I don't want to say, hey, listen, go gamble, but it's fun. We gamble. My daughters and I gamble. And it's always like just a hoot. We do daily fantasy.
Well, there will be an enormous amount of money bet on this, on the outcome of this game, more than anything else, I would assume, and setting records. To your point, because a new cohort may also be entering, in terms of young women who are perhaps for the first time sort of more focused on the game than they have been in the past.
And will they be advertising? You talked about back. Will they have a lot of cop show and NSCI hospital dramas that they'll advertise? Because that's what's called is linear TV.
CBS will definitely be advertising the schedule for sure.
119, baby.
Bob Backus, the CEO of Paramount, in the next hour of Squawk on the Street.
Can you ask him if he feels left out by the now still sketchy bundle that we keep talking about?
Well, it's not sketchy, and of course that is a key question in terms of the fact that CBS Sports, and also we should point out NBC Sports, were not a part of it.
No.
My understanding in part about that bundle you're discussing, which we of course told people about later on Tuesday, is that the price would have just been even beyond most people's ability if you included everybody in that bundle, Jim. You would be paying as much as you pay for YouTube TV.
That's just great.
Quit talking about the Chiefs and Taylor Swift, please. I can't take it this morning. You understand, Jimmy?
Completely, that Apple may have made an offer along those lines.
SPY, bingo, off to the beach.
Who said, I want to own the All-NBA, and they said no.
He owns MLS.
Because if you're the NBA, you don't want to be owned. You don't want to be distributed by one provider. That is not the way to reach the broadest audience.
Do you really have that?
I tend to think it may very well be true, but
I've tried to yell out.
But I wouldn't. I'm not going to put it under the banner of a favor report.
Oh, okay. Then no, that's just like.
Would that be bigger than MLS? In your view?
You know what? That would verify that MLS is great, but I think that the Vision Pro, if you could be at courtside, say in David Zaslav's seats from Warner Bros. Discovery, if you could be in courtside, then everybody who's watching this show should just go this weekend and get fitted. Because I can't believe it. I was dodging soccer balls, Messi shooting soccer balls at me. I was dodging them left and right in the Vision Pro.
Listen, Apple is getting more aggressive.
SPX made it to 5,000.
MLS being a perfect example of that. They do like to own the entire thing globally. They want to own it all oftentimes. So I don't dismiss it as a possibility. But of course, what it really does make is the bigger point which you were making, which is the competition from Amazon and Apple, and even potentially Netflix. I mean, if you want to call the WWE sports instead of entertainment, is going to be significant. And so 8 years from now, when CBS's deal comes up for the NFL, I mean, are they, who's going to be in a position to compete with these guys then?
Oh, no.
It's certainly a question, but that's so far from now, Jim. I mean,
I know, but you have to be thinking about it. And by the way, Tim Cook, when I asked him directly, would he ever do one of these advertising tiers where if you pay, you don't have to watch the ads? He didn't dismiss that at all. So that does cut in favor of your exclusive about
my exclusive that listen. Again, that's not going to happen, so it's not really.
But I think that
the NBA renewal is important, and it will be a key question as to whether our parent company, NBC, steps up in a way, or does everybody sort of come back in some way across the board? Amazon, NBC, Warner Brothers Discovery, ESPN, but get less.
Right.
For paying the same price.
All right, so David, you have the bundle. You have the Comcast bundle, but you really only want the sports. Can you cancel your Comcast bundle and just get the sports package?
Well, no, you'd cancel your video you'd cancel your video, and you would use Comcast broadband,
Okay,
to
thank you.
deliver the sports package yet to be named and any of your already, what I would assume are your streaming services that you're already paying for.
Well, does Comcast stock act as if it's two tin cans connected by a string?
It does. We pointed it out. I can't listen. We had an analyst on yesterday said it maybe it is because of that sports bundle. I don't buy
Makes
that.
no sense at all.
I don't buy that. I think
Not at all.
it was a continued reaction, Comcast's stock price fall over the recent sessions, to the Charter numbers, which were not good, to the idea that ARPU is going to have a hard time going up overall because of competition from 5G, from fixed wireless, and the impact of this ACP program. Remember?
Yes.
The government subsidization of broadband that is going to expire in, I think it's like a month or so from now. So I think those combined pressures have contributed. You see a bit of a bounce today in both Charter and Comcast to the downdraft there. But not the impact. I don't agree with that analyst who was on with us
I agree,
yesterday.
but Carl, in our business news category, this has been the most talked about thing since the rise of Tesla. For my people who are asking about stocks, they really want to know the impact stocks, impact Paramount, which is why I'm glad he has bought Bacchus, because people just feel like this is indeed existential for Disney. Because we don't know what the package is going to look like. Now, I will say that Disney brought it up, and they obviously have something that can be justified, but I just want to know about Warner
What the
Brothers
fuck?
Discovery. Is that people want to buy a $10 stock? Is that the winner? And David, there's still balance sheet issues.
Well, they generate a lot of free cash flow.
Right, but I'm saying that's it. Can you get to John Malone?
They have a lot of debt. Yeah, I can.
Would you give him a jingle during the...
Sure, I'll be happy to jingle them.
Well, but then this is a very important story. There's a lot of people who feel like this is the coiled spring if things go right.
Linear cable networks is an issue, and even in the Disney quarter, linear cable networks were declining at a rate that is pretty scary, and by the way, is only going to be exacerbated by the presence of this sports bundle if and when come the fall it's available.
Well, wait till you see Firefighter NCI, and you're going to know what people are watching.
How about we get to some more earnings? Affirm, you guys, any thoughts on Affirm?
So Max Levchin, whom I just love because he is so in your face with his curt answers if you ask stupid questions on his conference call, he delivered a good quarter, and the number of bad loans is so low, and this stock was hit by shorts instantly, like heat-seeking missiles. When it reported, they knocked it down 8. If they had listened, they would have realized that Max delivered a great quarter. And he's not defensive at all. He had really good numbers. This is a product that people really like, and a CEO that has a lot of gravitas. And people should just recognize that. What are you doing betting against this guy? I know it's up. We can say there's a big squeeze, but Levchin he's sui generis. There's not a lot of CEOs like him, and I enjoy his style. He's kind of Musk-like in terms of basically challenging about whether you really understand the company. But I do, and I like what I heard.
They do boost the full year guide on GMV and operating margin. The fiscal third quarter is roughly in line, Jim. Actually, the list of companies that did guide below includes Pins, Expedia, Newell, and Take-Two as well. We're going to talk to Strauss this morning.
Take-Two is a timing issue, and I think people should recognize that might be an opportunity. And I would go back and say, you want something that didn't? Look at Cloudflare, symbol net, with Matthew Prince, who has really turned that company into a cybersecurity giant. NET, and I've got him tonight, and when the stock was at 50, he came on and said, look, people are misunderstanding the kind of thing that I'm working
SPX,
on.
watch
And
it.
He was right, and this is another one
Read
of
a
those
double
companies
top.
in the cyberspace that is just flying. And Matthew is the real deal, and he has some very big contracts. Commerce Department gave him a big contract. That's Gina Raimondo. She knows probably the most, I think, about business in that whole administration.
Yes, and is very involved, of course, in the CHIPS Act.
Yes.
We talked briefly about Sam Altman's ambitions to raise, what was the number in the journal? $7 trillion?
He likes big numbers.
Because we're not going to have enough chips or enough electricity to power the chips we need to get to overall artificial general intelligence.
And
he seems so hell-bent on making sure the machines become smarter than us as soon as possible.
Okay, so I went to your talk.
Slow down, man.
And And that was all it was about. And I turned to my wife, I said, if David Faber were here, we would all just say, pass the hemlock. It was really an extraordinary moment where he basically just said, he didn't mention you specifically, that we're just atavistic. We're like, you know what? We're useless eaters.
50-20.
I had an opportunity to spend time with Mr. Altman, but I feel like he warns on one side.
Right.
And then on the other, he's like full speed ahead as fast as we can to get to that world that I keep warning about.
50-20.
Have certain concerns about.
No, he was the closest I've heard yet to saying
Lotto.
we're basically soil and green.
In the put side,
Can you do it?
Edward G.
here, let's do this.
Which one do you want? Do you want Charlton Heston?
No, I want
saying
Strangle
it's
out.
people.
You gotta
Straddle.
commit on that one.
I can't commit. I gotta hear Heston
Strangle.
first
Yes.
before I can really
David, by the way,
recreate.
what was To Serve Man?
Straddle.
What was To Serve Man?
It's a cookbook.
It's so good. Rod Serling, how brilliant.
One of the
How
best.
brilliant.
Jim, Bitcoin's getting some attention. Just a couple grand from the January highs.
You know, I had a good call that went down, and they said, listen, at 40, maybe a buy, but this thing is on fire. Tesla and Bitcoin trade together. There's a lot of hope there.
A lot of hope on Tesla or Bitcoin?
I think Tesla, too. I think Tesla's trying to make a quiet comeback. And I wouldn't put it past Musk to have something.
Tesla, yay.
I'm waiting for the Texas move, David. That's going to happen.
You know, it's funny. Did you? I didn't have it.
Come
I
back.
should have read it immediately and didn't read Chancellor McCormick's decision
The
until the
200-page
last few
decision,
days.
you've got to read it because it is a hoot.
And she writes really well.
Yeah, she did a lot of analogies. She really is a
And
very,
there were
very good
some
writer.
interesting references to this process was on self-driving mode.
Yes.
Yeah, we would have had it earlier had it not been for the back surgery. That's why it took so long.
Well, it's a wonderful opinion over and over again. It talks about how it's not doesn't matter how much money he made for people. What matters is process.
Thank you, Jim. That's exactly. Her issue was with the process and with what she felt like was a fully conflicted board in so many ways, and not necessarily with the end result. Which, of course, we've sat here and said, what was the issue? Why, in fact,
We're
would
still
there
at
be
the
an issue
VWAP with a SPY.
If you take a company from a 60 billion market cap.
Once
to
we break the
650
SPY,
billion,
we become bullish, but
you know, yes, you should be significantly rewarded.
Well, how about the?
I'm going to squeeze here shortly. Something's going to happen.
But of course, Musk is like, I'm out of here, and but we've yet to hear the follow-up.
There's another aspect.
Would you stop the jitter jatter?
He basically created targets if would get stock, and if the stock did certain things, and if the numbers are certain things, and apparently he had the first two targets in the bag. Will you give me a break? I mean, this was a gutsy thing to predict.
500 strike on SPY.
In hindsight, it looks like he had the whole thing in the bag. We saw a rally that was unprecedented. But I thought that was very bad.
She also says at the time he owned 21.9%. Of course, he was incented regardless to get the stock price up because he was benefiting to the tune of over, you know, a 22% ownership already. So why?
But she has this comment about, well, why did he need to make more money? He made so much money, and that's not the way you look at things. You know,
Although, Jim, you know, Jonas had a good note the other day. Can EV sentiment bottom?
Amazon.
in 2024? Because suppliers are cutting backlogs. Hertz is cutting fleets.
We got Nvidia
we've seen
up
adoption curve move down. Do you
1.5%.
think that happens?
I think that the when Toyota's cutting back.
Tesla 193.56. Resistance. Who's got a resistance? I do. Does anybody want to know what my resistance is on Tesla? It's 195.57.
Fascinating.
195.57. $195.57. What the hell's wrong with that guy? Okay. Where's my SPX? I'll be looking at the calls. Take down. Delete. The 5020 SPX. Just right close to the, if this thing drops, this could hurt me. If not, it could help. And the next one would be at 5015. And it's priced at 480 right now. I don't know. Jimmy, don't trust. Jimmy's going to go get some coffee and he'll be right back.
Big, but I just think he's cranky because he's got a birthday coming up.
In 24 hours, I believe.
I just think, you know, you get to a certain age and you get a little cranky. maybe it's nap time.
Time for your meds, Mr. Kramer. Check bonds today. We're going to get CPI on Tuesday. Not pretty light day today. We'll go over the calendar for the coming week when we come back.
We'll wait for double bottom. Should have got it in there. Wonder what that put's going for now. 5,000. Yeah, up $100. So the SPY's out of support. Use them tweezer bottom right there. And the other tweezer's right there at 498.62. Okay, get ready. $50.15 strike. You got a hammer.
BC.
Watch Pinterest today, down about 11%.
400 to
That's gonna take
450.
it back almost to the lows of the year. the first week of
You
January.
got a hammer right
That
here
revenue miss
coming
and
out of the
guidance
two
haunting
crows.
The stock, although EBITDA was a beat, as was MAU, best user growth ever, as Bill Reddy said. Dow down about 80, but we're holding 5K. Back in a moment.
Bam. Profit. Profit, profit, profit. You get an engulfing candle like that. Now, for sure. See the hammer?
And a strategy that stays ahead of that date, doesn't contend, but looks for a run-up into the earnings announcement. February 23rd cycle, buying a call vertical. One strike's in the money, one strike is out of the money, pretty standard for that setup. Buy the 57, sell the 61, $2 debit would be half the width of the strikes. 59 would be the break even, pretty close to the current share price, at least it was at the time that I looked at this about 10 minutes after the open. Risk would be 200, max reward would be 200. 1-to-1 ratio there, you're risking the same as you can make. That's oftentimes what I use as a loose guideline for this strategy, which I consider somewhat of a coin flip in the sense that the stock can go up and go down. And so if you pick right, you can be profitable. If you pick wrong, you're likely going to be in a loss scenario, equal scenario there. So risk the same as you're able to make with a break even pretty close to the current share price.
All right, I like it. Bullish, but with some degree of caution, but a little bit of a hedge using the spread. So, all right, sounds very positive on it, Gerald. Pepsi after the sell-off, how does that change the way you can use options?
Yeah, I think that it depends on what your time horizon looks like, what kind of feeling you have. Your guess, though, was a little bit more, I would say, positive on Pepsi, but of course with a move like this, you got to be cautious. And so I looked at a risk-defined, neutral to bullish strategy, kind of buying into weakness here, but doing so by selling a put vertical below the market, so it does give it a little bit of cushion. Now, at the time, the stock was trading closer to about 169, 168 and a half or so, and so it was closer to $1 credit. That would be the minimum that I would look for this type of a spread. It's a 4-to-1 risk-reward ratio then, with a break even below the share price. I would probably be interested before changing strikes up to $1.50 before I would consider different strategy or different strikes depending on what's available. I think it's closer to about $1.25 now as the stock is sold off. With the $1 credit, though, as we have on the screen, 4-to-1 risk reward, you're risking 400 to make 100. The higher the credit, the better. is, of course, it changes that ratio more favorably and lowers your break even and increases your probability of success in that sense that your break even would be lower, but the stock's probably lower is why.
Okay.
March 15th expiration though, so it does have a little bit of time. We just had the earnings announcement, so there's no earnings to worry about for a little bit of time. On this one, 164 would be the break even, so a little bit below where we're trading now. The idea being the stock's under pressure
March
right now.
what?
It might take a little while for the market to kind of figure out where it's going to be priced at now. You're allowing some lead here by selling below the market, and maybe it comes down and tests that level, but you're just hoping that it stays above 165.
Okay, so optimistic in the sense that maybe the downside will be limited, certainly not as bullish a trade as what we saw for Celsius. I think that makes sense with the charts. Good approach. All right, so on the downside, Pepsi, buying the upside in Celsius. Thanks, Alex. When we come back, we're going to talk about an upgrade in United Airlines. We're going to trade the stock as it's been a pretty good week for airlines. Hour 2 up next.
SPX, baby.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms.
They said we couldn't
Unlock
do it.
support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education.
Golly.
Just for traders. Also, you can trade brilliantly.
Shut up. Just talk when you're only spoken to. Now that's an inverted hammer. What happened here at... What just happened on the clock? Tesla hit Bug's number. Hillary, Tilray. Jimmy. Time for some more coffee.
Or the same.
The drumbeat continues, even a little louder, if anything, this week.
Gold under a little bit of pressure this morning. Crude oil up to 77. Let's talk about that.
Yeah, because gold's been pretty comfortable at this 2040 level, but it's crude that's really attracting contention this week. It's up about $6 from what we saw in the beginning of the week, down around 71. Now,
good comeback week for crude.
It is, and there's a couple fundamental factors behind that. We heard from the IEA. We had, strong numbers here in the U.S. If you remember, to begin the week, PMI, ISM numbers as well.
Yeah.
We've seen the dollar back off a little bit, come back down below 104. So there's a couple factors at play there, in addition to some interesting stories tied to some of the relationships between RBOB, crude, heating oil as well. But I do want to point to, again, similar situation in terms of rates. Look at this, very much contained. This, you could lay a dollar chart up here and you'd see a similar pattern, right? The ranges that we have established, upper and lower extremes, are well defined here, and everything within this is very random, and I would argue anything within those extremes is very supportive of what we're seeing in terms of stocks. Getting back to, again, as I mentioned here with the indices, 2 steps forward, 1 step back, Oliver. This is what the bulls are looking for.
What's interesting about the crude chart is how similar it looks to the dollar in yields again this year, whereas crude bottomed out basically when we went to 2024. The calendar turnover from 23 to 24 is where the bottom is for crude, for interest rates, and for the dollar. So all of those kind of suggesting that the end of last year's hyper dovish optimism is starting to come out of the market.
And remember, earlier in the week, we looked at beans and corn, right? And that was the high for those two products. So since the fall of last year, those products have been coming off.
Right.
So again, all of this sort of feeds into what we're seeing. Inflation, not necessarily at the levels where the Fed wants to see it at this point, and that's what the Fed speakers told us this week, but still getting progress.
Yeah, for sure. All right. Crude, kind of the outlier, actually looking pretty firm in commodities with a nice bounce back this week. Thanks, Ben, for the look at the intraday action here. All right, Russell up about 0.5%, so watching that as the potential leader for the day. Let's keep talking some notes and earnings. Kevin Green with a look at an upgrade on United Airlines. Been a solid week for the airlines, KG. What's this analyst saying?
Yeah, nice little bounce back here. We have Evercore ISI actually upgrading United Airlines to an outperform from in line here. And they actually increased their price target to $65, and that's up from $58 here. Now, that would be actually a dramatic move to the upside here, Oliver, hitting some of the 52-week highs that we haven't seen here in a couple of months. But they are really citing the fact that they believe the financial situation for the company, especially when it comes to capital allocation, will be adjusted here fairly soon, especially as their financial leadership has changed in-house. So this could actually be a benefit for them in the long term. We know that they actually did increase their debt load after the pandemic from $53 billion up to about $56 billion. But their performance when it comes to international flights has been able to really offset some of the concerns when it comes to debt. So they are very optimistic around the trends when it comes to travel, as well as the trend that we might see when it comes to capital allocation here in the near term, which could provide them a little bit of a floor and then outperform their peers.
Okay. United has got some 737 MAXs in that fleet, but they got a lot of other planes too, so I guess it's not a massive hindrance to them right now.
No, and actually this could be a little bit of a benefit for them because of the headwinds that we are seeing with Boeing. United actually came out with some commentary that makes it seem like they might be looking for other options. Now, that would be a very difficult thing to do in the long term. That wouldn't happen this year, but they might be able to adjust maybe some of the contracts for the future deliveries that they're supposed to have from Boeing, maybe adjusting some of those contracts or maybe having some incentives for those contracts that could help them here in the long run. I think that's really the angle that they're trying to take, and Evercore ISI also kind of notes that high level that this could be an intermediate benefit for them, and they also don't have to have the capital outlay. So if they're not going to receive these the planes on time, they could potentially use that capital for some other items here in the near term in order to try to optimize their business and really worry about the deliveries on the back end.
I think it's interesting this analyst isn't even waiting for them to get close to their existing price target, pushing it up even further.
Had a nice little bounce.
$58. We're at 42. I mean, they must really see a lot of pent-up bullishness in the cards here, because to jack the price target up to one-year highs, 65 would be the highest since 2021 for United. I mean, this is a super bullish call.
Yeah, we have a lot of analysts that are very bullish when it comes to the trends within this marketplace here, especially when you're looking at international. So international has a lot better margins than when you're looking at domestic flights. And for United, they actually increased their capacity by about 14.7% on a year-over-year basis. So if they continue that trajectory and the travel continues to increase, they will be able to capitalize on that. I also think that when you're looking at the premium business, if you're looking at business travel, we have seen that obviously increase since the pandemic, and if those trends do continue as well, that could be a boon for them. So confidence around the consumer still remains. That's kind of the justification for a lot of these price targets when you're looking at airline companies. I think the icing on the cake for Evercore ISI is that their balance sheet mix can also improve their leverage when it comes to this marketplace in the near term, which is why they're a little bit more aggressive when it comes to their price target.
Okay. Yeah, very aggressive. All right. Pretty bullish stuff. Only airline really up today. Not many of them higher. I can see the case for pent up, optimism in this group, though. Think about how all the cruise lines have done so well. Recovered almost, the leader in that group, RCL, almost completely recovered its COVID losses. So you think that in the similar category of travel that the airlines would be able to get back there. They've just been kind of plagued by a lot of margin crunching stuff. So they can iron that out. Seems like United has presented itself as a leader of the group. It's kind of becoming like a JP Morgan, of the airlines in a way, where that stock is like, led the entire financial group and left a lot behind. It seems like UAL has pretty well supported fundamentals as the leader of the pack. What do you think?
Their debt load, I would say, is a little bit higher than maybe some of their competitors that have the same type of revenue mix. But once again, they kind of have the premium tier consumer that really is offsetting that. And when you're looking at the international travel, I always kind of go back to that, Oliver, because that is something that has been very depressed over the last couple of years. And it took some time to come back, and now we're seeing it roar back. And it's around 38% of their total revenue mix. So even if we see a drawdown here from domestic travel, once again, those international flights have better margins. And if it's basically 40% of your revenue mix, that could offset some of these near-term issues. And then also jet fuel is coming down as well. So the expectations that we saw in the last quarter when it comes to jet fuel costs was actually, the actual number was actually below the expectations. If we continue to see that move to the downside here, that'll also help them when it comes to expense management.
All right. Like it. Okay. So the business international traveler, big per UAL. Thanks, Kevin Green, for the look at the analyst note. Super bullish. Dan Deming's with us to do some trading. He's a managing partner at KKM Financial. Dan, it seems like you're positive on the airlines, but not ready to quite buy upside in them.
Yeah, Oliver, I think, the initial reaction to the upgrade, it took it up to $43. Now we're trading closer to 42 and really at the, the top end of the short-term range. But when you look at the general trends over the last couple of months, I wouldn't say it's too compelling from a technical standpoint. Now, maybe fundamentally moving forward, there's some possibilities for them to shift and capture, upside as far as some of the trends in place. But I'm not so sure that that's going to happen in the short term. I still think that this stock is going to kind of wander around this mid upper 30s to maybe the mid 45 level or the mid 40 level, so 45ish.
Pumping it.
So yeah, that's what I'm looking at today. And today's trade example is just to basically capture some premium with the opportunity, maybe
SMCI
lower to get put in the stock at a better level, a level.
We're gonna know if it's going to squeeze or reverse right here.
As I just think that overall, that the potential explosiveness in this market is still probably maybe a few months off, if maybe even longer than that. Now, as you and Kevin pointed out, last July we did see a trade up to just over 58 before this big trough lower
next week
into the end of the year.
Oh,
and now it's trying to find some stability. But I still don't think from a technical standpoint, and also I think just from just a cyclical standpoint, that there's still some chop here in the market.
Wow.
All right. Definitely a lot of chop in this group. Never seems to go away. But I guess that keeps interesting trading opportunities because there's no short of
too much for my blood.
So you'd just rather collect premium
650
sell,
put
downside as opposed to trying to make a big bet on the direction.
Yeah, at this point, I think that just looking at the general trends within the industry and just the price action as well. I mean, maybe the fundamentals are shifting and there will be a dynamic where they'll be able to capture
650
significant
put
upside
or an
similar
850
to the run
call.
they had in the first half of last year. But at the same time, I think that the idea here is, you capture basically over the next, let's say, month. It's the March expiry that I'm looking at for the trade example. Selling the 41 put, buying the 36 put, basically just to kind of cap the downside so you don't have to put out as much cash. But the idea here is to collect 2% versus the stock over the next 30 plus days, I think, in the expiration, maybe closer to 40. But either way, the March expiration, and just see how it plays out. And if we see this market drift lower and we see it push back down towards those recent lows right around 38, that this trade would put you in the stock around 39.15 with the where the stock was trading at 42.5, maybe a little bit better now, down by around 42. And again, 2% collection here, and with the opportunity to get long at a better level, and just kind of see how this thing chops around here. And if it rips, you still get your 2%, and then you can make a decision maybe if you want to jump on the trend. I just don't see a defined trend here at the moment, Oliver.
Yeah, I mean, either it's pretty stuck, right?
Boom.
240 and 44 since December.
50-15.
So it seems like the break even makes sense here. You're basically taking the bottom of that range. Only time we tested or flirted with that was right before earnings, but earnings seem to kind of hold it at that 40, so there should be some good backing behind that level.
Yeah, it seems like it. If you look at just, the November lows are certainly below that, but, all the stocks, that was the market in general. And if you look at the recent lows, the January dip, down around 38, that's
Nice
kind of
bounce.
what the target is here. I just, going out just, it's a shorter term options, position as well. So I think that, 39 is, within the shouting distance of those recent lows. And again, if we were to drift down there, I think that that's a better level than 42 to 42.5, given the price action that we're seeing in the stock.
Okay. Like the trade. Good approach.
All right, thanks,
Bet on the
Oliver.
range. Thanks, Stan Deming, managing partner, KKM Financial, with the trade on UAL. When we come back, we're going to shift over to software. We're going to go to Canada and talk data and information storage in the cloud and management with the CFO of Open Text. Got a little bit choppy on the earnings, but still holding on near one-year highs and up about 20% in the last 52 weeks. Be right back.
Breakout on SMCI right there. Double top, boom. TQQQ's a double top in here. Pre-market high. I'm gonna go get me some more coffee. Oh. There's that guy again. God darn, look at AMD. Be right back. AMD almost make you want to buy a put here. We could go higher, but you can pull back and hit the 200 also. That's a couple buck drop, couple bucks. PX, what are you doing? Next week, 170 put.
The first thing that jumps out when anybody looks at your guys' financials over the last couple of years is the huge liftoff in revenue growth. Start there in terms of your trajectory. I know some of that came from a big acquisition you guys did.
Yeah, absolutely. So then again, we completed our first full year anniversary of a very transformative acquisition, Micro Focus, in the quarter. And our fiscal 26 aspiration from a revenue perspective, as you rightly pointed out, is 5.7 to 5.9 billion. And we really had a record second quarter. December is our second fiscal quarter. We actually delivered record revenues of 1.53 billion. Our enterprise cloud bookings, which is a very important metric for us, 236 million or 63% year-over-year growth. Strong EBITDA and strong free cash flows of 305 million. As I mentioned, we completed 1 year of closing Micro Focus. And look, this is unprecedented in the technology industry, turning a shrinking business into a growing and innovative business. And we also increased our annual outlook for cloud bookings from a previous 15% to 25 to 30% for our fiscal year.
Where are those bookings coming from at this point? Where is there juice left to be squeezed in the market?
Yes, there's a lot of juice left to be squeezed. Again, AI is a once-in-a-generation opportunity, but for us, the record cloud bookings in the quarter coming from two key areas. Our customers are consolidating and preparing for AI, and that is correct. They're consolidating and preparing for AI, which means higher cloud bookings for us. And we had clear AI wins in the quarter, right? We've gone from a vision to reality, products, roadmap, pricing, and clear customer wins. Carl Zeiss, Philips Healthcare, BMW, FedEx Express, all were wins in the quarter. I'd also add to you volume wins we had. We closed 48 cloud deals in Q2, over $1 million contract value, over 23 deals, same quarter last year. So clear and very impressive progress for us.
In terms of data management, I imagine there's somewhat near an endless supply of demand. In terms of like the marginal change in that demand due to AI, walk me through the specifics of that. Like when I think about the products right now, you've got some Chat GPT based search products. We hear about more products coming, but in terms of the scope and the scale, like what's that transition from the LLM developments to what you're providing from an information management perspective?
Absolutely, absolutely. And Oliver, think of us as business AI. AI will be a very essential part of our competitive advantage, and we plan to embed AI in all of our products. And what does that really mean? Our differentiators are, we manage, activate very large data sets. We believe in integrating automation and AI. We have been in the business of automation, and now it's easier for us to bring AI together. Again, as you can appreciate, data privacy, security, trust are all very integral. We focus on AI assist and personas in the wide variety of industry sectors and verticals we have. And of course, being cost reasonable is actually very important. Our AI products are called Aviators. 23.4, which is calendar 23 fourth quarter, 24.1 are all delivered, and soon 24.2, where we will be embedding AI in all of our products. Two other data points. We have 800 engineers in AI, and we're delivering new capabilities every 90 days. And we have built a powerhouse services organization where we're absolutely ready to engage with our customers for their AI transformation. Again, the point is our customers are consolidating and preparing for AI and engaging in real AI projects.
So do they need more support with AI developments? Like, I thought AI was supposed to make things more efficient. Why do they need more support from an outside party if they're going to be, they can program stuff on their own now? Or where is that coming from?
Right. The point I'd make is business AI is a lot more complex than consumer AI, right? When we talk about ChatGPT and ChatGPT 4. So what OpenText has built its expertise over the years is dealing with large enterprises. One system or application.
There's AMD pulled back. Jimmy planned.
Integration. Any of our customers thinking about AI is thinking about it in a very integrated way within their enterprise. And yes, there is a certain amount of support or services needed.
So we had an inverted hammer,
making the
a falling star,
more efficient, and of course, to your point, productivity will come after that.
Where do you see in your customers big changes happening?
OTEX.
New product that they're putting out, or something that needs more of support from information management? Are there specific examples at this point where a customer said, look, we've got this new product we're building, we need a lot of help managing all the information that's coming through?
Yeah, it's actually wide variety. We're working with a major apparel company to apply AI to their invoices. We're also working with a major bank to detect fraud, a major manufacturer for contract compliance, and a food company to consolidate like literally billions of supply chain transactions and documents to create the next generation of sustainable foods. So it's a wide variety of application, and it really depends on the priority of the respective enterprises. But there are two common areas, or maybe three common areas. One is, of course, growth, augmenting growth, and two is cost and productivity. And the third, let's not forget, it's compliance. So we see our customers applying across, and these areas will, of course, evolve and change. And the most important point is we're ready for it at OpenText.
Okay. And so these are projects that they wouldn't have been able to complete on the scale that they are now with AI support. Is that kind of where the marginal increase in demand for your services is coming from, where they go, okay, we actually need more of what you've got because now we're going to be able to get even more data than we thought we had?
Right, absolutely. So OpenText, in our 30+ year history, we do business with large and medium enterprises. So we have established relationship with these customers where we have been selling our products and software, right? So coming to OpenText, where we already have a product roadmap and support, is a logical place for our customers to come to us. So I would say that the impact is not going to be marginal. I think the impact is a very long runway. And as I mentioned, we're going to be continuing to release products every 90 days. And the data for the customers is already there. And today with AI and our cloud offerings, it's a very interesting and a long-run opportunity to monetize the data in a variety, as I suggested earlier.
Will this be a force able to drive revenue growth at the same pace as the Micro Focus integration, which cinch up to like 50, 60, 70% year over year. Is that sustainable though, or is that skewed from the M&A?
Yeah, no, thank you for that. Yes, it's absolutely, Micro Focus had a contribution to make, but keep in mind that capital allocation through M&A and doing accretive M&A is very core to our business strategy, right? So yes, when we do transformative acquisitions, you will see those very high growth, but our focus is organic growth. As we do M&A in the future, we will focus on cloud and ARR businesses that absolutely have organic growth characteristics. Now, coming back to AI, I can tell you that AI is in every sales customer RFP today, and that is very positive for OpenText. And given our differentiated position, as I said, we are winning business, we're expanding our growth rate for the year. And I'll also tell you, this is going to help internally and externally. We've kicked off an internal initiative to enable our engineers to go even faster with business AI. We call it Project Athena, which is really an internal platform where our engineers can create software on our platform. It's going to accelerate our innovations and again, help the customers. So just bringing it all together, these are very, very exciting times for us.
Okay, thanks for the specifics. Helpful to understand how
She
the
likes.
web connects. Appreciate it, Manu.
Yeah, and thank you again.
Thank you. Manu Ranganathan is the CFO at OpenText, OTEX, the ticker. Waterloo Canada based. Coming up, Chartmasters got some analyst notes we're going to get into, from chocolate to more software and more software.
Knock, knock.
Who's
Number
there?
one broker here for the number one hitmaker.
Thanks for swinging by.
Washboardjim with Retail Traders. May I help you?
It's my money and I need it now!
It's my money and I need it now! It's my money and I need it now!
It's your money. Use it when you need it.
It's my money and I need it now. That's PX.
Are moving. Maybe not the best trading signal in and of itself, but it's still an important sign that trend is improving here, and it's a visual clue that things are shifting more toward the upside. Volume profile, the area of heaviest trading was down here near 192, so a lot of activity at these lower levels, kind of bottoming out here. Actually, to me, it kind of looks like a bit of a cup and handle type pattern here developing. So what you would expect with the cup and handle would be a push back up to the resistance point, in this case 214, where we had lows and highs there, and then a brief period of falling prices, then and a surge upward here. RSI between two trend lines, more leaning toward the bullish side, so the price action seems geared toward the bulls today.
All right. Yeah, it looks like it's picking up some momentum. I mean, cocoa prices going through the roof certainly is going to help them for every sale that they make. They're going to, if they move prices up, So it seems like they're going to have to. Okay, market okay with the earnings, down 2%. Analyst says to keep buying it. Let's talk some software. Let's talk Monday on Friday here, Jenny. Price target hike. We're going to look at Datadog too.
Monday, fittingly so, though, also has earnings on Monday before the market opens. So we have that to look forward to. Mechanical today raising its price target to 250 from 200. Keeping a buy rating on the shares, saying they like the companies. They believe they're still in the early stages of this multi-product story that's maturing overall at the company, which in combination with its price gives them confidence on their average revenue per user and a $50,000 plus customer. So this company, though, is Israel based, so it does have offices here in the US, but this is a company that's based in Tel Aviv. So have to imagine seeing some geopolitical uncertainty weighing on a company that is based in, or sort of the hotspot of a lot of this uncertainty lies. However, as far as like price, we haven't seen that reflected in shares at all, which has been somewhat amazing as we head into their quarterly numbers.
Really is, yeah, totally resilient, amazingly so. $250. They were at 200, so they think there's more coming. We're at 235 right now, another $15 with earnings ahead of us. Market looks like it's very confident in this stock, right?
Pretty strong move up since last earnings right here. And we can see that the kind of pattern that formed here is interesting. It's something that shows up in a lot of products where there's a strong move upward. Vertical move up, sideways consolidation, vertical move up, sideways consolidation, with a notable drop off here that hit the 63-day EMA and then bounced sharply here. Vertical move up, sideways consolidation, vertical move up. So when we have this type of situation, you might be wondering, where is the next consolidation phase going to come? Where might this move upward start to slow down? Well, RSI is bullish. It is in the overbought area. The momentum is on our side here right now, heading into earnings here. If earnings does do what the bulls want it to do, we might be in for some upside action here. Perhaps the +3 standard deviation channel coming in near about 260 here. Blue line, linear regression line, standard deviations to the upside can project resistance. But we also touched at our +2 channel today. This could be a resistance mark. Perhaps we might see a bit of a slowdown near this level, near 235.75. To the downside, the old highs near 219. Then our +1 channel and our 21-day EMA come together near like 210, 211.
All right, a lot of good support in the chart. Big, fast breakout here. Should be fun earnings. I mean, up 3.7% on Friday ahead of Monday earnings. Okay, Datadog. What's up with this, Jenny?
Datadog, okay, so this name is I would say in like the cybersecurity world, it has been on a pretty decent run, and we are getting a nice lift today. It's up 3.6%, but I mean, it just hasn't seen the same overall enthusiasm to say some of its cybersecurity peers, which is kind of interesting to me. Bear today, though, with nothing but positivity, raising its price target to 120 from 103. However, this is below where we're currently trading, so it's like the fall asleep at the wheel here. They do have a neutral rating on shares, but they previewed Datadog's fourth quarter results, where they expect solid upside prior to its fourth quarter guidance, although they think the bigger focus will be on overall its initial guide for just the rest of this fiscal year, given the recent results at some of its hyperscalers. So again,
Damn.
I would just say its price
Another good
is
run.
only up about 1.4%. It's kind of a surprise to me, and it's also surprising
Only?
we haven't seen as much of a breakout as we have. But frankly, this
Honey.
price target to me today, like for as optimistic as the note was, doesn't really imply that. I mean, it's still below where we're currently trading, and well off actually where we're currently trading right now. So interesting report, notes out of Bayer. That report though is Tuesday before the market opens.
Okay, so it's going to be busy for software going forward. It's got a lot of built-in hype already. I mean, these stocks are all up big off the lows. Even the ones that are kind of underperforming to some degree have like doubled in the last year, Rick. So, I mean, the chart looks like it still has some good momentum.
This one is more than doubled off the yearly lows, plus 118% or so. Big gap up on our last earnings once again here. Pretty much just cruising upward in an upward channel type shape here. And we can see that we had another nice gap up today. One question mark though, of a little tiny bit of bearish divergence on the RSI, not quite taking out our previous high during our last high close. You know, I mean, we've still got a lot of time left in this trading day. It's only the morning here. So a push above that point would be what the bulls would want to see. Make another move above resistance into those highs as well. If we were to keep moving up, +1 channel, pretty close here, comes in near about 140 to the downside gap, and then the 21-day EMA near like 127, 128.
Okay, so if we break out from here, then we are really ripping in Datadog because we're already a standard deviation off the mean on this general trend. So I mean, software companies seem like they are the next playground for bulls trying to get ahead of the AI stuff. No secret that these stocks are up big. All right, nice. Going to be fun next week with earnings for these companies. Thanks, Rick and Jenny. When we come back, got a little market meetup to talk about the session so far. We've also got some more earnings action for you, as a big crash in Children's Place will be our developing story. Wow, got halved overnight.
I'm going to have lunch. And then get back at it. SPY's been bullish, straight up. We're getting ready to squeeze, I think. Called the breakout on the 1, 2, 3 on the VWAP. Now we might be getting a little bit top heavy. That 500's everything. You got your 500. SPX, $6. The 50-15. $6.20 now. Jimmy likes.
The available wagers, a new record is expected to be set with bettors planning to wager an estimated $23 billion. Our Contessa Brewer joins us now with a very special guest. Hey, Contessa.
Hey there, Carl. Not all of that $23 billion is expected through the sports books, but an awful lot is, and an increasing number from last year. With me now is the CEO of BetMGM, Adam Greenblatt.
640.
By the way, we're both New Yorkers. We live blocks away from each other, but we meet up here in Las Vegas. When we look at Super Bowl, it's an exciting time to be here, and I want to get to it. But first, there's news this morning about BetMGM's new partnership with X. Tell me about it.
There is. So we're very excited about the news this morning. So we've announced that BetMGM is going to be the exclusive live sports betting, live sports provider, so provider of live odds to X, formerly Twitter.
Are you concerned at all about your brand being linked to X and the increasing amount of controversy or accusations about misinformation that are aimed at the platform?
It's a really important question. Our priority is ensuring that our brand is where our players are. And so we're following that lead. Our players and the conversation around live sports lives on Twitter. And as a result, that's where we are going to insert our brand.
How much of what you're doing with X feeds into a broader strategy around reaching people who might not know the BetMGM brand? I mean, for instance, you're buying your first Super Bowl ad this year. Is this a part of a larger strategy?
Well, absolutely. 2024 is an investment year for BetMGM. You will see more of us more often. We are going to elevate the brand, invest in the brand. So this work that we're going to be doing with X is consistent with that. We've also announced last year our partnership with Marriott, where they have a database of, as part of the Envoy program, 186 million people. That
Missouri's not on here.
BetMGM to reach the biggest possible audience in 24.
Well,
and you had BetMGM and the MGM rewards system as well. Why hasn't that done more for you on market share? I mean, you have bricks and mortar rewards for your players, where DraftKings and FanDuel are at you would think, a rewards disadvantage, and yet BetMGM is losing market share, not only in sports betting, but in iGaming too, where you were the national leader.
God, honey.
In 2023, we made some commitments to the street. And that the primary commitment was we were going to show EBITDA profitability, and we did that. We did that for from the second quarter consistently. Now, with that kind of investment approach, there come trade-offs because of what some of our competitors.
Okay, we got a flag here on SPX.
Yes.
Yeah.
What we've shown is that. Excuse me. Go.
Well, I did ask
Call
MGM
620.
CEO Bill Hornbuckle this very question about. Look, if you're profitable, then does market share matter? And here's what he told me. Let me play it.
Market share does matter. The difference between 21 and 18, okay, it's relevant positioning. But what matters is ultimately when you go for profit, that you have a big enough piece of the pie to do exactly that. So between sports and obviously iGaming. We've told the street come 2026, we'd be at about $500 million in cash flow. We want to grow our share back. We want to particularly grow it back in iGaming, where we think MGM's brands resonate.
Bingo.
Okay, so how do you do that? How do you get back to #1 in iGaming and maybe third, or make even more increasing inroads in sports betting?
Well, 2024 was about three things. It's investment in best product. We're working really hard, have an exciting roadmap of new things in the area of both sports and iGaming. We're integrating a business called Angstrom, which is a specialist sports pricing business that will allow us, frankly, to offer every conceivable bet type in a game. We're also investing in something on the iGaming side in global jackpots, more marketing, unique and exclusive content. So we have an exciting pipeline of games, but that's one part of it. The other part of it is how we reach the maximum audience.
Now it's gone 650.
The Super Bowl ad is a perfect element, example of what we're talking about. It's elevating the brand, reaching as many players as possible through increased investment. And the last element is omnichannel.
Yeah, omnichannel, that's the buzzword in gaming. By the way, you guys, you can't really see it in this particular shot, but on the other side of the Luxor, watch, we'll step out. Look at the BetMGM branding is everywhere around here. When you come into Las Vegas, it's clear that they want to make a splash. Sarah?
I'm sure they all do. Contessa, thank you. Contessa Brewer. Especially those Taylor Swift prop bets. Taylor Swift themed prop bets.
How many are there? Are there a lot of them?
I think there are some. They're related to Travis Kelce.
Okay.
Next hour on Money Movers, we've got another big interview from Las Vegas with Contessa, Caesars CEO. That's 11:30 a.m. Eastern Time. We're going to take a quick break here with the Dow down 76, but the S&P 500 near the highs of the day, above 5,000. Don't go anywhere.
She said, don't go anywhere. There's a bear flag right there. So the 5,000 put at 290. Whoops.
The White House hosting a CHIPS funding event this hour, announcing multi-billion-dollar investments in semiconductor-related R&D in the U.S. Our Megan Casella is at the White House with the latest. Megan.
That's right, Sarah. Commerce Secretary Gina Raimondo is just wrapping up remarks here at the White House on that CHIPS Act money, and she's kicking off with an update on those long-awaited awards for private companies. Here's the latest.
On the incentive side, we're cooking with gas. We have hired 200 people, an unbelievably high-quality team. We've already had a couple of announcements. In the coming, 6 to 12 weeks, you're going to see a drumbeat of even bigger announcements.
Now, Raimondo today is also
know if I wanna
announcing
hear
$5
that.
billion for research and development will be used to establish a national semiconductor technology center. It's envisioned to be a public-private partnership, and the focus will be on workforce development. Government agencies, private companies, universities will all be involved, and many of them are here at the White House for the announcement today. Now, the goal here, as
Okay, get
Secretary
ready.
Raimondo emphasized, is to ensure that the U.S. has the workers that they will need to build out a domestic semiconductor industry, which has been a concern. And to put
The
this
government?
into perspective,
I don't know if I
$5
like
billion
this
here
idea.
is not a lot of money, but the administration says this is just one piece of their broader effort. They argue, too, that the award money that will be coming just won't go as far without this step. David?
Megan, thank you. Get Casella down at the White House. All right, next hour, don't miss it. We're going to have the CEO of Take-Two Interactive on the company's latest results. By the way, the shares are getting hit. So Strauss-Zelnick's going to have some explaining to do, perhaps. That's next. In the next hour, of course, our live market coverage continues right after this.
Oh, no.
Trading the trending names every day.
I don't know if I like that, but what can you do? $5 billion wasted. Nice little bounce.
On emerging markets. And we will talk DraftKings sports betting ahead of the Super Bowl, the big game in our 360 panel, taking a look at semiconductors and some takeaways from ARM Holdings' big breakout that we saw yesterday. In the meantime, take a look at the markets here. 5,013. So if we close above 5,000, that really is very telling to traders. When you touch it and pull back, not as convincing. However, if you close above the 5,000 mark, that brings optimism. Of course, this is the 5th week in a row of gains for stocks, and so that too is bringing some optimism overall. Here's a look at the S&P's up 15, the Nasdaq is up 130, gaining 0.75%. The Dow also right now is to the downside, down 0.25%. And
Wants
the
to hold
Russell
that
gains, S&P
5,000.
Nasdaq 100 all-time highs. Taking a look at the futures, look here, you can see gold is down almost $12 today, as we are seeing oil gaining a quarter of a buck, right? So 25 cents. Here's dollar 103.96. That pulls back some, and Bitcoin back to 47,510, 3.8% gain there. So look at some of the top moving stocks in today's market. I'm joined by Jenny Horn, markets correspondent here on Schwab Network. Starting off with NVIDIA, seeing some gains after Reuters reporting that it's creating a new unit focused on custom AI chips. So tell us more about that, Jenny.
Yeah, Nicole, according to this Reuters report, NVIDIA is right now focused on establishing this new business unit that is to tailor these custom-made chips. So NVIDIA is reportedly aiming to support these various tech firms that do want to create these custom design chips for specific requirements, some of them being like lower energy usage as well as streamlined design expenses and other various features that these companies want to become the most efficient and the best basically tech offering possible. So in addition to potential customers in the telecom, automotive, and video game industries, they've also discussed the development of these custom chips with representatives from Amazon, Microsoft, Alphabet, and OpenAI, according to this report. They're also negotiating right now with Ericsson for the development of these wireless chip incorporations in terms of their graphics processing units. So according to one source, the anticipated new version of the Nintendo handheld Switch console could actually incorporate this NVIDIA chip design. So I think this is exciting to see actually how their chips are being implemented and evolving given the current landscape. But of course, NVIDIA has been one to watch all week long, all year long, all 2023 long at this point, as we are up 44% just since the start of January this year, up 8% this week, and fresh new all-time highs actually as we speak now at around 716.98. So a name that just continues to surprise and build on the overall cloud momentum. We have earnings though February 21st after the closing bell, so still that catalyst to look forward to.
Yeah, and I saw some price targets getting higher and higher. I think I saw above 900. Let's talk about Cloudflare. Your thoughts there?
Cloudflare, another name that's surging on the session, Nicole. Another one that I'd say is benefiting from the overall cloud AI hype. But the difference about Cloudflare is it's a cybersecurity stock, and they operate specifically with some of these small to mid-sized customers. So for that reason, they're more headwind exposed. Like they have more economic risk, they had more pandemic risk, just given these smaller accounts. But also the bar was set relatively lower into their earnings. So seeing a nice 22% pop today, now putting shares up 32.5% since the start of this year, and we are up about 33.5% just this week. Off of it, and now it's intra-session highs by about 5%, but hey, it touched $116 a share earlier in the session. Analysts just piling in, raising their price target. I mean, we see Citigroup, JMP Securities, Wells, Cantor Fitzgerald, Truist, Piper Sandler, all on the back of the fact that this company reported better than expected fourth quarter financials and guidance that was really strong now for their first quarter. So continuing the trend that the street typically tends to love these cloud earnings, especially when you can reaffirm your guidance and give strong conviction now into the current quarter. So really nice pop today, obviously, in Cloudflare shares, Nicole.
All right, thank you for that. Good to see you, Jenny Horn. Appreciate it. So plenty more to come here on Trading 360. We're going to have the big three stocks, three charts, three trades. Ben Lichtenstein will take us through the technicals. Stephen Guilfoyle, Sarge, will take us through his trades for Apple, Netflix, and then those are shorts that he has, and then a long play on the emerging markets ETF. All that, we will be right back on Schwab Network, Trading 360.
My dad was a hard worker.
Oh.
He used to do side jobs.
My dad was a pellet mill operator. He used to climb 6 stories a day with 2 bags of pellets for throwing down the mill, weighing 50 pounds apiece. Sometimes I seen him carry it with his teeth. 6 flights straight up. And that's today's Washboardjim's commercial. D-Dog looking good for a squeeze here soon. Pretty good run.
Founder, President, Sarge 986. Great to see you both on this Friday. We got in our inflation report, our CPI. That was encouraging inflation news, to say that. The revision's not as bad as some people had expected. There was some talk there. So we have stocks at new highs. Sarge, how are you feeling about the market as the S&P 500 and the NASDAQ 100 are hitting new all-time highs today?
It's hard not to feel good about the market. All of our longs seem to be working. I think if you're having trouble making money on the long side right now, you probably have made some erroneous guesses as to not the health of the economy, because I don't believe the economy is really that strong. I don't believe in some of the reports we've gotten of late. But I don't think you understand where capital flows are running to at this time. I think maybe the market is really betting more on the Fed than maybe they should. Maybe we'll sell off soon. We'll have to watch for those signals. But for right now, I mean, if you look at your quarterly statements, folks, you're going to be, if you're
God darn,
looking at
man,
them all the time, you're going to be pleasantly surprised.
My throat's tickling.
Yeah. All right, do you want the Fed to cut, and how many times, just quickly on that?
If the GDP numbers are correct, and the jobs numbers are correct, the Fed really shouldn't cut, right? I mean, I have my doubts. I think Q3 GDP was inflated. I think Q4 GDP was inflated. And I know that November and December jobs numbers were inflated. None of them were presented accurately to the American people if you go through the data. But if you have to go by the headline numbers, then they shouldn't cut. If the economy is as weak as I suspect it is, then they do have to start thinking about cutting probably by May.
Okay. That being said, I know you have a short on Apple today. Not so hot on Apple. Why is that?
Yeah, let's say there's a few names. You do have to selectively short this market, and Apple is the one of the Magnificent Seven, or maybe you can include Tesla, two of the Magnificent Seven that probably don't belong there anymore. Right? Apple reported on February 1st. They beat on EPS and they beat on revenue projections, but revenue only grew 2.1%. Yes, it was the first growth in over a year, but it was only 2.1%. iPhone sales were unimpressive. Mac sales were even less impressive. iPad sales were awful. Wearable sales were awful. Services are slowing it down, and that's the margin.
Only somebody with fresh breath there.
Huawei is bringing a great deal of competition to the Asia market, so those decreased Chinese sales, they might not be a passing thing. That might be there to stay. So and also look at India. I mean, we'll get that later in this segment here, but India is a growing threat to China's dominance of not just Asia, but the emerging market scene in general. So if you look at the charts, okay, I'm actually going to ask Ben on this, because I'm not sure what I see on the short term, whether it's a head and shoulders pattern that starts forming around the beginning of November and rounds out here into February, or if it's actually a double top reversal covering December into early February. I think it's a double top reversal, which would give me a pivot of 180. All right, if you go out longer, you go out to about a year or so, maybe 8 months or so, you'll see that Apple has topped in the same place 3 times. So I don't think Apple's going to really get too close to that 200 level anymore. My target price for Apple to the downside is 165. I mentioned my pivot is 180. I short more from 195 to 197 because those are the reversal tops. And I panic when it hits 200 because that would be a new recent high.
Panic.
Yeah, I want to see what Ben has
That
to
shocked
say
her.
about the chart. Thank you for that.
Well, Nicole, I completely agree with Sarge on this in terms of the levels he just pointed out, and not necessarily the short approach, but the fact that there could be some opportunity here from the short side, because I think we're still in a longer-term trend higher, but we'll break it all down here. Let's begin first and foremost with the 30-minute candle chart, because it's been a while since we looked at Apple, and the last time we were seeing a bit of a trend up. We were seeing after the middle of January, price activity rallied all the way up to 197. You can see since it's been just a mess. Look at some of the volatility we saw in reaction to earnings. Let me just identify again, last time we looked at Apple, we were talking about these areas of value that were moving at higher and higher levels. We were talking about how we were balancing around 194, and we mentioned, hey, the bulls don't want to see us get below 192. Look what happened, and why didn't they? Well, because that invalidated the trend up that we had been in. So since it's been kind of choppy, we haven't seen a lot of follow through, right? We didn't see any real conviction below that mid-Jan low, and you can see how we're just kind of hanging out in the middle of the range here. So I always say, when in doubt, zoom out. Let's do just that. Sarge brought to our attention a couple key levels. He mentioned the triple top that he sees playing out here. That's right around 199. This is the area the bulls want to get above right now, because after seeing high conviction throughout the month of February, March, April, we've gone basically sideways. So we've lost that momentum we were seeing to the upside, and we're currently balancing right now. If you take a look at the area that we're forming this range around, you can see that, well, it's forming around 185, right? So in order to get that high conviction, that real energy associated with this follow through associated with this trend to the upside, you're going to need to take out this 199 level, but no indication that we're not trending higher still. We are. Value is moving higher, right? So you've got, in fact, a key test that happened right around 174 that was, for the most part, held. So let's take another step back, and I want to show you what's going on as we look longer term here, just adding more time onto the chart and pointing to the fact that we're still in an uptrend. This is a weekly candle chart, but here's the range that we're in here. And so I can see, again, the potential to see further chop within this range, but still in a longer term uptrend, that's for sure.
Okay, so a long-term uptrend, not what you're saying, Sarge.
Well, you know, my net basis is a little over 193. I'm up a couple of percent on this trade. I do have a little room to play with. And as long as I stick to my panic point of 200, even if I get hurt a little, I won't get hurt a lot. So I think the risk is worth the reward in this name.
All right, next up, Netflix. Your thoughts there?
Well, it's another one I'm short. My net basis on this one is 557.11 right now. So I'm down about 1% or so, not too bad. Reported January 23rd, missed on earnings, beat on revenue. Current quarter earnings guidance was strong, but revenue guidance was soft. Net additions, as we know, were very strong, but are projected to be down sequentially. The stock is up 12.6% since Q4 earnings and 62.4% since Q3 earnings. It has since flatlined. I'm hoping that it's probably going to go sideways. It's already started to consolidate really since late January. It's come off of its technically overbought RSI reading. The daily MACD, if you can see that, has finally experienced a bearish crossover by the 12-day EMA through the 26-day EMA. There are two large unfilled gaps now staring the stock in the face. The first one needs the $481 level to fill. The second one is even more aggressive, a $344 level to fill. I'm not even going that far. My target for Netflix, my aggressive target is 481, which would be that first fill. My pivot is $538, which is currently the 21-day EMA. I short more from 557 up to 579, and I panic, so I can't lose a lot of dough. I panic at 580, which would be a new recent high.
All right, good to know. And look, I mean, when we see Netflix, we've seen it at that recent high of 579. What say you, Ben, about these charts, please?
Well, I can understand the apprehensiveness alongside this one, especially trying to position it alongside because it's had such a huge run up. I also think there's a possibility that we could start to balance here, so there could be opportunity again for both sides here, but I think the longer term trend is the upside, and let's begin again in a similar situation, similar fashion as we did with Apple with a 30-minute candle chart. Easily identifiable, 2 phases of development. I mean, if you don't see this, I'm not sure what you're looking at here, because you've got horizontal, sideways, random type price activity. Earnings catalyst comes into play, and you get that imbalance that's created. Higher highs and higher lows. That's a initiative type vertical phase, and then you transition back into that sideways phase. So we're looking at a 30-minute candle chart. So again, a limited amount of information here, but it really speaks to, again, as we take a look here, the 2 phases of development, right? Right around 480. Sorry, that was meant to be labeled there, 565. So let's move away from this 30-minute candle, because I want to add a little time on here now and show you an hourly candle chart, and almost an identical depiction, right? Very well defined. 2 separate areas of consolidation that have formed. I'm sorry, 4 on this chart. Areas of consolidation that have formed, but I'm looking at these 2 most recently, 470 all the way through November, December, into January of this year. You get that high conviction move up, and then sideways consolidation again. So this is the move that we just looked at. You can see holding above and right around this 565 level here right now as we speak. As long as we're above 470, I think this is key, and still in a very bullish type pattern. Let me show you the other time frame that I queued up here. And this is a daily chart. So again, it really speaks to the strength that Sarge was just talking to about what we've seen as far as this move higher and the momentum associated with it. But look at this gap up here that's been coming into play, and I think that we recently, again, just went into a vertical phase, and then, as I mentioned here, it's possible that we're going to go a bit sideways here right now and provide a little bit more overlapping rotational, something a little bit more for a 2-sided trade relative to this, which was very much in favor of the bulls at this point. So let's see, again, different times or different phases of development call for different approaches towards trading. Maybe we'll see a little bit of weakness in the near term, but longer term, still trending higher.
Right, okay, so again, he's not in this short camp, but to your point, you're not loving some of the outlook for this one, Sarge, right? From the company even.
Yeah, no, I don't really like the whole industry, the whole streaming industry, which where, like with other competitors, you might have cash flow streams that might support the streaming industry. Netflix, although they're doing well right now, this is all they have. This is their whole ball game. So they either have to maintain what the pace of growth or, I guess, earnings success that they've been having lately, even though everyone else in this space is running into trouble. I just don't think Netflix can sustain this much longer. And like I said, I have panic points. So if I'm wrong, I pack my bags and I get out of the small loss.
Okay, next up. Now, this is one that you like. You had mentioned India, but talk about emerging markets.
Back down to support level here on the SPX.
That you do like.
Right, this is EMXC for the folks at home who've never heard of this. All right, it's the iShares Emerging Markets ex-China ETF. I'm currently long. I'm only up about 3%.
I think $5 drop if it don't hold.
It's a play against the deepening property debt crisis in China. It's also a play on the move of industry and cross-border investment that had gone into China for decades into places like India going forward. Additionally, it's a bet on the Indian consumer as that economy grows in a much more fertile environment, I believe, than China and some of the other emerging markets. If you look at the chart, we have an almost perfectly formed up cup and handle here, which started around late July. It's run into early 2024. We have a pivot of $55 on it. Relative strength is fine. The daily MACD is improving. India has been a focus for a couple of months now. I'll give the kids at home INDA, which is the iShares MSCI India ETF. I'm up in that one. And I'm also up in SMIN, which is the small caps in India, iShares MSCI. I got all these Indian ETFs and stuff from Keith McCullough over at Hedgeye. I'm sure you heard of him. And I don't want to give credit. I don't want to take credit when I got somebody else's homework working for me here. But anyway, back to the EMXC. My target is $63. As I said, the pivot is $55. I add down to the 50-day SMA, which is currently $54, and I panic if the ETF loses the 200-day SMA, which is currently $51.
All right, thank you for all of that. And then EMXC. Ben, take a look at this one.
and not only someone else's homework working for them, but also trend to the upside. So I'm on board with this one, Sarge. I'm going to end on a positive note here. Definitely agreeing with the bullish sentiment. Taking a look here at a 5-minute candle chart here, you can see just over a very short period of time, the rally we've seen this week from 54.46 all the way up to 55.75 and holding this upper level. Exactly what I look for. Areas of value that are forming at, well, in this instance, higher and higher levels. Now, we've got the fine-tooth comb out, that's for sure, right? But I wanted to show you, again, even on these ETFs, we see futures, stocks, options. As long as it's open auction and it's involved in that process, you're going to see these phases of development, the two price phases here, horizontal, shifting to a vertical, horizontal, wash, rinse, repeat, easily identifiable. We're talking bottom left, top right. Depending on how you want to describe it, it really shows the same thing, right? Trend up. Similar pattern playing out here as we take a step back, right, to the hourly time frame. And Sarge was talking about that cup and handle. We'll have a look at that in just a second here. I want to show it to you on the bigger picture because it actually looks like a couple cup and handles that have played out.
A couple of them.
Just looking at this here, we've got a hourly candle chart here. We're going back and the stock is trading around, the ETF is trading around 47, balancing around 49. Big move up, 56.20, sideways around 54. But look at this here. You're going to notice that we get that pattern that plays out here multiple times here, right? You can see that staircase type pattern, wash, rinse, repeat, where even within this bigger picture, high conviction move up, sideways consolidation, you get that redemption, that multiple times of occurrence here to kind of solidify the working assumption. Again, we're trending higher here, pretty well defined at this point. Sarge mentioned the cup and handle that we saw into, what was it? He said starting out in the beginning of July, right, into October, and you can see here that we've sort of formed this bottoming pattern playing out. Wasn't the first time we've seen this happen along the way. This is a stock here that's been, an ETF that's been recovering very well, going all the way back to September, October of last year. It was down around 44, as mentioned. Again, we recently up to around 56. I agree with the bullish stance on this one, that's for sure, Sarge.
All right, I'm going to leave it there. Sarge, you have a last minute thought?
Yeah, just overall, I think India is a good place to be right now. If you're looking at the world and you're looking at the way things are shaking out, and you want some foreign exposure because you never want to be all domestic. I think India is the place right now with the most potential and most positive GDP right now at the current moment.
All right, thank you so much. Great to see you both for the big three on this Friday. Stephen Guilfoyle of Sarge 986, Ben Lichtenstein, thank you. Coming up next, a spotlight on online gaming. It's the big game this weekend, the Super Bowl. So what should investors be watching when it comes to names such as DraftKings? Trading 360, we'll be right back.
Do. Kind of needs to hold here, the SPX. Kind of do. There's the 200 here on the SPY. I'm going to get out of the SPX right here at 3. Got it $3.
Actually expecting the fact that the Boeing 737 issue that we are seeing could actually impact travel demand, as well as ticket prices going down could also impact their revenue moving forward here. So overall, they are expecting low to mid single digit booking growth for 2024. And actually at this point, we did see a nice run up as you talked about. So a little bit of a sell-off here may be something that's needed for the stock from a technical standpoint. And hopefully it is able to find an area of support here in the near term. But overall, I think it's just cautiousness when it comes to the consumer. Also, whenever you have unexpected leadership changes, that could also throw investors off guard, which could also provide some selling pressure for the stock.
Right. All right, Kevin Green, thank you for that. Senior markets correspondent. All right, time for our spotlight on online gaming. Ahead, we're looking, obviously, Sunday is Super Bowl, one of the biggest sporting events of the year. And we know that the betting has continued to exceed estimates. It's been growing really since the pandemic, and now even more so. Chad Bainen's with us, Managing Director of Gaming Lodging at Macquarie Group. Nice to see you. Thank you for being with us. So it's my understanding that, I mean, it is just surging. Gambling is hot. Tell me how hot.
Very hot this year. So 2023 sports betting revenues in the United States were up about 50%. And that was due to new states legalizing and then just better products overall. And we're seeing the engagement move from pre-match bets. So instead of just, -2 San Francisco versus the Chiefs, more towards things within the game and different prop bets and live betting. And that's kind of where the casual customer has gotten involved. And that's what we expect for the Super Bowl. So we expect, obviously, viewership to break all-time records. I think these are two teams that people know very well. The Taylor Swift effect has brought in a different type of audience. The number of teenage girls and moms that I hear that are going to be tuning into the Super Bowl for the first time in a long time, I think are setting records. And the big beneficiaries will obviously be the sports betting companies and then companies that operate out in Las Vegas, given that it's out there this weekend.
Right, understood. They have, I don't mean to talk about the Taylor Swift effect, but it's my understanding from the likes of FanDuel, and we had Flutter here just recently at the New York Stock Exchange. They are talking about the bets on someone like Travis Kelce they are surging. Tell me a little bit about some of these specific bets and trends that you are seeing for this particular Super Bowl.
Sure. So we put out a report yesterday, and what we found was the bookmakers really need San Francisco to win. They need a low-scoring game, and they need some of the big stars to not kind of hit their projected targets. If that happens, companies like DraftKings and FanDuel and the like could take as much as 30% hold rate. The natural hold rate for sports betting is 5%. That's what it is in the casino. That's what it is here. So some of the bets that we're seeing, they're standard prop bets in terms of how many yards each player will achieve if they'll score a touchdown. There are some fun little prop bets that we're seeing just in terms of how many times they'll show Taylor Swift. You have the traditional heads or tails. coin toss, little things like that. Some of the markets have pulled back in terms of how far you'll get to in terms of the broadcasting and kind of what's going on. But there's a lot of fun little bets that are out there right now.
Understood. So when you look at the gaming stocks, which ones are the buy ratings in your opinion?
DraftKings was our top pick. That stock was up over 200% in 23. There's a lot of strong momentum there, so it's always tough to get in front of the momentum trade. What we've also seen is some of the others are doing well now. MGM actually announced a deal with X, formerly known as Twitter, today. So they're looking at their current market share and their current, let's call it 26 projections as floor for the company, and they're looking to acquire more customers. So that was a really interesting partnership. FanDuel, which sits in Flutter, which you mentioned, dual listed here last week. They're the bellwether, right? Everyone's coming for them. They have the best product, the best technology, the best followers. But yeah, I think there could be some share gains for Penn, which struck a deal with ESPN Bet. The stock's trading as if that deal will fail. MGM, as I mentioned, is making a move here. And then Genius, ticker GENI, they collect all the data. They feed it to the sports betting companies, the media companies, and the leagues. Yeah. So they're kind of your picks and shovels, and that's kind of the best B2B way that we think investors should look at.
Yeah. You mentioned DraftKings was a top pick last year and the surge that we've seen for that stock. At this point now, what's your rating?
We still do have an outperform rating. The stock is run here. They report earnings next Friday. We did upgrade our price target in our primer on January 17th. We're at $44 per share, which is right around where the stock is trading. We're going to wait for Friday's results to kind of see, how we're thinking about the stock. But obviously, companies that are expected to grow 20 to 30% for the next 5 years, that's an area where investors want to go to. So yes, we'll reconsider some items after the Super Bowl and after they report on Friday.
Yeah, understood. That being said, now, when we think about different states that will add betting, right? Tell me more about that, because that could only help these names, right?
Absolutely. So currently in the United States, 38 states have legalized sports betting. Most of those are mobile. Some are still in the retail fashion. The big one that we're going to see for 2024, hopefully right before March Madness, is North Carolina. So that's a big state that's going to add some incremental, population there. And there's agreements, and a lot of the sports betting companies are excited to get in markets there. There's a few other bills that are being tossed around, and we'll see some movement in the next few months. So the U.S. is legalized in 55% of states, and then also in Ontario. For iGaming, that's where we haven't seen the momentum. 12% of states you can bet on iGaming. So that's slots and blackjack on your phone. If we see more of that, and New York is talking about that right now, that's where we think you would see these stocks really start to run, because that would create a brand new opportunity. They already have the customers. It's just cross-selling. So iGaming is kind of the holy grail over the next 5 years, but sports betting has been incredible, and it's really helped engagement for the leagues.
Yeah, Chad Bana, great to see you of Macquarie Group. Thank you very much. Appreciate it. The big game. All right, everybody will be watching on Sunday. Coming up next, George Sillis will take us to the disruptors, and he'll have an example trade for Datadog as well. Baird saying it expects some upside from this company. So let's talk about this one. Here's a look at winners and losers in the S&P 500.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. So she had a lot of questions when she came in. I watched my mother, being a single mom.
follow Cloudflare, which is symbol NET, NET, that's higher today in the edge cloud computing, but also the data center and of course the elements behind hyperscale enterprise data, and that's where Datadog and companies like MongoDB, which is also breaking out to hitting some nice highs this year, fitting with that same infrastructure scenario. So I think there's a lot going on in this entire space. If you look at Datadog, it really is all about infrastructure monitoring, application performance monitoring, and hyperscale performance algorithms as well. And so I think overall, the trend in the last year is very promising, essentially because enterprise spending continues to be robust. If the economy continues to strengthen, you're going to see businesses continue to spend, and Datadog is one of the leaders, up about 66% over the last year. Now, you have to consider that they have earnings next week, but one of the things I did notice about Datadog relative to, for instance, Cloudflare, is Datadog is actually closer towards GAAP profitability, a lot closer than Cloudflare, and it's actually trading at about a half of the forward multiple than that particular stock. But at the same time, it's growing faster at about 46% earnings growth for 2024. And it's trading around 73 times forward earnings. Now, in a nutshell, looking at other stocks that are cyclically exposed in nature, let's say energy or consumer staples, 73 times forward earnings is expensive, but it's not trading at too lofty forward multiple, considering that 47% earnings growth estimated for 2024.
Okay, so with that, I want to hear all about your example trade today, please, George.
Okay, so we're going to put on a bullish trade here, but we gotta be cautious in consideration of the earnings that are next week. So it could be volatile, it could be sort of blowout earnings where you see it higher, but also if the guidance is underwhelming, you could probably see the stock drift lower quite a bit. So what we're going to do is we're going to play and sell the next week's options that expire next Friday because they're very expensive, and we're going to use the proceeds to finance a March call option. So it's basically a long call diagonal spread, and so we're going to sell a out of the money 155 February weekly that expires next week call option, and then we're going to use the proceeds to finance a March monthly 135 in the money call option. So essentially, we're buying something that has intrinsic value right now, that 135 in March. Now, altogether, it would cost you about $8 a share or $800 a contract. So ideally speaking, we'd like to see the stock move higher. You don't participate if the stock goes above 155 by the end of next week. But if you do hold the position until expiration in March, you basically need to see 143 or higher because that's your break-even point.
All right, George Still, it's always great to see you for our Disruptor every single weekday here on Trading 360. Thank you. Coming up next, it's our 360 round. We're going to talk to our panel all about these semiconductor names. How about what happened with ARM this week? NVIDIA at new highs. We'll talk about it. Our panel is ready. Stand by.
I remember when I first started flying.
solving this very ambitious future project, but also right now in front of us with the CHIPS Act.
Yeah, no surprise right now, the biggest S&P gainer, AMAT, along with a bunch of those other names. Dee, thank you, Deirdre Bosa. When we come back, the CEO of Caesars is next as Super Bowl gambling is expected to hit new records with nearly 68 million
Nice reversal.
Americans planning to bet on the big game. Stay with us.
Caesars.
Well, I hope the audience knows what I had to explain this to a younger person who I deal with, and I was like, wow, you don't know what that is. So what it is something that seems more than what it is, like a magic trick, right? So why is ChatGPT a magic trick? Well, it's a large language model that is using statistics and something called a neural network to be able to answer questions and sound as if it's a human, but it is not. It cannot think, it cannot feel, all of those kind of higher order thought processes. It doesn't have. It's great at retrieval and being able to match patterns. So that's what that means. And I think AI, by and large, is a little bit of a parlor trick, but when applied to a value-adding solution, it's like magic. You can get more out of your time and thus probably higher productivity if you're using something like ChatGPT to help you write something.
Right, understood. And I want to hear about which names you think may be using AI in the better way, but I see what you're saying because there have been things that have come and gone or maybe seemed like a bigger deal than they actually were, that kind of stuff. Olivier, tell me what's behind what we've seen. For example, ARM had an incredible week after its quarterly numbers, and which companies are benefiting right now?
Yeah, ARM crushed it. And I think, it's reflective of whether it's a parlor trick or not, at least the interest in the market and all the opportunities for AI. Obviously, the semiconductor space is almost entirely driven, or at least the growth and the interest in it right now is almost entirely driven by AI, both in the cloud for the very large applications and training and inference models, and also on the edge, right? We're seeing AI that's already been in devices like mobile phones and computers take more of a forward role in solving problems and automating a lot of tasks that were difficult to automate intelligently before. So that's driving that. And also we're seeing it in automotive with all kinds of systems, including ADAS, where obviously on-device intelligence is pretty important to help the car steer itself and help drivers be safer. But I think, the top beneficiaries, I think, for ARM on the obvious side are going to be companies like Qualcomm and Apple that have based a lot of their solutions on ARM architecture, but also AMD, NVIDIA, AWS Cloud, Microsoft, and then somewhat less obvious of a list, you also have Synopsys, Cadence, Intel, Samsung Semi, Micron, Oracle. So they're kind of everywhere. And the fact that ARM produces, or at least has created, an architecture for chips that allows these chips to be extremely high performance, but with a low power signature, essentially kind of like, a really good performance per watt, makes them ideal because they're thermally efficient and they last longer on the same battery charge. That's really important.
Yeah, understood. I mean, when we look at the beneficiaries of what has gone on with ARM, you said some of the obvious were Qualcomm, Apple, AMD, NVIDIA, Taiwan Semi, AWS Cloud, and Microsoft. What do you think of that? Does that seem on point to you, Kim?
It seems absolutely on point, and I love that the electric power was brought up, that is always a concern in any kind of mobile device or even a device that's in a car. You don't want it to suck up too much power, right? And I think that's super important. But I agree to that whole list that he gave of beneficiaries. Yeah. I think too, like AI it may be a parlor trick, but it's real, right? And it's going to take a long time to play out. But I think investors need to be patient. And I too like AMD, Intel, and Micron because, well, AI takes a ton of memory or a ton of data, and data has to live somewhere, and that data lives on memory. There you go. So those are the things that I really like.
Yeah. Yeah, and look, I mean, I know you've worked as a software engineer in AI, you understand its potential. So we definitely don't want to minimize AI because it seems like the biggest thing going since sliced bread. I don't know. You do have names that you do like. You still like Intel, AMD, and Micron. Kim, tell me about those names. I mean, are those those are your favorites in the group, right?
Sure. Well, I'm growth at a reasonable price. So I look at some of the names like, God bless it, NVIDIA. I know that on a PE and going forward, looking forward, what it might be a good deal. But I also know that the buyers of NVIDIA, the AI, people developing AI, don't really love the price. And they are going to look for lower priced alternatives. And that's why Intel and AMD are some of my picks. Is because they should be able to come up the curve and be able to offer products that compete directly with AMD at a better price. And who doesn't like something on sale?
And so, thank you for that. And Olivia, when we look at the PC and mobile, I mean, you mentioned Qualcomm because you think that's the next phase for AI, right? Moving to mobile devices. As users, how will we know? What are we benefiting from? This is the next phase, right?
Yeah, and to be fair, I think Qualcomm's been has had AI on their devices for quite some time before we really paid attention to it. But I look at this as sort of like back of the house AI and front of the house AI. So back of the house AI is the AI that you don't necessarily notice, but it makes your connection work, especially with millimeter wave, which is very complex to do. It helps your pictures get better. So a lot of the filters that you're seeing on your apps that make your video and your pictures better, that's also managed by AI. So there's been this presence, and we've had natural language interfaces on phones directly through Qualcomm Snapdragon platform for some years. So it's a natural evolution now. But what we're seeing is as Qualcomm enters the PC space with their ARM-based X Elite solution, I think, which launches with pretty much every major PC OEM in the spring, we're going to see a lot more forward, like front of the house AI, where you're going to see some of the same sort of LLM training, inference work, natural language interfaces happen on the front end, and it's moving to PCs. And so that's the real, I think, big development for this year.
And Kim, just final thought. I mean, would you buy the group as chief investment officer? I mean, would you look at the whole group, or it really is name by name?
I love name by name because I'm a fundamental analyst, and while I think the whole group is going to rise, there are winners, clear winners. So I like what I like because I think they're well priced, and looking forward, they have a shot to outcompete the competition.
Yeah, great to see you. Kim Forrest, Boca Capital Partners, Olivier Blanchard, Futurum Group. Thank you both so much for being with us here on Trading 360. I'm Nicole Petalides. I will see you at 2 p.m. Eastern Time here live from the New York Stock Exchange for the Watch List on Schwab Network. Keep it right here. Fast Market is next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with no monthly service fees or account minimums. Unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
20.
To worry about with the consumer as long as unemployment stays low and wages are now growing faster than inflation in some areas, so that's real disposable income.
Yeah, and some of the bullish scenarios that say David Kelly was spinning on our air today, where you get continued relief on inflation from used cars on goods, and maybe some auto insurance numbers keep coming down, and employment stays steady. That spread, the real wage component, where you have money freed up from moderating inflation, would definitely be supportive to the consumer.
I do think one question is how the market would react to a little bit hotter inflation rate. Now that we've gotten some good growth numbers and some patience and wanting to see more evidence on the part of the Fed, that the biggest question mark is over the Fed's reaction function. What do they want to see? You know, Powell says more good data, not necessarily better data on inflation. And growth. So I think that's going to keep the market guessing a little bit when it comes to especially some of the big tradable events like a CPI report.
Right. And by the way, speaking of Fed speak, we're going to get next week Barkin, Kashkari, Goolsby's in there as well, Daly, some voters for sure.
Yes, and look, they've all been pretty consistent, I would say, in the message that March is not really in their thinking, but they have shifted towards cuts. So as long as they continue to talk about cuts and the data comes in good, that's been a good story for the markets. S&P higher now, 14 of the last 15 weeks.
That's right, as we continue to hold above 5K here, even though with some weakness in the Dow, as we put to bed, pretty busy week, not just a Fed speak, and not so much data, but definitely the corporate results this week have had us quite busy. So enjoy the game. Go Niners.
Because of my family. Everyone knows I'm a Bengals fan, but my husband's a diehard fan, so go Niners. I'm really just watching the commercials. The Super Bowl's like a break the game.
Let's get to the judge.
All right, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. 5K and beyond, the S&P crossing that major milestone. Now the investment committee debates what's next for your money. Joining me for the hour, Bryn Talkington, Jason Snipe, Jim Leventhal, and Kevin Simpson. Let's check the markets. We're holding above 5K on the S&P. Dow's a smidge negative. There's the NASDAQ outperforming today. So the bulls, Jimmy, say this is not done yet. You got UBS, 5,300 this year, sounds right. Tom Lee is the bull. 5,400 to 5,500 says his prior target looks conservative. It's been a remarkable run.
That's been one heck of a run. I do think those targets will be met by year end, but Scott, I mean, we're up 5% on the S&P 500 in 40 calendar days, about 30 trading days. Nvidia is up, 45%? Now that by market cap, folks, that's about almost 600 billion in market cap in a month and a half. And
Nvidia's up again today.
I know.
Nvidia right now, let's just throw it, there it is. You guys have it up. Nice job. It's up it's $715.
Yeah, well.
It's another 3%.
It's another 3%, 600 billion roughly in market cap added this year. And I'm just going to say to you, Scott, but also to our viewers, nothing's changed in the company over the last 40 days that merits 600 billion of market cap change. This is sentiment. This is enthusiasm. It can continue. It's continuing right now, but I will tell you that as much as those targets that Scott just mentioned, I think are reachable, I also think we will have a correction as we do in any normal year. Now, I woke up this morning, Scott. I know I'm going on the show and I'm thinking to myself, geez, I haven't done any moves recently. I'm kind of boring. You're probably bored with me. And until this morning, I was thinking, I got to buy something because I sold Boeing, I sold Alaska Airlines a little while back. I got to buy something. No, this morning I wake up and say, my next move is to trim. It's to trim, because we are going to have a correction. It's not today. You can see that in NVIDIA. You can see that in Apple and Microsoft. But I will tell you, when you get a distributive day, which we haven't this year, a distributive day in the Mag 7, I'm going to take some money off the table. It's not because the earth is shaking or falling out beneath our feet, but because corrections are normal. And when you have this much of a swoosh higher on enthusiasm, at some point you got to give it back.
You think NVIDIA is the key to the whole market right now?
I do, because of those numbers. And actually, it's not just NVIDIA, but that's obviously the bellwether. Think about Meta, which has added $300 billion in market cap so far this year. Think about Microsoft, which has also added $300 billion.
I mean, Josh trimmed 20%, Bryn, off of NVIDIA, which he loves. You own it. Everybody today but Kev owns it. What are you thinking about as this stock just continues to defy gravity? As I said, it's up 3% again today. It just recently crossed 700, and now it is at 716.5.
NVIDIA has doubled 4 times in the past 5 years. It's just been this historic, company to witness. But I think when that occurs, what was maybe a 3% weighting, if you've held it, all of a sudden becomes a 12, 15% weighting. And so I think that's where portfolio construction comes in. And so you can't fault anyone for trimming this just like beast of a name. I do think from my perspective, half of my position I sell calls on. And so when NVIDIA was between 400 to 550, I was selling calls. So right now on that position, I sold 550 calls. So in the middle of March, if it is over 550, with just well over that piece will get called away. I'm totally comfortable with it because that is portfolio management to me. And so I do think though, where NVIDIA and Meta are 50% of the return of the S&P, because the move this year has been so big. To me, what's really concerning is this exuberance underneath the NVIDIA adjacents, like the ARMs, the ASML, the Supermicro, these companies that are up, Palantir, up 30 to 100%, right after their earnings or 2 or 3 days later. That, I listened to all the earnings calls, Scott, it does not make sense, except it's exuberance and sentiment. So to me, there's a ton of froth underneath this AI shift, but it's not all going to come in the first year of AI.
Right. Tony Pasquarello talks about, he's of course head of hedge fund client coverage, Goldman Sachs. I always cite his notes when they come out weekly because I feel like he gets at the pulse of what's happening and those that he speaks to. I know the kind of investors that he talks to on a regular basis, and they're really on the pulse of what's happening in the market. He addresses this too concentrated risk within the market, and he says, well, I worry that we're increasingly due for a short-term correction in the momentum story. The key has been to keep your eye on the ball where the biggest and best names are. How about this stat, Jason? The top 6 stocks in the S&P are up 11% year to date, while nearly half of all stocks in the index are marked down in the new year. If that doesn't speak to concentration, I don't know what does. And yeah, anybody would come on here and say, well, we've got to be due for a correction. Of course we're due for a correction. Look how much we're up in a short period of time. The Nasdaq's up 24% since November 1st. Being due for a correction doesn't mean anything.
Absolutely, Scott. And as I was kind of thinking about it this morning, one of the things that came to mind for me is we were having the same conversation last year, in Q1 of last year, talking about the narrow breadth and how seismic the returns have been in the NASDAQ 100. And we were also talking about the year of efficiency and obviously what Meta did. And we're seeing a lot of that pass through again this year with the mega caps. There's been a lot of layoffs and margin expansion in terms of growth and revenue. So I think it can continue. To be perfectly honest with you, I think the later part of February, likely there will be a pullback. I think to your point, a lot of folks, it's easy to say that. It's easy to surmise that based on what the price action that we've currently seen.
Right. Of course the market's due for some kind of consolidation at some point. So what?
Right.
Doesn't mean you're going to have one today, tomorrow, or next week.
But what I will say, though, what's been interesting for me is industrials are starting to break out. Obviously, the transports are starting to break out. So there are other areas of the market that you can participate in. And I do think, from Bryn's perspective, I think it's an excellent point. Risk management is important. You can do some pruning at the top, but keep these core holdings in place.
I mean, Kev, is it the right strategy right now to, quote unquote, keep your eye on the ball with the biggest and best names? Now, Tony also points out, by the way, that hedge funds continue to buy these stocks. They've been buying tech for 4 consecutive weeks, and that length is now a multi-year high.
Yeah, I think people are always going to pay up for tech, but this doesn't feel the same as it did last year. I mean, last year it really felt like there were 7 names that were carrying the entire market. And I realize that in his note he's talking about 6 names representing 11% of the S&P return this year. But I want to pick up what Jason said. It feels like there's a whole lot more breadth this year. And if we do see a pullback, because, you know, why can't we? Once in a while, you do get 10% pullbacks. In the old days, you know, we get 2 a year. Every once in a while, you get a 20% pullback. It seems like every day things keep going higher and higher. And I guess the valuations, if you look at them on a 1-year basis, Scott, we're ahead of our skis. Easy thing to say. But if you take the lens back a little bit and you look at it from the rate hike cycle, when it started at the end of 2021, there's a ton of things that haven't gone up a whole heck of a lot. And looking at it from that macro picture, we're not as far ahead of our skis as it probably feels like just over this micro concept or this micro sector of time.
You know, Jimmy, you want to know why people keeping their eye on the ball with the mega cap names? I mean, cash pile, reliable for the most part, earnings growth, right? That's where you're going to go. And Tony also mentions buybacks. We already know the massive amount of buyback that Apple does. And he lists sort of from the mega caps. Apple bought back $20.5 billion in Q4. That leaves $53.5 billion of their prior $90 billion authorization still on the table. Google repurchased $16 billion, Meta $6.3 billion, Microsoft $4 billion. In other words, these companies are buying back more stock than anybody else in size and scale that nobody else can do because they don't have the resources to do it in the magnitude that they are. There's your fuel as to why, in part, these stocks continue to go up.
So I agree with you about the fuel being there, and I think you know how I feel about buybacks. But if that is the case, then there are a lot of companies, folks, outside of the Mag 7 where there is even more fuel. And, you know, I mean, I'm not going to go through all of them, not going to go through by names, but airlines, casinos, car manufacturers. And here's the point I would make, taking nothing away from the Mag 7 in those buybacks. If you're Apple and you're buying back your shares at roughly 32 times forward multiple, that's an earnings yield of 3%. If you're GM and you're buying it back at a 5 times multiple, that's an earning yield of 20%. I mean, this is, if you're looking at the cash that's going into these shares as an investment, the yield return, or the earnings yield return on GM's repurchases is 20%, Apple's is 3%.
I knew you. So I knew you were going to cite that particular buyback. I would just suggest these feel more powerful in what the message is around these stocks. That as investors are scrutinizing what some would suggest to be extended valuations, but yet these companies continue, Jason, to come in and buy back their shares, even at these elevated prices and multiples, it gives you more confidence that there's more room ahead.
Right.
And that's why there's not a lot of selling in these names. It's why in NVIDIA, now it's not on the buyback list, obviously, but it is why those stocks continue in part to go up to the degree that they do.
Right, and I mean, to the point of, for me, when I think about free cash flow, and you talk about a company like Apple who has $100 billion in free cash flow, and the ability to make these statements and buy back a ton of stock, obviously is a message, right? But the other thing I think that is important as we look to what we saw last week, there was clear dispersion. right? All of them didn't. All the mega cap names didn't move in the same fashion. So I think there are some stories that make more sense than others. Like I like Microsoft, I like Amazon, but the Apples and Googles of the world I think are falling back a little bit. So I think it's something to evaluate.
So Kev, you could the people who are more cautious or are still bearish are citing these alleged risks to the market. Not to discount any of them, they may be real risks. How significant each one is the real question. Too concentrated. We just went through, the Tony's list and some of the facts around that. They say the market's too reliant on rate cuts. We're not looking at March anymore. All the Fed speakers of the week, and there were many, are on message that we're going to get rate cuts likely this year, but it's not going to come in March. So
advisors, Lind, Elf, Bet Eyes, Drumstick, and Nerds returning FanDuel, Reese's, Pringles, Oreo, BMW, Skechers, T-Mobile, TurboTax, Booking.com, and our first topic that we'll get into in next segment, Anheuser-Busch. A big number. Anheuser-Busch that we'll talk about in the next segment. I mean, it's all about advertising. It's all about people getting their name out there. Monday morning, we'll be talking about the commercials, who did it right and who did it wrong. Joe, final thoughts on as we prepare for Super Bowl Sunday. What should we be looking for?
Yeah, I think Bud's got to get funny again. I mean, they do well when they have funny ads. I think all of the ads, to a certain extent, kind of do better when there is that comic relief aspect to them. We might be moving out of the last couple of years where there was a little bit more kind of a social slant to some of the media ads. I think one of the things you just mentioned there with the new advertisers, Elf is absolutely taking advantage of this opportunity to have more female viewers paying attention to the Super Bowl this year. That's right down there, right in the middle of their alley for that demographic.
Yeah, it's interesting because the things we talk about on this show and the things that Las Vegas deals with, and what's the link between our business and Las Vegas? Probabilities, right? We teach probabilities on a daily basis. Las Vegas was built on probabilities, Joe.
You are the Steve Wynn of derivatives, my friend. Yeah.
Yes.
No, yeah, absolutely. There's a reason, like I said, there's a reason why you got all those beautiful shiny casinos on the strip there, right? Because the probabilities work for the house, and they understand mathematical models pretty darn well. Whether it's going to be DraftKings that we'll talk about later, or whether the casinos, they are looking at this as a monster weekend, both online and in person in Vegas. And like I said, a fantastic opportunity for the people that are going out there, but I am more than comfortable sitting on my couch and just taking it all in from there.
I once gave a speech in Las Vegas where it was titled Probabilities. Las Vegas wasn't built because you win. All right, let's take our first break and come back with our first train of the day, and that is Anheuser-Busch, Budweiser, call letters BUD. Stay right here on the Schwab Network for more Fast Market. See you in a couple minutes.
Trading at Schwab is now powered by Ameritrade. Unlock
call it a failed advertising campaign. Now, the good news is the stock has made back most of that market cap loss, but Bud Light hasn't. It's still 29% below year-ago levels. Now, they're putting a big push into Super Bowl advertising. They've got a 1-minute commercial scheduled with Peyton Manning, Post Malone, and something called the Bud Light Genie. I don't know what it is, but it kind of scares me. But your views on AB InBev, Joe?
I mean, Bud has spent the last year recovering from that PR nightmare, if you want to call it that, whatever that led to the dismissal of 2 marketing executives. Bud Light lost its place amongst the top of the beer selections in the U.S. It was replaced by Modelo Especial. There we go. My apologies on that one. There we go. And in terms of dollar sales, right? And so, as you mentioned, they lost $27 billion in market cap. They have come back for the most part, but Bud Light as a whole, it's falling to $107 billion at the end of May for its sales. So, Bud Light sales haven't recovered. The brand itself has made some headways. Bud Light's retail sales are still down 29% last year compared to the same period last year as we come up on this weekend here. Shockingly enough, though, and one of the reasons we saw a little pop in the stock, though, this week is that, Bud might have found a new, surprising as it might be, a new supporter in the way of former President Trump. He told his social media followers that Bud wasn't a woke company, and then he listed some stats about his supports for farmers and veterans. And it's the company itself has undergone what you would call, at least in my opinion, a slow increase in revenue and earnings, about 3% each year over year. But it has had a decline in its operating margin, and the stock has pushed all the way back up from its lows in October, around 52, to about 65, and where it was early this morning has pulled back a little bit now. There's been about 3 times where it's got up to that $66 level, prior to the PR hit that it took, and each time it's failed. Most recently, just a couple days ago, or yesterday, really. So I look at the stock and I say, okay, from a valuation standpoint, yeah, it's probably in line. It's trading about a 21 PE, so it's a little bit below its three-year average. But the operating margins are coming down as they've had to spend more in advertising to kind of clean up some of the mess from last year. And I just look at this as a company that's had a nice run into this Super Bowl. But unless there's some major catalyst that comes out of it, it might start to kind of slowly creep back down to where it was before. And the reason I say that, I'm just looking specifically from a technical basis here. That 66 level's been some resistance. You look at the RSIs; those are rolling over back down to around 40, about 50, right around 50 at this point. And you're also looking at some divergence between where the stock was and kind of where the RSIs are right now. And so the trade that I'm looking at, Kevin, is it's a broken wing put butterfly. It's going to keep you out of the earnings date, which is March 1st. We're looking at the February 64, 62, 61 broken wing put butterfly, as I mentioned. Basically, you buy one of the 64s, you sell 2 of the 61s, and then you buy one of the 61s. The reason this is a broken wing is because on the top side, you got $2 wide. On the bottom side, you got $1 wide. You're going to pay probably about 45 cents or so. I just checked it. I think it's right around that, the same price right now, which means you need a little bit of movement in the shares. I mean, we're currently at 64.40, so at this point, it would not be a break even until it gets down to about 63.55. And this is just looking for maybe it to fill the gap that it got that little pop off the Trump news a couple days ago.
Yeah, this is the maker of Budweiser, Bud Light, Stella, Michelob Ultra. You mentioned Donald Trump as a spokesman. Also Dana White, Ultimate Fighting, cut a deal with them. So they're attempting to get that pendulum that swang way against them back into the middle of where it was before. And like I said, Peyton Manning, Post Malone, and the Bud Light Genie will do a 1-minute commercial during the Super Bowl. If it's $7 million for 30 seconds, it's got to be about $14 million. That's without paying the celebrities. That's without the production of the feature. So big money coming from Bud Light. But your trade, looking to the downside, because in all reality, the stock has run quite a ways. This is a trade that combines the $2 put vertical with the short $1 put vertical. And at somewhere between 45 and 50 cents where it's trading right now, that peak, if it were to move towards that 62 strike, this 45-cent debit could go to $2, Joe. So with very little risk, on almost no risk, actually risk on the downside, because it's at $2 versus the $1. So Joe, looking at this trade and the bearish nature, it gives you about 18 short deltas. Your final thoughts on this broken wing butterfly downside in AB InBev?
So one of the reasons that I chose the 62 strike for the short strike on this one is if you kind of look at where the stock popped pre-Trump news, it was right around 62. It was kind of gravitating towards that price for a while. And this is just, it's a trade. It's a fairly cheap trade, right? You got $45 at risk to make 155. It's just a way to play a little bit of a downside without buying puts outright. Gives you the opportunity. Should this thing kind of creep back down to that level in the next couple of weeks prior to earnings, like I said, you might get a little bit of volatility Monday or Tuesday, kind of based upon what the news is and what the commercials are over the weekend. But if that's the case, that's going to affect the price of this broken wing butterfly. This thing expands in value at 62. It's looking for a move back down towards that kind of a ledge where it was before.
All right, Joe, we're almost halfway through the show. We've covered salty snacks and booze so far. We still have 2 more categories to go, and that is food with wings and then some gambling at the end. So let's take our second break of the day. Come back with Likefolio. Megan Brantley is joining us to talk about, actually, here's a bonus. She has data on all 3 names we're talking about today. Take a quick break. Come back with Likefolio and Fast Market in 2 minutes. See you then.
Ameritrade.
Break out.
rallied up to here. Can it rally further? It can. Yeah, we can't rule it out. This is one that plays for that big move, Joe. Your thoughts on the long iron condor? The risk is what you pay for it, and time is actually working against you here.
Well, I mean, look, Kevin, if you look at the last earnings move, it was about 12%. So I mean, this thing can move. It went from 180 bucks to well over 200, and then it's really just continued to move ever since. It is getting a little bit stretched, I think, from an RSI perspective. But yeah, I mean, if you're looking at a type of trade and you're looking at a stock that's gone from 180 to $300 basically, really since the November lows, you're playing movement because that is what the stock has shown, right? It would be hard for me to look at something like this and say, well, yeah, no, this thing isn't going to move. You want to sell premium into this. I just look at, I say, okay, well, what has history shown us? History shows us that, this stock is pretty volatile around its earnings announcement. And if that's the case, we don't know where it's going to go up or down. But what you've done here, as opposed to buying a straddle outright, where, you're going to have to pay a lot more to do so, you're actually saying, I don't know what way it's going to move. I'm just expecting movement, and the outlay, the debit that I pay for this, I can cut that down by choosing to do this as a long condor versus buying a straddle. Yes, you need more movement, but your debit and your cash outlay is much less.
Yeah, it's got about a little over 1 delta. It's actually paying $5 a day in theta, but you have the chance for more than a double. If this $4.35 debit, which is the risk on this trade, over that time period, what did I say, 36 days? I think it's 36 days. Yeah. So over that time period, the 435.
Well, there's a big old candle in the SPX.
The break evens on this trade, which is about, let's see, 266.70 and 324.35 in that range right there. So remember, you need movement with an iron condor. The risk is if it stays in that range. All right, let's take our final break of the day. We'll come back with the Ben Lichtenstein market update. George Tillis talking about DraftKings. Joe and I will take a look and trade it. Take our final break of the day and come back with more Fast Market. See you then, everybody.
We still own Airbnb. But you're right. You could see others come into play here. So, Jimmy, candidly, the reason we bought this stock was because it was a quality name that saw a surge in revenue growth of up 30% over the last 3 years. And then guess what kicked in, Jimmy? Momentum. Momentum kicked in, and that's what I'm trying to emphasize right now. Momentum is dominating the market, and this is a classic example of a momentum name. And when you have these momentum names, and you're 27% above the 200-day moving average, don't be surprised if you wake up the next morning and you're only 9% above the 200-day moving average.
Joe, thanks for joining. Enjoy the weekend. Enjoy the Super Bowl. We'll see you on the other side. Joe Terranova. Now, I mentioned Bill Baruch buying a stock that's up 60% this week alone. It is ARM Holdings, and he joins us now to explain why. 60% up. You buy it now?
Yeah. It's about 10% off the high, so I'll take that part of it. But before I dive in why, again, here's the thing: is I'm looking at ARM, and it's all about portfolio positioning. Amazon's our #1 holding. I talked about Tesla yesterday. If you couple ARM and Tesla together, they're about a third in our portfolio, a third of the size of Amazon. But I want to own these names because I think that they can 4 or 5x from here over the next 3 years. Look at the EPS that just came out here. They raised guidance on this report on the lower end of full year guidance of EPS by 20%. Not only that, we're going to start to see better royalties as their clients switch off the VA.
Thank you very much. That's really nice. Thank you.
Better computing. They cover 99% of the smartphone CPU computing market right here, and I just see this foothold getting bigger and bigger. I want to have a piece in this game right now, and I see myself adding if it does go lower.
So a couple things. So you're telling me that none of that, what you just said, is already in the stock, number one. Number two, if the market is ripe for some kind of consolidation, wouldn't this be at the top of the list or certainly near it for stocks that can have a larger drawdown than others because of the unbelievably rapid rise?
Well, number one, I mean, here's the thing: is overall this positioning in this market not being priced in right now, because I think that this name is now on the list of other managers, other funds that are looking to gain this exposure. Remember, they went public when September, October of last year. From there, these names are not getting bought right away. The lockup period for those who own it is extensive, but these names are not getting bought right away. We got through 1 quarter of earnings reports, and then we're getting, this is the main quarter right here. This is what puts it on funds' radars. This is what puts it on managers' radars. So I think now they're waking up to it. The big banks that are managing large amounts of money, they're waking up to that name now. That's why I want to piece into it. But when you talk about the broader market, in the move that we've had in the SPX above 5,000 here, new highs typically lead to newer highs. And that's why here, if we do get a pullback, I think what they've done, what they've accomplished and announced within this earnings report is going to keep this market out above, the $70 and $80 mark. I would love to buy it again and add to this position if for some reason it did go to $80 and $90. I think we'll see it build a nice base out. But the thing is, it may not go down there. And the way I look at this extrapolating in years to come, we're in the early innings of AI. I, at some points, have thought that we were maybe in the middle innings. No, I really think we are in the early first half of AI and monetizing it. What we're seeing here from the hyperscalers, from Apple now, what we're seeing from Meta, of course, Alphabet and Microsoft, they're going to be putting more money into this and pumping into it.
I got you. I mean, one of the obvious concerns is that some of these stocks have gotten 9 innings worth of gains in the first inning. So that's something to keep an eye on. I appreciate you joining us. Bill Baruch, thank you. Up next, Mike Santoli is here with his midday word. senior markets commentator Mike Santoli sitting at the desk with us for his midday word. We did wonder what getting over 5K, that the hurdle itself would mean. You had the revisions to CPI, which we had looked at, and look, the yields are creeping up. You have the 10 years at almost 419 again.
Yeah, I don't know if the market is exhibiting a little bit of resistance to the yield effect, or if it's just lagged, or if it's not hit a threshold where there's much concern. What I will note is the big landmark index level was just hitting a few seconds ago, 2,000 on the Russell 2000. We're back. It's the third out of the 5 days this week that the Russell's been outperforming. It's been obviously the problem child of the market in some respects. It doesn't have to lead the way. 2,100 is the area. Another 5% from here. That's like the early year high, going back a while. That would suggest that the tone is changing in the market. Not that it has to change, but that would indicate something might be brewing. And that has been the most yield-sensitive part of the market.
Yeah, you're right. That's a really good point. It doesn't have to change, but it would certainly help. It would help in the overall kind of narrative about where we are and where we may go from here.
It would help stock selection. It would help the idea that the market's responding to a better economy and not just, flows and excitement about AI. I still keep pointing out, though, that the market itself is not as narrow as is being portrayed in general. Industrials have a very nice looking chart. As a group, they've done well. Off the lows, consumer cyclicals have done better than the market. So the market's figuring stuff out. It's just not necessarily providing the big push in terms of adding market cap.
All right, we'll see you on closing bell, Michael. Thank you. Mike Santoli coming up. A big breakout from one of Brin's holdings today. We're going to trade it, of course. Plus, we will talk about some of the week's other major movers in 2 minutes.
It's your Verizon.
All right, we're back. Want to single out 2 big winners and 2 big losers this week. Loser, well, Charter Communications is down big. trading to lows not seen since January of 2019. Moderna's a big loser this week as well. On the winner side, Bryn, I'm coming to you because Roblox is on our list. They beat and they had that strong guidance. We wanted to talk to you on that day. You couldn't do it, so I'm glad you're here today. Given the week,
Damn, Moderna's took it.
What do we do here?
Knife.
Yeah, I mean, I like buying good founders. Dave Bazzucchi's so solid. I think to put some more context around the numbers, whether it was daily active users, bookings, revenues, hours engaged, they were all up 20 to 30%. So really strong numbers. What I'm excited about is their international expansion continues to go very well. Japan was up, I believe, 45, India at 59, and they mentioned that they started this AI chat translation. So, you know, everyone has their headsets on while they're playing. You can actually translate now into 16 languages. So someone in the US can talk to someone in India. So I think that's really cool. They're hitting all their strides. I do think for the stock to get, Scott, over 50 and then on, they're gonna have to have a path to positive earnings. I still think that's probably a year or so away, but really good to see the execution overseas.
You can give me something quick, too, on Bitcoin, which is up 10% this week and above 47K for the first time since March of 2022. So it's been a minute.
Yeah, I mean, I think people are excited about this halving. You know, I couldn't tell you exactly why that's bullish and what it means, but I know people are excited about it. And so I think, you know, Bitcoin continues to surprise everybody and just be very, very volatile, but very durable over the long term.
All right, we'll take a quick break. We'll come back to final trades. Is reporting that that company plans to restructure its business, including laying off thousands of employees, looking, according to this report, to focus on high growth areas, according to three sources familiar. The company, as you may recall, and Jimmy, you own the stock, so you followed the earnings most recently, when they did cut their full year revenue and profit forecast, a sign that demand for their networking equipment was slowing. We've heard a lot from tech companies about trying to get leaner, and this appears to be the latest one added to that list.
Yeah, and this seems to be the playbook now in tech. You get rewarded in your share price if you cut heads. So that's what they're doing. Look, last quarter, when Cisco reported, they gave very poor guidance as far as their order book, and the fear is that all the spending on AI is just taking revenue in limited tech budgets, taking revenue away from Cisco. So they're going to report next week, and here's what I think is key. They announced this week a partnership with NVIDIA in terms of corporate budgets and enterprise spending. I'd like to see them on the call next week talk about that more in the same way, different industry, in the same way that Bob Iger really gave some life to the Disney story when he talked about the Warner Brothers and Fox Sports partnership that he's got going. There's an opportunity here for Cisco to really get back on its feet, but they need to act on it. It's not just headcount cuts.
It looks like it would be the second significant pairing of jobs from this company in the last, let's call it 18 months or so. November of 22, they did announce during an earnings call, according to this report, a restructuring that impacted roughly 5% of the workforce. This particular report suggests that the total number of employees this round is not known. They're still deciding it at this point. Kevin Simpson, you're in this name too, aren't you?
I am, Scott, and if you think about the acquisition of Splunk, it makes sense that there might be an excess of employees. I know that sounds callous to talk about it, but if we look beyond that and we talk about free cash flow, in addition to the restructuring, this company is committed to really 50% of free cash flow being distributed to shareholders through buybacks, dividends. They still have $10 billion in buybacks that they have authorized. I don't expect a whole heck of a lot out of the earnings report. I don't know that I buy the stock in advance of that. We do own it. We have a 52.5 call against half the position. We love the stock long term, but I'm not sure that there's going to be tremendous headlines that are going to drive it forward next week.
You know, Jim, it's just one of those names that just hasn't really resonated very well with investors this year. It's flat. Maybe down a touch on the year, as all of these other stocks we've been talking about have just ripped within tech.
Yeah, and I hate to say it, but I think this earnings call, Scott, is make or break.
Well, this is obviously trying. If this report is correct,
it doesn't
it's
bode
well, it depends how you look at it. It's obviously trying to get ahead of that.
Yeah, and I'll grant you that. But look, they had a bad quarter and a bad guidance last time, and this has been a steady Eddie performer. But I don't want to see this roll over into something that becomes very moribund for a long time. So I'm looking, and I think others are as well, and I know people in my company that I talk to, we're looking at this as kind of make or break this quarter. There needs to be some good guidance. I do think the NVIDIA partnership is important. I think Kevin's right about Splunk. That's important too.
Bryn, you got a final trade? Thanks for that, Jimmy, by the way.
Yeah, I think the Qs are the best way to play AI. So if you want to have a more defensive way, JEPQ, it sells calls on the NASDAQ 100.
All right, appreciate that. Kevin Simpson?
MPC, Marathon Petroleum, we love energy, especially the refining space. This is a stock that will benefit from global consumption that hit record highs last year. We expect the same in 2020.
Jimmy, are you the Russell?
I am. I think senior markets correspondent Mike Santoli is right on it.
All right, and Jason Snyder.
Caterpillar margins are improving drastically. Take a look.
All right, so S&P 500 is holding quite nicely above 5K. Of course, all comes down to what happens at the close, and I'll see, of course, as we take you through the last hour on Closing Bell.
Hi, everybody. I am Brian in for Kelly once again. Here's what's ahead. It's been a big week for semiconductor stocks. And there is one name in the group that may not be getting all the attention from Wall Street, but it is getting lots of love from our market guest. He'll name it and tell us why. Could we be in for a spring selling season surprise? Yes, says real estate broker and TV star Ryan Serhant. He is here with the trends he is seeing. Plus, a special 3 buys and a bail Super Bowl style. We are talking streaming, snacking, and of course, boozing, as we are counting down to the big game. All that's ahead. But as always, let's begin with today's markets. Dominic Chu and how we're looking. Dom.
We got a record high in the S&P 500. Stop me if you've heard this before, Brian, but we're currently sitting at the S&P at 5,018, 5018, up 20 handles, or roughly 0.5%. And at least I get to draw a little star over here as well, because again, record highs for the S&P 500. The Dow Industrial is down about 0.25%, about 79 points to 38,643, and the Nasdaq Composite really, that tech trade continues to just motor and motor and motor. The NASDAQ composite currently at 15,971. That's up 178 points, or north of 1% gains there. So again, some massive moves there, mostly related to technology. Now, one other place we're keeping a close eye on is what's happening with Bitcoin, cryptocurrency in general, but Bitcoin specifically, because at these levels, if we were to close here, it would be just about a record high on a closing basis
I'll be right
for
back.
Bitcoin prices that have seen a nice little surge over the course of the last 5 to 7 days. Now, you may recall that back on January 11th, we did get above 49,000 briefly for Bitcoin prices. So on an intraday basis, we're still a couple $1,000s away from there, but still watch Bitcoin prices and some of the stocks that are tied to that Bitcoin ecosystem. And I mentioned that outperformance in the tech trade. A slew of the big name tech companies that are out there are making some record highs today, including Microsoft for one. But also check out the one-year charts on NVIDIA, Applied Materials, and the SMH, which is the VanEck Vector Semiconductor ETF. Every one of those stocks has been up pretty decently over the course of the last year. Of course, NVIDIA is a huge part of that story, but each of these gets a star as well, because Applied Materials, NVIDIA, and that VanEck Vector Semi ETF all made record highs today. Just look at those performances over the last year. The blue line really stands out, Bri. I know you got a lot more on that coming up later on this show.
You just inadvertently made the Chicago flag, by the way, with the colors and the stars.
And then the 3 stars. I needed them to be red, right, at some point, kind of in there.
Chicago's amazing. We love. My wife's from Chicago.
We love Chicago.
Yeah, we love Chicago. Not in the winter, but we love Chicago. Dom Chu, thank you very much. All right, despite the big gains in the semiconductor trade already, your next guest says he is still finding some value in certain parts of the market, and maybe one chip name. Joining us now is David Bahnsen. He is Chief Investment Officer of the aptly named Bahnsen Group. David, good to have you on The Exchange. I am Brian. I am not Kelly. Texas Instruments. It does not get a lot of love. It's been around forever, just kind of sits there outside of Dallas and does its thing. Why are you interested in this name?
That's the exact reason why. We love names that are not fully understood, that people are not paying attention to. It has a market level beta. It isn't way above market beta like most of these names might be. It's trading at 22 times earnings, not 60 times earnings. And it's, most importantly, a big dividend grower. That's what we do. We run over $5 billion, and dividend growth is our key strategy. Texas Instruments is a heck of a dividend grower. And why are they able to do that? They continue to grow their free cash flow. It's just a more attractive way to play some of that space.
Yeah, is there something specific about it? Is their business mix, David? Is it their valuation that's, to your point? Is it kind of the fact that, as we both alluded to, they don't get a lot of attention, or maybe D, all the above?
It is D, all the above, and I also think, too, the fact that it came back a little bit last year. It came in, when we entered the name, it had come down about $20 a share, so we liked the fact that we had a more attractive entry point. But again, you have a 3.3% dividend yield in a space that has largely ignored dividends, and they're growing that dividend at 8% per year. And I think on a valuation basis, it's a wonderful way to play the sector.
I saw David Simon, who does not do a lot of interviews at all, the founder and CEO of Simon Property Group, on with Jim and Mad Money the other night. A fascinating interview, in part because despite all the talk about retail's woes, Simon Property Group is like 96% full. They tend to have very high-end malls, and now, of course, they've got this international expansion. Simon, even with all the concern about retail and commercial real estate, David, is a name that you like.
Yeah, we've owned it for years. And so this Texas Instruments is a newer name. Simon Property have owned a long time. They're 96.4% occupied, to be precise. And new leases are averaging 7% rent growth over prior year. They are a phenomenally run company. They do own higher end malls, higher quality. And where there has been trouble, they have over and over again been able to create economic value by repurposing some of the brick and mortar, some of the real estate. They own great assets. I just think Simon Property was largely misunderstood. Here you're talking about now a 5.5% yield, but we're getting over 20% per year cash on cash from when we first entered the name because of their ongoing dividend growth. And they are basically a balance sheet play. They have a wonderful balance sheet of assets with debt that is under 50% of a ratio.
Wow, yeah, just truly, it feels like SPG has just done something that a lot of others certainly have not been able to do. Do you have a macro view on the markets? We're sitting at over 5,000. We're at record highs. You heard Dom Chu walk through all the numbers. Nobody seems to care about valuations. It's just about, buy at the highs and keep riding it. Do you think this momentum can continue, David?
Well, the answer is yes, it can, and I also believe no, it won't. And so we don't really believe that people should ignore valuation. And I grew up as a professional investor in the 90s, and we learned what happened out of big tech. The amount of similarities from that dot-com moment right now are frightening to me. 72% of companies in the S&P last year underperformed the S&P, highest in history. You have a couple of names in the Magnificent Seven that their market cap is bigger than all of Japan and Britain and Canada put together. Okay, some of these names are phenomenal. They're better cash flowers than those names in the late 90s were. But at the end of the day, it's a valuation story. But you say, can it continue? Sure. I'm not timing this. I'm not telling people next month these things are coming down. But I don't want to buy NVIDIA at 70 times earnings. I don't want to buy Amazon at 55 times earnings when I think there are other value-oriented names that can do better. And for as good as 2023 was for the index and for big tech, Mag 7, et cetera, they're basically broken even over 2 years. You have one really bad year, one really good year, and it's about flat. And that choppiness is not a way.
That is an amazing point you're making, David, because I just posted something about, I was bullish on Japan. Nobody cares what I think. 2 years ago, turned out to be not bad. And I look back and I was trying to compare the S&P to the Nikkei in Japan, and the S&P is only up 4% since December of 2021. I mean, it's been a heck of a run the last year and a half or year or so. But to your point, we fell, and if you just bought the S&P 500 with inflation, you're actually flat to probably slightly negative.
That's right, and the S&P wasn't even up at the end of 23 from its high of late 21. It's only up a few percent now just because of the first month or so of this year, and so that's fine, but I just think this is a historical pattern, that you have a huge bull market, you have a correction, and then you have years of a flat market, a consolidation. That's generally a very good time to be in the dividend names, to be in more value-oriented names. I'm not recommending people get out of the market altogether. There are positions, places to be. But there was a free ride for 12 years, Brian, for index investors, with the Fed at ZIRP, with QE, and with really kind of reflating the economy post-financial crisis. That bull market is totally over. Right now, what's the news story? Well, maybe AI is going to continue and 70 times earnings we can grow into. But that's not going to be every name. There's going to be a lot of names that end up in a graveyard. And to me, I'd rather be more fundamentally oriented. A name like Simon Property is sort of removed from all this. It's got a totally different story, and we think it has repeatable cash flows that investors are going to like a great deal.
SPGTXN, and a little bit of good historical context and maybe kind of a warning about the market. David Bahnsen with the Bahnsen Group. We appreciate it, David. Have a great day and a good weekend.
Thanks, Brian.
All right. Meantime, shares of New York Community Bank Corp down more than 20% this week after reporting commercial real estate charge-offs that scared a lot of investors. Now, the stock is getting a bit of a boost today because some of the directors and executives buying shares, a lot of insider buying this week. The KRE Regional Bank ETF still negative on the week, but your next guest says the concerns surrounding NYCB are more about the bank itself and less about regional banks or commercial real estate in general. Joining us now is Ron Camden. He is the Morgan Stanley head of U.S. REITs and commercial real estate research. Ron, you make a great point looking at some of your notes, which is that, and this is a little bit wonky, but it's important. Once New York Community Bank Corp bought some of Signature Bank's assets, it catapulted them over $100 billion in assets, which changed the way they are scrutinized by regulators. How big of a deal is that part of the story?
Yeah, thanks for having me on. And I was just catching up with our mid-cap banks analyst, and I think you're spot on that the event that happened in NYCB is idiosyncratic because it's very unique for that bank to move from a different regulatory bucket into a higher Category 4 bucket where there's more sort of provisioning and regulation involved. So we think that's actually what catalyzed the provision surprises that you saw, and we do not expect that to translate into some of the other sort of regional banks in the sector.
Yeah, so I guess I'll flip it and I'll ask you to speculate, Ron. You can dodge if you'd like, but if NYCB had not bought those assets, if they were still below $100 billion in assets and scrutinized and sort of examined and regulated as that classification, not class 4, do you think we would have seen the magnitude of the decline in the stock?
Yeah, it's a really good question. So when you think about commercial real estate, usually these loss realizations happen over time, right? Over a 2 or 3 or 4 year period. And the two things that we have to remember this cycle is that, number one, commercial real estate is a 13 trillion asset class, but only about a quarter of it is office, right? And number two, most of the biggest lending that happens on commercial real estate does happen in the smallest banks in the US. They do about 27% of the lending. So to answer your question directly, I think that provision process could have taken a longer period to play out, but make no mistake, we do sort of still expect commercial real estate values and office specifically to continue to decline this cycle. So we would fully expect the banks to continue increasing those reserves and increasing those provisions over time.
Is NYCB, with the massive sell-off, a good deal? Is it a buy here?
Yeah, it's a good question. I don't cover it personally, so I can't comment on it. What I will say is that these commercial real estate issues is not something that's going away overnight. The price discovery process does take 12, 24 months to play out. So I wouldn't be rushing into anything whenever I'm dealing with commercial real estate.
So you think there still may be time in the sector, because you're the REIT guy, that in the sector may still have some cleansing? Because, Ron, when I look at the numbers, and I know a lot of people predicted commercial real estate doom last year. It did not happen. Some good properties are able to get refinanced. They can just keep pushing, pushing, pushing. At some point that comes to a head, and there's big numbers coming up through 2025. Do we see another leg down overall?
Yeah. So you make a really good point, Brian, because when you think about what's the catalyst to drive a lot of the commercial real estate market, you have to think about commercial real estate maturities. So there's about $660 billion worth of debt coming due in 2024. 20% of that is office, and 40% of that is multifamily. So when we're investing in the commercial real estate market, we've told investors the office sector is where you have the most secular headwinds, and that's where you're likely to see the biggest downside surprise. So that's a sector you want to sort of avoid. But there's other aspects of the commercial real estate market, being industrial, being retail, being senior housing, where there's still sort of opportunities for investors to buy really good quality companies with good sort of earnings growth. So it's important to just remember that there's a diversification to the commercial real estate market, and this cycle, the risk is acute to one sector.
Yeah, and I feel like there is definitely more to come, but a great analysis on NYCB, because that has been a big story. Ron Camden of Morgan Stanley. Ron, have a great weekend. Thank you.
Thanks so much.
All right, take care. All right, coming up, speaking of real estate, we're going to get a real estate reality check with the star of $1 Million Listing New York, Ryan Serhant. He has got a new show coming out on Netflix. He just wrote a book, and he's going to break down some of the trends he sees right now in housing. Plus, a special big game edition of 3 buys and a bail featuring streaming, snacking, and spirits. The Exchange back after this.
This is The Exchange on CNBC.
right, welcome back. As we approach the spring selling season, also known as spring, the housing market still faces a host of challenges. Home buyers still facing higher mortgage rates than a couple of years ago, and there really are just very few good homes or condos out there for sale as people just sit and don't move. So let's figure out what's going to happen, not what has happened, and get some insight from one of the most powerful power brokers in America on what he is seeing on the ground. Ryan Serhant is founder, CEO, and broker at a firm named Serhant. Amazing how that works out. He's also out with a new book this week called Brand It Like Serhant. Ryan, it's good to chat with you again. There you go. You got the Netflix show. It's just firing on all cylinders. But is the real estate market going to fire on all cylinders in 2024?
So far, this has been one of the busiest starts of a year to my entire career. I mean, new listings nationally are up just under 7% year over year. Doesn't sound like a lot, but compared to 2023, feels great. Prices are up about 5%, right? Rates are still keeping inventory down, but sellers are feeling less locked in than they have over the past 24 months, even though 90% of all home loans in the United States are at or roughly under 5%. People feel a bit unlocked. That's my word of the year so far, is unlocked. This year is going to be unlocked, and it's so far moving pretty quickly.
Now, let's be clear. Patrick Mahomes is having a pretty good year in football. He's going to play on Sunday with Brock Purdy. You're the sort of the Mahomes of real estate. You're at the top. You're at the top, and so I wonder, can Ryan Serhant's experience in 2024 be sort of explanatory for the rest of the country, right? I mean, for the broker in Ohio, what message would you send to him or her? Because they've probably had a pretty rough run the last couple of years.
I'm not so sure about that. I think inventory is low, sure.
Nothing to
so
sell.
I think but a deal volume is lower. But I mean, in Ohio, where I hope to open a Serhant soon,
nice.
That deal time on market is still incredibly fast. I mean, nationally, most homes are still sitting on the market for less than 2 weeks. I mean, that's very, very fast. Yes, there's a lot of luxury movement in the luxury markets we're in. I'm talking to you right now from our headquarters in Soho, and the average time on market is still just under 6 months, and the prices are higher, right? The luxury market's been moving really, really quickly. There's been multiple, 8, 9-figure deals between here and our South Florida markets, but the national housing market, I think, is starting to really come back to life. I think as rates slowly start to stabilize or tick down, according to the Fed announcement, I think we'll see a lot more life. People have to move on. You can't sit there and complain all day long. And if we look at history, markets go down, markets go right back up.
If interest rates go down, and they might, because to your point, the Fed has sort of forecasted it may target, cut a couple times this year. Will prices also go down nationally with it?
No, they'll do the opposite. Prices will go up. I'm seeing it from, we're Serhant's in 8 states right now. We just expanded into Georgia last week, and we started to move west. And from all of the sellers we're speaking to, they see price increasing as rates stabilize and decrease. They say, this is what we've been waiting for. I thought I was going to sell my home for less money last year, but now I can wait. And so what we say to all buyers is, you can wait for lower rates too, but so is the seller. And you have to understand the math, right? You don't live in the purchase price, you live in the monthly payments. The headline rate right now is just under 7%. And so people will say, well, I'm gonna wait till it gets to 6.5. For every $100,000 borrowed, that 0.5% swing is $33 a month. And so you have people making life decisions over $33 a month for every $100,000 borrowed. People need to look at the entire picture. What is the outcome you're trying to get to? What is that total monthly payment that you're going to live in? There are still great options out there. And I think it's an exciting time. 2024 is turning out to be what I think might be one of the most robust real estate markets that I've ever seen.
What's blowing my mind, and this is, again, you're in Soho, I live in New Jersey. We're lucky. We live in nice areas. There, and we're blessed to be in the positions that we are. A buddy of mine lives outside of New York in a town, basically an ex-burb of New York City, financial place.
Sure.
He sold his house last year. He wanted to list it for 1.6. That's kind of what was in his mind. He'd owned it forever. The real estate agent said, do it at 1.75. He thought that was high. House sold for 1.973 in 2 days, all cash. What's blowing my mind is that about half the deals that we have seen in parts of New Jersey are all cash. So they don't even care about interest rates.
True, there's a significant amount of cash that's sitting on the sidelines. I think we can thank our government for creating so much of it over the past couple years, and that's definitely helped certain industries, has hurt a lot of people in other ways, and that's not for me to talk about. But what I'll say is, pre-COVID, we were doing maybe 20% of our transactions that were all cash. If we really looked at total volume across all price points, today it's well over 50%. In our luxury markets, it's 70% of all transactions that are being done in cash. But then what happens is they're doing technical refis. Right? Is the minute they close, because it makes sense to keep that amount of cash locked up in a hard asset that way, they can put it to work, right? They can put it into the markets. Markets are moving pretty quickly. Bitcoin's back up, people like to make money. And so we'll see what happens. We'll see what happens in November. We'll see where we go from here.
We want people to buy your book, so you brand it like Sirhan. So you forgot about your own book. We got to get the book. We want to get the book in.
All right, it's right here.
Yeah, you got a book. Show us the book. I'm sure you have it somewhere. You wrote it. Anyway, so brand it like Sirhan. We want people to buy it, so we don't want to give too much away. But give us one message, one lesson in there that our audience watching and listening can take away.
The U.S. Bureau of Labor states that by 2027, 50% of the U.S. economy is going to consider themselves in some way, shape, or form part of the gig economy, meaning they're going to be selling something. So maybe they're still taking their W-2, but they're selling something on the weekends. They're selling something at night. Maybe it's real estate, maybe it's software, maybe it's insurance, maybe it's t-shirts. To do that, how do you learn how to actually make an income? Right? My first book, Sell It Like Sirhan, taught everybody how to sell. And this teaches everybody how to build that brand awareness for either yourself as a trader at a bank, yourself as a real estate agent, yourself as a car salesperson, doing a side hustle to create that awareness so that you can generate more leads and make more money. I think building a brand is the skill set of the new economy. I could not find another book that taught me how to build a PR strategy, a TikTok strategy, and understand a core identity and tie it all together. And so I wrote it, and now it's out. And it's the greatest book that's ever been written in the history of the world.
Like better than The Odyssey?
I read The Odyssey, and it was really long, and it took me a long time when I was a little kid. I think it rivals The Odyssey. Rivals The Odyssey.
In scope
I don't
and
know how many
magnitude.
solopreneurs that are 18 years old that are reading The Odyssey right now, but brand it like Sirhan. It's out now. It's really the branding Bible for anybody that wants to build a personal brand or a product brand. And it's incredibly tactical and goes through my entire company's building over the past couple years, all the mistakes that I've ever made. We interview a lot of great people, from Gary Vaynerchuk to Kenneth Cole to Rebecca Minkoff. Amazing people.
It's amazing. You just threw out Gary Vee, because Gary Vee, I'm just filling in on this Kelly show. I have a show at 7 p.m. Gary Vee is going to be on Last Call, my 7 p.m. show tonight. Had no idea you're going to throw that out there. It works like that.
He's got great quotes in the book.
Fantastic.
He's a branding maestro.
Better than The Odyssey, Gary Vee. I appreciate it. Ryan Sirhan, thank you. Good stuff. Good luck with the book.
Thanks, man.
All right, appreciate it.
Thank you.
All right, not quite as good as Crime and Punishment, but that didn't have a happy ending. Coming up, our mystery chart of the day, having its worst day in over a year after an earnings miss. There's your chart. Tweet us at the show or at SollyCNBC. Take your guesses. We'll reveal it later on in the show. We're back right after this.
Good day and welcome back to The Exchange, everybody. I'm Tyler Matheson with your CNBC News Update. The European Commission will reportedly open an investigation into TikTok. That is according to Bloomberg. The probe would launch under the new Digital Services Act over concerns the company hasn't made enough changes under the law's mandate to protect underage users. America's three biggest banks collected 25% less in overdraft fees last year as they face pressure from regulators to reduce those charges. That is according to regulatory filings. JP Morgan Chase, Wells Fargo, Bank of America reported a combined $2.2 billion in overdraft fees in 2023, roughly $700 million less than in the previous year. And an update on a story we first brought you yesterday. The Frenchman who built this 23-foot model of the Eiffel Tower out of matchsticks originally denied the world record by Guinness because he used the wrong kind of matches. Well, Guinness has reversed course and today said it considers the record valid and within the world. Bravo, La Tour Eiffel. Brian?
That's an important update. We talked about it yesterday. I'm glad you could bring it back to us today.
Wanted to close the loop on it there.
I feel so much better. I didn't know how I was going to sleep tonight.
You could call it Paris Match, couldn't you?
Oh man. You know what? You got to strike.
Deep into the archive.
You got to
there,
strike
man.
while the iron's hot, or the match. Here we go.
See you,
Tyler Matheson, thank you. All right, coming up, Chiefs and 49ers players are speaking out on business. And they're talking Elon Musk, artificial intelligence, and yeah, even the Federal Reserve. Contessa Brewer is live in Las Vegas talking about the Federal Reserve. Contessa.
That's right, Brian. And boy, this was a fierce battle, head to head. I got the Super Bowl teams to tackle tough questions. And look, Wall Street might want to listen up. The Exchange is back right after this.
Here's some breaking news. We're 2 days away from the Super Bowl. And between the brands, the booze, and the bets, it is no exaggeration to say there are literally Billions of dollars at stake here. Lives are on the line. We've got full team coverage. Julia Borstead is the advertising angle. Gina Sanchez is the trade on 3 names to buy and 1 to bail on. And Contessa Brewer is live in Las Vegas with the business talk of the town. But Julia, let's start with the ad side and just how big it really could be.
Well, Brian, despite the rise of streaming and cord cutting, the NFL is as big as ever for TV advertisers. Around 70 30-second spots sold for an average of $7 million. That is in line with last year's record cost for Super Bowl ads. It's also up 75% from the cost of a Super Bowl ad a decade ago. Group M telling us that 20% more of their clients were interested in Super Bowl ads this year after last year's record 115 million viewers for the game. Now this year we expect advertisers to avoid controversy. Celebrities from Lionel Messi to Serena Williams will again be front and center after last year 40% of commercials featured multiple celebrities. Expect more ads, including from e.l.f. Cosmetics, targeting female viewers that Taylor Swift has brought to the game. We'll also see a jump in candy brands, at least 6, which is a record. But not all Super Bowl ads are going to be on television. Streaming-only ads on Paramount Plus cost $1 million for 30 seconds, drawing Ally Financial, Dannon, and Stokey Cold Brew, among others. Now, Ally saying, quote, more and more of our target audiences, millennials and Gen Z, are migrating to streaming each year. We're being smart with our own money by more effectively engaging our target consumers. Now, this follows the NFL streaming a record number of games this season, a trend we are examining in a new documentary launching today on CNBC.com, looking at the NFL's digital transformation, the risks it's taken to boost its viewership. Brian?
There's an anchor on this network called Kelly Evans, and she's usually sitting right here, as a matter of fact. And she tweeted out something today, Julia, about how if every like a bunch of products, if they followed the ad inflation rates, like a chicken wing would be like $60 and a pizza would be like $150, because there's just no end to demand for Super Bowl TV ads. People are paying a ton.
That's right. I mean, and it makes sense that there would be more ad inflation in Super Bowl TV ads than in chicken wings, because overall, you've seen that overall TV ratings have declined, but ratings for sporting events and specifically for the NFL and the Super Bowl have gone through the roof. This is what we're examining in the documentary. You've got to check it out, Brian. We talk to folks from the NFL, from Amazon about their big deal about Peacock. They had record ratings for their streaming games. So the idea is the NFL is trying to go to where their viewers are and where consumers are, but there are some big risks they've taken, some frustrated fans, and then a whole new audience that has found the game through some of these big deals.
So you're saying you have a documentary out on, where do I find it?
I do. CNBC.com. You can also find it on YouTube.
Do I need to put in the http://?
No, I think you could just go to /game-plan. You're going to find it. I know you'll find it. Just Google it, Brian.
I'm going to bing it. I'm in a mood. I've been on TV 14 hours a day, every day this week. Julie Borstead, thank you. Appreciate it. All right, it's // Speaking of the Super Bowl, streaming, beer, snacks, pizza, they're all essential, of course, ahead of the big game and even during the big game. And your next guest is here with 3 names that you should buy and the name to avoid. Joining us now, 3 buys, Annabelle, Gina Sanchez, Lido Advisors, Chief Market Strategist, CNBC contributor, and somebody said to deal with my terrible sense of humor for about 15 years now. Gina, it's good to see you. First Buy.
Good to see you.
First Buy is a name that is close by, literally, to your home in LA.
Yep, right over in Burbank. It is Disney. And quite frankly, streaming generally is a great buy. And Disney, obviously, this is more attractive on a valuation basis, but for a reason. They've had a lot of struggles with their attempt at a succession plan that did not go well, pandemic, et cetera. But you're starting to see Disney earnings really start to stabilize. They're narrowing their losses in streaming, and they just announced a massive deal, a joint venture with Fox and Warner Brothers to offer the ultimate cord-cutting sports package. And most people who subscribe right now to cable television are mostly just subscribing for sports at this point. I think Julia's ad commentary absolutely supports that. And so if you look at the potential and also the $1.5 billion investment into Epic Games to bring their IP content into the gaming space, I think these are big announcements, and they're not priced into Disney stock yet.
All right, you got two more buys. I'm going to do something. I'm just going to break trend. Why not? And combine them, because I think that Constellation Brands, the biggest spirits and booze producer out there, and Pepsi, obviously soft drinks. Some people don't drink. It's fine. And snacks kind of go together. I feel like this is a food and drink play.
Yes, it's absolutely a food and drink play. And ultimately, what we were looking for was good growth, healthy balance sheets, and good valuation. So you look, for example, at Constellation Brands. They have a 30% profit margin. You look at Pepsi. I think Pepsi is largely was written off because they thought everybody was suddenly going to change their dietary trends, and all of these diet drugs were going to make people not eat, snack food. Well, guess what? Junk food is still a big business, and quite frankly, Pepsi has a very, very broad category of foods and snacks, including Aquafina water, Sabra hummus, which is a great way to sneak in vegetables, Quaker oats, healthiest stuff on the market. The growth expectations and margins also for both of these names are really strong.
But yet your bail is also a food play. A lot of people are going to be just buying up tons of pizza. They may buy the pizza, but you say don't buy the stock of Papa John's.
That's right. Domino's has become the really, really big behemoth in pizza. Papa John's, on the other hand, this is a mid-cap play. This is one where expectations for growth next year are not that great, and their margins are really, really tight. And so, we're looking for a little more breathing room than that in the pizza play.
Yeah, and I mean, BTIG does see it as kind of a turnaround story, but, down 4% year to date. To your point, it sounds like, just pardon the pun, DPZ's going to eat Papa John's lunch.
Absolutely. This is feeling like a value trap.
Okay. Gina Sanchez, 3 buys and a bail. Have a good weekend. Enjoy the Super Bowl, Gina. Thank you. All right, now let's get to where the Super Bowl actually is taking place. Wherever Contessa Brewer goes is automatically the Super Bowl. Doesn't matter what sport it is, what event it is, it automatically elevates to that level. Contessa, would you agree with that? Wherever you go, it is the Super Bowl.
Flattery gets you everywhere, Brian, everywhere, at least with television talent. Look, here was the great thing. I got a chance to sit down with all these players and ask them some really tough questions. I asked Niners QB Brock Purdy whether being underestimated as a long shot was actually an advantage. His short answer, yes. I asked Chiefs coach Andy Reid about the serious warnings about gambling to his players and to his staff. And then I really got down to business. What's your expectation of a Fed rate cut this year?
What was that? I think they're doing a soft landing.
Timing-wise?
Timing-wise, probably end of the month or early Q2.
I hope it happens, honestly. I bought my home last year, so I missed the train on that.
I think towards the later part of this year, maybe Q4, we'll see a rate cut. Obviously, Jerome Powell has continually fought against that, but I think he's just trying to signal the market not to get too hot. Crypto still has a part, for sure. It definitely has slowed down.
I was never with crypto and just still learning about AI.
I'm into more crypto. Yeah. I'm personally not a fan of crypto. I feel like it's too volatile for my portfolio.
As far as AI and crypto, I made a couple grand off of NFTs, but then I realized that they were kind of scammy, so I stopped doing that.
Technology is crazy. I wouldn't be surprised if I have a clone sitting next to me in the next couple of years.
You invest in the S&P, all of those 500 companies, plenty of them are investing in AI, so you cover your AI basis. You don't got to be too risky.
Elon Musk as a leader, yes or no?
I think he has shown the ability to build up companies, obviously. He's a little eccentric, and so I could see as a shareholder how he would scare you, but maybe he's a genius. Yes and no, I feel like he created the entire company. His ideas are the reason the company exists. But at the same time, now I feel like he's ready to move on from it.
Which do you think has brought more fans to NFL? Gambling or Taylor Swift?
Taylor Swift.
Taylor Swift, no doubt. Taylor Swift. I think it is sports gambling.
Taylor Swift or sports gambling across the nation?
I don't know, but that's a deadly combination.
Speaking of Taylor Swift, FanDuel CEO Amy Howe told me on Squawk Box this morning that bets on Travis Kelce have doubled, and that, of course, then they're seeing more women gambling on the platform as well. And Caesars told us that so many bets, more bets have come in on Travis Kelce to get a touchdown, Brian, than all of the San Francisco 49ers money line and spread combined.
Well, that's good. Listen, I wonder, and I should probably check my account, if you can bet. I'm sure somebody would take a bet, maybe it's on these apps, on how many times they're going to show Taylor Swift, you know, on the television feed. It'll definitely be the beginning of the game. Anytime Kelce catches a pass, he scores.
Not in the United States and not on regulated sports books. You will find that in other countries and in offshore illegal sites. But listen, the gambling industry is really serious about this. They said all this talk about, you know, is Taylor Swift going to get a ring? Those bets are being made on platforms that are not regulated in the United States.
Like a Super Bowl ring or like a spend the rest of your life with me kind of ring?
I think, yes, I think show me the money kind of ring.
Yeah, I'll tell you what, if the Chiefs, I think the Chiefs are going to win. And when they win, and if they win, it's going to be like the Taylor Swift effect, if it couldn't get any bigger, is just going to get much bigger. And by the way, I understand it's like, it's warmer here than in Phoenix right now. I understand it's not hot there.
You know what, I don't know if you can really tell behind me, but Mount Charleston has snow down to the 3,500 level. I mean, this is a view that we just don't usually get. I don't know, Jerry, can you broaden it out a little bit? We don't usually get this in Las Vegas where, one, you need a coat, but also they're talking about, should we go hiking in the snow? Should we, you know, like, is it safe to go out there? The mountains are beautiful in the backdrop of Las Vegas, Brian.
Yeah, I'm sure you'll be right. I'm sure you'll be scaling
shot.
the summit momentarily, Contessa. It's
me and my winter boots.
51 degrees in Inglewood Cliffs, New Jersey right now. 47 degrees in Las Vegas. It's warmer in New Jersey than Vegas, which would be good. You don't want it 100 degrees. Good stuff, Contessa. We'll see you soon. Thank you. All right, coming up, 90 days, 5,200 square miles, and $11 million. For this, it is a sonar image of the Pacific floor and what could be a key part in the hunt for Amelia Earhart. The story next. All right, got to give you a quick update on these markets because while the Dow is down a little bit, we are at record highs on the S&P 500. Remember, yesterday we hit 5,000 for 4 seconds, right literally at the end of the trading day. I mean, a couple seconds before the close, then it adjusted, ended up below that. But the S&P 500 is up 0.4% to 5,020. The NASDAQ is up. And by the way, the 10-year yield is also up. So stocks and yields up at the same time. Sometimes we don't see that too often. All right, coming up, a nearly 90-year-old mystery may be one step closer to being solved. The leader of the team that may have found Amelia Earhart's airplane. All right, welcome back. Where does a former Air Force intelligence officer, private pilot, tech entrepreneur, attorney, commercial real estate investor usually end up? Apparently at the bottom of the Pacific Ocean. At least your next guest did, sorta. And he thinks he may have found Amelia Earhart's plane. Joining us now is chronic underachiever, Tony Romeo, founder and CEO of Deep Sea Vision. Tony, I'm fascinated by this story. Thanks for coming on. It's been an 80-year search. Theories abound, from coconut crabs doing their thing to Howland Island. There's even a little rock there in her honor. What have you and your team believe you have found?
Well, we always believed that she fell. She landed very close to Howland Island. We looked at all the evidence that we had. We didn't take anything away. We didn't add anything to the evidence. We looked at just what was out there. And our conclusion, as well as many others that have studied the story very carefully, was that she landed very close to Howland Island.
Basically a navigational error. They just screwed up, maybe forgot to reset. They had this thing, a calendar, which could, basically it's how you navigated back then. Probably just ran out of fuel and had to ditch it in the water. Is that kind of summing up what you think?
Yeah, that's it. So she took off on July 2nd. She flew into July 3rd, and just after midnight, she flew back into July 2nd. She crossed the international date line. Her navigator, Fred Noonan, who was one of the best in the world, had he forgotten to change the calendars back a day on his for his celestial readings, it would have thrown him off by a significant distance. Not far, but enough that she would not have seen the island.
So have you spotted something? I mean, because I would also imagine that, and as a big fan of World War II history, actually reading a book now about the Japanese and World War II and air battles, got to be a lot of downed World War II aircraft around that region.
There's a lot in the Pacific, just not in that area. The Pacific's huge, right? There we've got, I mean, all the way from Japan all the way down to Argentina. I mean, it covers a huge amount of area. The place that we were was in the Central Pacific, Howland Island, which is about right on the equator, which was not the site of any known World War II battles. The Japanese did strafe the island actually immediately after Pearl Harbor, but there's no known shipwrecks. There's no known. In fact, there's not even any flight paths or shipping lanes to the area. When we were out there, we rarely. I think we saw 2 boats in 3 months, and we saw 1 or 2 planes flying over at way 50,000 feet. But other than that, I mean, it's a part of the world that really nobody goes to.
Oh, you went there. It's amazing. And listen, we'd love to put some closure on this. And if she was able to just kind of, bring the plane in gently, given the depth of the water, given the frigidity of the water, it would seem, Tony, and tell me yes or no, because you're the scientist, I'm not, that if you do find the plane, it should be in relatively intact condition, I would hope.
Yeah, that's right. She would have landed it as softly as she could. She would have turned the nose of the plane into the wind, slow the plane up as much as she could to land it on the waves. And then there's been other Lockheed, exact same plane that have crash landed in the water that have remained intact. It was a strong aircraft. We expected it. She likely, unfortunately drowned in the plane or went down with it or got out and maybe survived a little bit in the water, but it would have spiraled down to the seafloor, and then it would just rest on the seafloor. And there's been a lot of folks that said, well, wouldn't the pressure crush it? Well, sure, a pressure will crush something with air inside of it, but
it had no air. It was filled with water.
Exactly.
So how deep is it, and could you get it? If it, I mean, are you able to extract it?
16,000 feet. We possibly can. There's no. Yeah, it's like a 747 on every square inch of your body. I think so. I think we'll be able to. It depends on the conditioning. Over time, the rivets and things will probably have softened and weakened. The plane will probably not be in its same strong condition that it was on the day that she disappeared. But yeah, we expect that it's the aluminum will still be there. It's not going to have disintegrated. The temperature and the water, at this depth is very stable. There's no currents. There's not going to be a lot of erosion and wind. I mean, it's very stable, very cold water.
Amazing work. 16,000 feet. My gosh. I mean, over 3 miles down. That is just tremendous. Good luck to your team, Tony. Keep us updated on this because I just find it fascinating, and Godspeed, and hopefully you can solve it.
Thank you. I appreciate that.
All right. And they are in the middle of, literally the middle of the Pacific Ocean. Amazing. All right, folks. That does it for the exchange. I'll see you for last call, 7 p.m. Eastern, 4 Pacific, and have another great show for you. Gary V's on, etc. The Power Lunch starts on the other side of this quick break.
It's your Verizon.
Welcome to Power Lunch, everybody. Alongside Morgan Brennan, I'm Tyler Matheson. Welcome, Morgan. Good to have you here. Coming up, $7 trillion and a dream. OpenAI's Sam Altman has some ambitious plans for the future of his company and what is needed to power that dream.
Plus, getting ready for the Super Bowl, the cybersecurity threat surrounding the big game. The cost of the wings and nachos. We're going to talk to a former Super Bowl champ as well about what he expects to see on the field Sunday night. But first, let's get a check on markets because it is a bit of a mixed picture here with the Dow under pressure, but the S&P firmly trading above that 5,000 mark, up about 0.5%. Tech really leading the charge here. Shares of Pepsi are falling today after the company surprised Wall Street with a drop in revenue, even though it did beat on earnings and raised its dividend.
But the action today is clearly in big tech as AI ambitions just get bigger and bigger and bigger. And Sam Altman says the limitations of current chips are holding back his company's growth. Our team is on every angle of this story and what may come from it. Deirdre Bosa, Steve Kovac, Christina Partsinevelos. Deirdre, let's start with you. What do we know about Altman's ambitions and the price tag he has put on them, or someone has?
Tyler, we know that they are mind-boggling. This is like the moonshot of all moonshots, and I'm going to use Google's definition here. A moonshot is something that sounds undoable, but if done, could redefine humanity. That is what Sam Altman is reportedly looking at. Let's start with the number. According to the Journal, it could require up to $7 trillion. That is 7 times the expected size of chip sales in 2030. It's more than the combined market caps of Apple and Microsoft. It's 7 million millions written out, 12 zeros if you're counting. We'll put it up on the screen for you. Yes, we could barely fit it on one screen. Now, the project itself is aimed at reshaping the world's chip-building capacity. Altman is going after one of the most complex, expensive, and geopolitically sensitive industries in the world. And it's a project that would create an equally complex partnership between OpenAI, chip makers, investors, power providers, and governments. Perhaps the most interesting part of this is the why. OpenAI and Altman are on a quest to develop AGI, or artificial general intelligence, which OpenAI defines as systems that are broadly smarter than humans, and so has the ability to teach itself, thereby creating new, even potentially smarter AGIs. Depending on who you talk to, that could ruin humanity or could supercharge it. A lot would need to fall into place for any of this to happen. There are still a ton of questions that I know we're going to get into. A few of them, though, if chips are a national security issue, do we let Abu Dhabi fund a new landscape? Because you're going to need sovereign wealth money for this. Can a software CEO lead the charge when others, notably megacaps, chip companies themselves, struggling to catch up to NVIDIA? And how do you raise $7 trillion? Guys, I was trying to figure out, what do you think the valuation would be of a $7 trillion investment?
You got me, but we'll come back to you in just a bit. Why don't you ponder that for a minute, Deirdre? Joining us now on set to discuss this is CNBC's technology correspondent, Steve Kovac. I'm guessing if this is as big as these numbers suggest, that this has to have a major governmental drive behind it, one way or another.
Exactly, and Deirdre alluded to that too, the possible security issues. Let me just read, I asked OpenAI about this, and a spokesperson told me, I'll just quote here, we will continue to keep the U.S. government informed given the importance to national priorities and look forward to sharing more details at a later date. So they are taking that into consideration. They are talking to authorities, at least that's what they say they're doing, but we know what the U.S.'s position here is. We've had those chip sanctions going from over to China. That's been kind of hurting NVIDIA a little bit and other chip companies, unable to do business maybe in China in the same way they were, because this technology is seen as so fundamental to the future. It really is
and so
a
national
race.
security
and
important.
National security and you name it, all down the line. So all that gets tied up in there. We're talking about the $7 trillion whiz-bang, oh my God, number.
Where did that number come from? Was that a number he put on the investment?
That's, I guess, that's what the Journal's reporting. That's what apparently he thinks it will take to do what he wants to do here. But who has this is a question I would have for Deirdre here, is who has the $7 trillion besides governments? It's not, VCs
Sovereign
can't
wealth
do that.
funds.
Yeah, sovereign wealth funds.
Sovereign wealth funds would have it.
And there aren't too many sovereign wealth funds that, the U.S. government would be cool with us.
Or a consortium of sovereign wealth funds.
But for that, you'd have to go to the Middle East.
Yeah,
Get
but
rid of the Middle East,
arguably,
which they're doing. Singapore.
But arguably, the UAE would be one of those that would potentially make sense and check a lot of boxes. And to be very, very clear, and I can say this from many of my conversations on the national security side and my interviews on the record with Gina Raimondo, the Commerce Secretary, 100% without a doubt, semiconductors are a national security issue. They're only becoming more of a national security issue. It also speaks to a broader industrial policy here in the U.S. That is much more national security focused. But the other piece of this, of course, is going to be the electricity and the energy needs that are associated with all of these semiconductors and all of this AI compute power too. And I'd imagine that would be part of the conversation you're having with, say, sovereign wealth funds or like a UAE that is energy rich.
Exactly, and that comes down to oil, doesn't it? And fossil fuels, and you know that's not what the Silicon Valley ethos really would want from this. At the same time, so this is ambitious. Like ambitious is not even the right word for it. It is almost ludicrous.
Mind-boggling. That's what I keep going back to. I can't think of a better word.
Yeah, and I mean Deirdre covers VC funding quite a bit. I mean, Deirdre, when was the last time you heard a deal, a round of funding even approaching $1 trillion?
I thought a lot about that this morning, and it has to be SoftBank's Vision Fund. That was a $100 billion fund that was bigger than anything we ever saw before, and this is magnitudes larger. And that completely reshaped the venture capital world, the startup world, led to supercharged companies like WeWork. Can you imagine what this would do to some of the chip companies?
Let's move to the chip side specifically of the equation, and how Altman's plan could affect the existing chip heavyweights, since we know some of the reporting suggests that they would be involved in this process. Christina Partsinevelos has that side of the story from the NASDAQ. Christina, what is your reporting unearthing on
That's
this
a good point. I haven't got them.
Dynamic?
I need to
it's funny because you use the word could, and I'm going to stick with that because, like everyone's alluded to, it is quite a mind-boggling number. But if, I'll use the word if, the funding does come through, this could bode well for equipment makers like Lam Research, KLA, Applied Materials, which already could also get an additional boost because of CHIPS Act funding. Morgan, that you just talked about, we're expecting more awards to be dispersed in the coming 2 months or so, so that's a positive for a lot of these names you're seeing on your screen. There's also strength possibly in the chip designer, simulation, and verification firms like Cadence Design, Synopsys, and so that's the reason why you're seeing Cadence and Synopsys up higher today, because of those two leaders. Even ARM, which we saw a surge, just after its earnings report, this stock is up again 2.5%. But look up, week to date, 65%. They make the blueprint for a lot of these chips. So if all this funding is coming into the United States to build, these are some of the beneficiaries. There is also a Reuters report that OpenAI and NVIDIA are working on custom chips, hence the positive reaction in NVIDIA shares. Creating custom chips isn't new for NVIDIA, though. I want to point that out. And something CEO Jensen Huang did mention in his keynote back in 2002, which I listened to, but it was largely overlooked, myself included, because we were all just more focused on NVIDIA's AI chips, right? It's all about those GPUs. But today, Reuters reporting NVIDIA is actually meeting with Amazon, Meta, Google, and OpenAI to discuss building their own custom chips. And they're also in talks, NVIDIA's in talks to work with on a wireless chip with Ericsson. So I reached out to NVIDIA, they wouldn't confirm any of these conversations, but it's still enough to create a reaction in all of these stocks. A lot of these companies like Ericsson, or negatively impact a company like Marvell, because Marvell does make custom chips, so does Broadcom. And for those that are like, all this conversation about chip stuff, custom chips, think of it like performing very specific tasks. Therefore, they're a lot cheaper than GPUs, which GPUs can handle a wide range of tasks like graphics, rendering, machine learning, etc. And to bring it full circle to your conversation requires a lot more power. In the chip world, they use the word power gate, right? And this is going to be a huge topic in the years to come because of the power use that is needed for these data centers, which is why efficiency is key for budgets for everyone.
One more company we're not mentioning, Microsoft. Its destiny is uniquely tied to what OpenAI is doing. A lot of the technology they are developing, or OpenAI is developing, will eventually find its way to Microsoft products. They're already doing that with their Copilot assistant and so forth. The journal reporting that, Satya Nadella, the CEO of Microsoft, is aware that Sam Altman is going out here trying to do that. But look, what we learned last fall was this is a complicated relationship, not just because Microsoft relies so much on the technology, but because it's heavily invested in OpenAI too. Mm-hmm. So if OpenAI is chasing, a $7 trillion fundraise at, again, as Deirdre said, who knows what the valuation of a company would be there, that plays into Microsoft, and that plays into
Microsoft
Microsoft's
has a lot of money,
valuation.
but they don't have $7 trillion.
Exactly, and so that also plays into how Microsoft values its stake in OpenAI. Not to mention just the technology being developed. Microsoft also working on its own chips, so there are just a lot of complicating
What's
factors.
the argument, Deirdre? Christina or Steve or Deirdre for that matter, that a non-incumbent chip maker, not NVIDIA, not Intel, not Broadcom, not ARM, not AMD, could be a big beneficiary of this?
Well, in the case with OpenAI, he has the branding right now and the interest from sovereign wealth funds all around the world that want to invest in AI. So there is an opportunity for investments there. But the big question is, I think the skepticism is around actually OpenAI building the chips, why he has to rely on third-party members. A beneficiary would be TSMC, Taiwan Semi, for example. But we saw with the example of Apple. Apple has been working on these mobile chips for smartphones for quite some time. But they had to re-sign their agreement with Qualcomm because they weren't able to make a chip that was ready to put in the new iPhones. And that shows that even Apple, a tech company that's been around forever, mega cap, has been a leader in technology, still can't figure out exactly how to get those chips for the perfect chip for the phone. And it shows that a lot of these chip companies will benefit because they specialize. And that's what AMD does. That's what Marvell does, Broadcom, Arista Networks, the list continues.
All right, Christina, thanks very much. Deirdre, you too. And Steve, thanks for being with us, explaining this all to us. Coming up, Super Bowl Sunday is upon us. Huge money swirling around this game. Maybe not $7 trillion, but plenty of zeros. Between the event itself, the gambling, the food, even cybersecurity. We'll cover all the big angles further ahead on the program. Power Lunch will be right back after this. Look at those wings. They look good.
Download the app.
Welcome back to Powerline. Shares of CyberArk up 17% this week on blockbuster earnings yesterday that beat Wall Street's estimates. Looks like shares are higher again, about 6.5% today. Wedbush and Bank of America increasing their price targets following that report, both calling it a top pick for 2024. As cyber attacks become ever more sophisticated and frequent, CyberArk's survey found nearly 9 out of 10 organizations were targets of ransomware attacks in the past year. 9 out of 10. A large majority actually paid the ransom. So let's bring in my next guest to discuss the trends in cybersecurity. Joining us now for more is CyberArk CEO Matt Cohen. Matt, it's great to have you on the show. We teased that we were having you come on to talk about the cybersecurity threats as we come into Super Bowl weekend here. But when I see a stat like 9 out of 10 companies in your survey having ransomware attacks and in many cases paying those fees, let's just start there because it's staggering.
Yeah, I think it speaks to the threat landscape that we see today, which is as kind of enterprises face this rising crisis of proliferation of identities that exist, the new complexity of the environments they're trying to protect. And they're doing it in a new environment, by the way, with workers working hybrid, working from home. They're doing it each and every day to try to figure out how to secure the new perimeter, and the new perimeter is identity. And that means that the bad actors that are out there are innovating themselves, trying to figure out how to get in, and they're doing it more effectively each and every day. And we see that in the ransomware results that you're exhibiting.
Okay. Dan Ives over at Wedbush called your quarter that you just reported another, quote, Mahomes-like quarter. I mean, at a time where the geopolitical landscape has become more fraught, we see more attacks, including cyber attacks by the likes of Russia and China and Iran, to name a few. It's a big year for elections, not just here in the U.S., but historically speaking, when you look the globe over. And then, of course, we have more and more adoption and application of AI. How is the threat landscape growing and evolving? And what does it mean in terms of the innings we're in around these security risks? What does it mean for CyberArk?
I think as you think about that threat landscape that you're describing, and you hit on this idea of AI-enabled attacks, and when you think about the power of AI and what it can use to boost productivity for enterprises like us, it also is an element of innovation that the bad actors can use to actually make their attacks more efficient, to make them more effective, to make even basic things like phishing, which has been out there for years and years, turn into a more advanced attack with deepfakes, with phishing, with voice simulated attacks. And I think as you get into the election season itself, you see people actually more likely to click on links, more likely to believe what they read, and then become more susceptible to these bad actors that are out there trying to get into environments, trying to get into enterprises, and trying to take over. And so for CyberArk, that represents an opportunity. We started securing the most privileged assets, the IT admins accessing the data center, but now throughout the enterprise, whether it's developers, it's the larger workforce, it's the growing amount of machine identities that are out there, they all need a layer of control in order to be able to be secure, and that opens up the broader opportunity for CyberArk to actually secure the entire enterprise of the customers that we deal with.
So whom does artificial intelligence help more? The bad actors who are going on offense using it, or the good actors who are playing defense?
I think it's a constantly changing seesaw, if you will, or scales. I think they innovate and we try to innovate in response. And all of us, not just CyberArk, but all of our cybersecurity peers out there are trying to make sure that we innovate ahead of the bad actors that are out there. But it is a constant balancing act, and certainly in this threat environment, we need to stay vigilant and we need to stay on the attack as defensive agencies.
Is a bad actor more inclined to attack a big event like the Super Bowl, or more inclined not to attack a big event because the bad actors, would realize that the defenses would be so bristling surrounding that event that they would wait and maybe go in March or April to attack the National Football League or its teams to get credit card information about season ticket holders, et cetera, or whatever the hell they want in terms of identity theft or whatever?
Tyler, it's probably tough to predict exactly what people are going to do. With that being said, these larger events, like we're talking about with the Super Bowl or we're talking about with the elections, they really allow an opening to the consumer, to the individuals that are out there. The attacks that are going on against the enterprises, including, for example, the franchises that sit within the NFL, that are operating as business entities, that's an ongoing attack vector that pretty much is going to happen all the time, and we need to be aware and prepared.
I mean, it's been a pretty solid earnings season so far for anybody who's in cybersecurity, yourself included. I even just look at Cloudflare, which is surging double digits today. I realize it's a little bit of a different business there, but how would you categorize the competitive landscape, and would you expect that we're going to see more M&A in this landscape, given the fact that this threat landscape is changing and the demand is growing?
Sure, thanks. Yeah, I mean, our quarter and our year really demonstrated the growth potential of this space of identity security. You know, we grew 36% in our ARR, our annual recurring revenue, for the year. We actually were able to put up a record fourth quarter, which you see in the results that you have up on the screen. But what we see in the competitive environment is more and more attention being spent on identity security. You know, when you peel back all the major breaches that are out there, you peel back all these terrible headlines that we talk about, all roads seem to lead to identity. And that's ultimately where the bad actors and the attacks are targeted. And so we see ourselves as well positioned to be able to respond and help our organizations respond to that type of attack method, that type of attack vector. Ultimately, that leaves us with looking at other ways to obviously build out our identity security platform, make sure that we're able to secure every part of the enterprise, from IT, as I said, to developers, to the entire workforce.
Okay, Matt Cohen of CyberArk, thanks for joining us.
Thank you.
Shares are up another 6% today. As we head to break, a quick power check. On the positive side, Enphase, the CEO saying recent declines in the space have hit a bottom. Morgan Stanley and Barclays raising their price targets. On the negative side, though, Expedia diving on soft guidance, naming a new CEO. You can see Expedia shares are down 18%. Big move there. Enphase up about 6%. We'll be right back.
CNBC.
All right, welcome back to Power Lunch. Revisions to recent CPI data now show inflation wasn't as bad as we first thought. Let's see how that's playing out today in the bond market with Rick Santelli in Chicago. Rick.
Yes, Tyler, you nailed it, but not as bad. That's kind of a wide statement. Many are using it. I looked at all the revisions. They go back to 2019, 5 years, and they were subtle revisions. And that's not a bad thing because many, including myself, are very nervous that changing seasonalities due to a variety of reasons, not the least of which is pre, post, and post-COVID issues and how the world's changed, well, those seasonalities might be giving us data points that aren't highly accurate. So seeing that the CPI didn't stray much is a good thing. And the Valentine's Day surprise will be the revisions to PPI. Those will be next week, of course. Look at an intraday of 2-year, and you could clearly see at 8:30 Eastern, we had a whole lot of volatility. Knee-jerk reaction, rates went down. But that quickly dissipated, and that's the short end. You can go all the way to the 30-year bond, see exactly the same dynamic. But maybe the bigger story here is that despite the subtle changes that specifically most traders saw that DEES was 1/10 lower and immediately started buying the market, pushing yields down. But once you looked at the data, well, 2024 has been a year for higher rates, forgetting what the Fed's going to do. I'm talking market driven. So let's look at a 10-year. There's a year-to-date chart. It's currently at 418. That is the current high yield close of the year. So we're toying with the new one. 2-year yields, well, they settled, their high yield close is 447. So right now they're on pace for a fresh high yield close. And by the way, 10-year note yields as they sit here are up 16 basis points on the week. 2s, 3s, 5s, 7s, 10s, all toying with fresh 2024 high yield closes. Morgan, back to you.
And we're here trading with an SPX at record levels. It's kind of amazing to think about it. Treasury funding, all these auctions. It's been a wild week for bonds and for those yields.
Absolutely.
All right, Rick Santelli, thank you. Natural gas prices falling to their lowest levels in 3 years. Pippa Stevens here now with a look at what's driving that trade. What is driving that trade? Is it weather or is it something else?
Okay, well, weather is always the most important thing when it comes to nat gas. So that actually is the first factor. Apart from that 1 week of kind of, very cold temperatures we saw across the country, has been very warm, very seasonably warm temperatures, and December was very warm, so we're still working through that. The second factor, so that's the first factor. The second, of course, is production, which is currently over 100 billion cubic feet a day, around record levels. And then the third is the fact that we still have that outage at Freeport. So one of their LNG trains is offline, one of the 3 of them. And at the end of January, they said it'd be offline for about a month. And so that impacts nat gas because it reduces our export capabilities and so reduces demand for nat gas. And so right now we're at 184, and actually 150 is the level where producers start shutting in production. So we still could drop quite a bit from here before producers start saying, I can no longer make money, I'm going to shut in my production.
So it's as simple as elevated production, warm weather, which reduces demand, price goes down.
When you put it like that, yes, it sounds very simple, but it's true.
Let's take the rest of the day off. Right? Sounds good.
Yeah. But I mean, you see this, that it always responds to weather, and it's very volatile in that you can never predict that far out in advance, and particularly now with increasingly volatile temperatures, it's even harder to predict, and we're still working through what we thought was going to be this big surge in European demand when we thought there was going to be this energy crisis. And so we're still seeing the lasting impacts of that. And so Goldman actually put out a note today saying that while 2024 looks bad, 2025 is looking better because, of course, this is a cyclical business. And so if the market takes the corrections this year, then next year looks better. So 11 months to go.
Thank you, Pippa. Appreciate it. Let's get to Kate Rooney now, CNBC News Update. Kate.
Hi there, Charlie. The Department of Veterans Affairs announced a plan today that lowers the burden of proof to get disability benefits for certain cancers and chronic conditions. It's expanding the list of locations and timeframes for service members who were exposed to Agent Orange and other herbicides. The list already included Vietnam and other locations in the South Pacific, but it will now include 12 states where the toxic materials were stored or tested. Egypt, meanwhile, has sent about 40 tanks and personnel carriers to its border with Gaza in the past 2 weeks in an effort to boost security in that area. It comes ahead of Israel's military expansion into the southern city of Rafah, where many Palestinians have come for safety. And Saturday Night Live's Colin Jost will be featured as the entertainer at the White House Correspondents' Dinner in April, often called Nerd Prom. Jost will be the latest in a string of entertainers, including Trevor Noah, Stephen Colbert, who have highlighted and headlined that event in the past. Big news for the NBC family, guys. Back over to you.
All right, we'll take it. Kate Rooney, thank you. After the break, it's not just a new Super Bowl champ being named this weekend. We'll also have a new stock draft champion. Before we announce our winner Monday, we're going to take a look back at the competition with one of the year's contestants who unfortunately came up a little short. That's coming up next.
Com. Welcome back to Power Lunch, everybody. After 9 months and 10 teams, we are getting ready to crown a champion in the 2023 CNBC stock draft that ends at the close of trading today. Team Woo, which is wrestler Charlotte Flair's team, has a commanding lead because of triple-digit gains from, what else, NVIDIA. She has followed up by Tori Dunlap with a financial feminist, Olympic swimmer Erica Sullivan, and Team Mountain Goats, which includes actor Ryan Reynolds. I believe they were the winner the prior year. Draft didn't go quite as well for our next guest, Ndamukong Suh, Team House of Kings. It's in last place, dragged down by a long shot bet on Peloton, which has lost nearly 48% since the draft began on the NFL draft day last April. His other pick, United Health, up 7%. Here to discuss the draft is Super Bowl and champion and more, Ndamukong Suh, future Hall of Famer as well. Ndamukong, welcome. Good to have you with us. Hey, listen, when you picked Peloton, and I, as people know, I am a devotee of the Peloton, I thought it was a pretty cagey choice because to win this, you have to have a home run. And that had the possibility to be a home run. It didn't work out, but...
Yeah, it definitely did. I had the opportunity to kind of do a little bit of research and seeing they're implementing a new CEO. I was going to right the ship. There was a couple of news pieces that came out, I think, in the last couple of months, and unfortunately, it just didn't work out for me. So it dragged me down, and I knew United Health would give me kind of that steady gain. I was doing my barbell approach, which is outside of my normal way of investing with all the great mentors that I have.
And one of those mentors is Warren Buffett. How, you I guess, got to know him when you were at Nebraska, All-American player there. He's a Nebraska fan and benefactor. Do you talk to him, and what did he teach you about investing?
Yeah, we do. We typically talk on a quarterly basis, and we just talk about a handful of things, one catching up most of the time, but then just in general, just being patient. And I think that's one of the biggest things that I learned from him, having that opportunity to be patient, be steadfast in your thought process of looking at these different companies that you're investing in, also involved in to help them grow. So a lot of patience is one of the big key, and I know most athletes and entertainers don't have patience. They just want to see immediate success.
Yeah.
And it's all about the long game.
Patience is maybe not a virtue that is rewarded by our stock draft contest, which has a very finite timeline. You got to hit and hit quick, but yeah, Morgan, jump in.
Yeah, I do want to get to some Super Bowl questions with you, but first, I mean, you are an advocate for financial literacy. Why is it so important? What is the number one mistake that you think athletes make?
Honestly, financial literacy, I think, is one of the biggest things that our youth need to be involved in and need to be exposed to, primarily because at this age of having NIL deals, especially in sports and collegiate sports and all that whole landscape changing, they're in tune with all these amazing deals that they're getting involved in with, but just don't understand how they need to structure themselves to be able to pay for those taxes and that income coming in as we're getting into April and tax season and whatnot. And so those are the things that they need to start learning at a young age, whether that be in middle school or high school. And something that I've been able to be very fortunate of is having great partners like I have with Intuit to be able to create these interesting opportunities to do workshops with kids in high school like we did this past year. And even more specifically, coming up in the near future, we're excited about doing another partnership with them and growing that space, especially around this NIL work that needs to be addressed.
Okay. Contessa Brewer, our colleague Contessa Brewer, last hour was asking different athletes about Super Bowl this weekend, about their investments, but also about the fact that we've seen this surge in popularity around the NFL and whether betting is the culprit or whether it's Taylor Swift or both. So just want to get your thoughts on that as we do go into Super Bowl weekend.
Yeah, Super Bowl weekend's a big weekend, and betting's always the number one piece. Taylor Swift is obviously a big part of it as well. I'll be in attendance in the Super Bowl and in and around all the fun activities. So we're getting ready to head out, me and my wife. So it's a lot of excitement. I've been in 3 of them. So being able to be a part of them and then around them at the same time, betting is always a big thing.
Who's your pick this weekend, Indamaka?
My pick, I'm watching. Throughout the last playoff weeks, I was in London with Sky Sports, having some fun with them, doing an announcement. But with watching Kansas City, I picked them as my winner because, one, I beat them in previous years and know how dominant that offense is. And they're on a very high roll of being on all cylinders. And then their defense, surprisingly, their defense has shut down some amazing offenses. And Lamar Jackson, who just won MVP, and then the Buffalo Bills with Josh Allen and that amazing, very high-powered and effective offense. So I think the Kansas City Chiefs are going to take care of business against the 49ers, even though I got some friends over on that team that I hope can get a ring sometime soon.
You didn't play this year. You didn't get back in?
I had many opportunities. Actually, one of the teams that's in the Super Bowl called me in week 16, 17 to come and play, but it just didn't fit well for me and my family. So it's all about the right opportunity. I'm in a very fortunate and blessed situation where I don't have to play the game of football, but I would love to play it if it's the right fit for me and my family.
Yeah, well, those quarterly meetings with Warren Buffett, I'm sure, help as well.
The game is better when you're playing, Indamakan. The game is better when you're playing, and the Hall of Fame will be better when you're in it, which is going to happen. Thanks so much, my friend.
Thank you very much, and I appreciate it. It's always a pleasure to talk to you guys, and I look forward to seeing you again soon.
Likewise.
Well, still ahead, a small bill for your big party. Some game day snacks will cost you less this year. Woo, thanks to deflation. Our own Jane Wells has the details. Jane.
Well, with my Rams on the sideline, I'm all about the Super Food Bowl. And up next, we have good news, even for Taylor Swift's favorite food. Yes, I'm going there, and you will too when Power Lunch returns.
Welcome back. While food prices seem to remain a perpetual problem for consumers, those looking forward to the Super Bowl could actually see some deflation. Jane Wells has a story. Hi, Jane.
Hey, Morgan, you know, I'm all in. I'm wearing my commemorative Roman Gabriel jersey. Google him. But anyhow, whoever wins or loses on Sunday, you win and lose a little when it comes to the party. We're going to start with the proteins. Wing prices were already down a year ago, and they're down even more. By the way, Taylor Swift's favorite food is chicken tenders there. I have worked her into the story. Ground beef for your tacos and burgers is up, though, but the surprise value this year, shrimp? Take a look at this. Courtney Schmidt at Wells Fargo has been running the numbers, and she says ground beef prices are up 12% from a year ago. You can see what's happening with shrimp and chicken. Shrimp is down 6%. It's a value now. And wing prices down anywhere from 5 to 11%. Why?
They've been dealing with some export restrictions related to the bird flu again this year. And then they've had, more weight on the birds. That's caused more production.
Now, we have plenty of avocados, so guac prices are about flat, but it's in the packaged goods where you're going to start to see inflation. It's the packaging costs more, there's higher labor costs, and wages are going up. Chip prices, according to Schmidt, are up 5 to 6%. PepsiCo this morning talked about higher potato prices. Salsa prices are up 3%. As we move to beverages, beer prices are starting to flatten out. You know, not as many young people are drinking beer. It's about $1.75 for 16 ounces, she says. And when it comes to soda, soda in a can is up 5% from a year ago, and soda in a plastic liter is down 1%. So it all depends on whether it's the aluminum or the plastic. And as we look at how PepsiCo has performed after reporting earnings, Schmidt says soda has seen the highest food inflation of any category since COVID. Canned is up 55% since 2020, and in liters it's up 33%. Guys, who knew? Get out of here.
55% since when, Jane, did you say? Coke? Soft drink?
Since COVID. 2020, 55% for flavored carbonated sugar water. A lot of it, of course, is what it comes in.
I have to say, I remember watching Roman Gabriel.
He was so dreamy.
He was dreamy. He was a big, tall guy, I think from North Carolina State, if I'm remembering correctly. I can't remember. But
I think so. He's still alive. He's out in Palm Springs. He's in his mid-80s, you know. But they could never get past those darn Vikings.
no, that's right. And then the Vikings could never get past whoever it was they were playing because they never won a Super Bowl.
I know.
Jane Wells, enjoy the wings. Thank you.
Thank you.
All right, see you soon. Still ahead, the S&P 500 may be notching all-time highs, but more than a dozen stocks in the index are trading below their 50-day moving averages. How about that? Our three-stock lunch trader will tell us if there's any opportunity in those laggards when Power Lunch returns.
Black-owned businesses secured a little over $2 billion in venture capital in 2022. That's a lot of money, but it represents less than 1% of the more than $200 billion pool of venture capital. Many agree this means there's more opportunity to invest in founders of color. Celebrating Black heritage, I'm Sharon Epperson.
Most illogical.
And comfort.
Welcome back to Power Lunch. It's time for today's 3-stock lunch. Today we are pulling 3 stocks from a CNBC screener, looking at stocks underperforming as the S&P sets records. Here with our trades, David Wagner, portfolio manager at Aptus Capital Advisors. So up first, we were talking about chips earlier in the hour. Teradyne, as of yesterday's close, slightly below its 50-day moving average. David, your trade on Teradyne.
Yeah, Morgan, in the semiconductor space, it's tough to, get excited about a company that does not have a narrative right now, and that's Teradyne. Yet their biggest peer, Advantest, has one of the best market narratives out there. Well, why? Well, Teradyne works closely in the mobility market, so think smartphones, think Apple, while Advantest, this peer, has more visibility in the current environment given their focus on the GPU test market. So think NVIDIA, think AMD. And that, honestly, is the narrative that the market has been rewarding right now. And when you look at fundamentally under the hood of Teradyne, you'd see that the market was really hoping for some type of growth this year, but their guidance ultimately pushed that off to the second half of this year because they've seen some weakness on the automotive side of their business. All in all, it's great at winning designs. They just need these designs to convert into volume. And that's taken a little while because we're basically in a 8-quarter straight slowdown in their end markets. So I'm staying away right now, but you can remain patient if you own the name.
Let's move on to Broadridge Financial. That stock up about 37% in the past year, trading just below its 50-day moving average. Your trade on Broadridge, David?
Yeah, Tyler, I've been a holder of Broadridge probably for almost a decade right now. And I think the last few months have been a prime example as to why I've held the stock for so long. So if you go back about 1 year, the company was really fighting 2 big bear cases that were thrown at it. The first was that the wealth management build-out would be a headwind to free cash flow and dilutive to margins. The second bear case would be that the proxy business has been growing above trend for a few years.
I'm back.
And that was going to revert. Well, fast
What
forward
we do,
to
have
today,
sell-off?
and we now know that the wealth management build-out is complete, and that we've seen a lot of cross-selling, actually, which has benefited incremental margins, which has ultimately driven free cash flow. Secondly, the proxy business remains very resilient, growing mid-single digits for this year. Basically, the company put all these 2 bear cases to rest, allowing the name to trade at the higher end of its valuation. But Tyler, there's nothing more I like than when the bulls really just stick it to the bears, and that's exactly what Broadridge did here, so I remain long.
All right. Finally, Carrier Global, which reported earnings this week. Stocks up about 24% in the last year, but like the others we just talked about, it's trading below its 50-day moving average. What's your trade on Carrier Global as we talk about HVACs and a secular trend that involves more spending on things like infrastructure?
Yeah, anecdotally throughout this entire earnings season, I've seen the market really start to reward a few turnaround stories. And while Carrier, it's not a story that needs to be turned around, it feels like it's a name that has at least turned the corner to a more simplistic story. If you look at just this past earnings report, investors finally received the new fiscal year guidance, and it wasn't that bad. Of course, the bears are going to continue to focus on the concerns around the European heat pump demand and the U.S. residential HVAC market, but overall, the guide was strong. I mean, core earnings are expected to grow 15% this year, while proceeds from sales, are going to provide Carrier a pathway to get to about 2 times leverage by year end, which will open up to be able to resume share buybacks. And this simplicity, Morgan, is what should be rewarded. So pending no material slowdown in their end markets. So I do like this name right now.
All right, David, thanks very much. Have a great weekend, sir.
Cheers.
All right, you bet. Coming up, big banks pulling big gains from overdraft fees, even as regulators tell them to quit.
It went to
We'll break down the
1562
numbers when Power Lunch returns.
Oh, well, again, got out way too soon on that one. Jeez, look at the run on that thing. The 5,000 strike. Oh, my. That had to have been to put. Yeah. No? No, it couldn't have been that. Yeah, it had to have been put.
Okay, we only have 2 minutes left in the show. We got several more stories you need to know. JP Morgan Chase, Wells Fargo, and Bank of America reported a combined $2.2 billion in overdraft fees last year. And while that may seem like a lot, that's roughly $700 million less than the year prior. This comes as banks face pressure from regulators to cap fees, create new ways for customers to avoid the penalties. And of course, we're having this conversation in a week where maybe not the big banks, but the regional banks are certainly under fire and more scrutiny.
Yeah, under the NYCB bank issue has certainly cast yet another pall over them. Banks are ingenious at figuring ways to hit you with fees, whether they're overdraft fees or the latest one I've is the paper statement fee that I'm paying for not going wire. What is it called? Paperless in my accounts. $3 a month from my bank. I'm happy with them. I have to talk to them about that. Big game may not be till Sunday, but the Kansas City Chiefs have already been dominating the advertising game. Have you noticed? During this year's NFL season alone, Patrick Mahomes, Travis Kelce, and Andy Reid starred in a combined 33 different TV commercials, which cost nearly $400 million to air. So whether or not Kansas City wins or not on Sunday, and I think they will, because I think they're the hot team, Kelce, Reid, and Mahomes have been winners in the ad place.
I mean, that's there. You talk about. We just had this conversation about athletes and investing and what future looks like off the field.
I bet Mahomes makes more. I think he made $500 million in his latest contract or something like that. I bet he makes more from endorsements than he does on the field. I bet.
Meantime, we're seeing the price of Super Bowl tickets hit fresh records too, which I
Yeah,
feel like we talk about every year.
$8,500, $8,600 for one this weekend.
All right, the U.S. Army abruptly scrapping its high-profile big-ticket program to develop a new armed scout helicopter known as the Future Attack Reconnaissance Aircraft, FARA. The service had already spent at least $2 billion, had requested another $5 billion for the next 5 years for that major modernization effort. Lockheed Martin, Sikorsky, and Textron's Bell were competing, GE building the engine that will now stay in development indefinitely. I'm going to talk a little bit more about that on Closing Bell Overtime, where we also have a number of guests, including Lule Demasay from eToro.
We'll be watching. Thanks for watching Power Lunch. See you next week.
All right, guys, welcome to Closing Bell. I'm Scott Wadman, live from Post 9 here at the New York Stock Exchange. This make-or-break hour begins with the S&P chasing history. The first close above 5,000, very much within reach. We're going to track every move over this final stretch and ask Trivariant's Adam Parker in just a moment how high this surging stock market can go. In the meantime, a look at the scorecard with 60 minutes to go in regulation. We got a lot on the move. take a look at this. NASDAQ on the cusp of 16,000 again. First time since November of 2021. S&P is going to close above 5,000 today, barring something miraculous over this final stretch, because right now it's 25 points over that level. That's 0.5%. Dow's giving some back. The Russell is a big winner today.
Russell,
That's outperforming. It's
IWM.
up 1.5%. Well, more evidence of the recent broadening in the market after weeks of top-heavy trading. We talk so much about that. How about interest rates? They're mostly higher, too, after some revisions to CPI and more suggestions from more Fed speakers that rate cuts might very well come this year, just not so soon. It does take us to our talk of the tape. Rally and risk. Whether the latter is increasing as the S&P keeps rising and some big-name stocks go parabolic. Let's ask Adam Parker. He is the founder and CEO of Trivariate Research, a CNBC contributor. Good to see you.
Great to be here.
Do you marvel at this market like just about everybody else?
I think the bull case we talked about, gross margins can go up for the average company. You'll think earnings are growing in the middle of this year, next year, and so forth, and that the Fed's likely to be accommodative. That cocktail's still in place. I mean, valuations have moved a lot, but as you know, valuation is never a good predictor of near-term return. It's about believing the economy is going to be in reasonably good shape, and I think the data points support that.
So you think that the environment, all of the things that you said, plus other things you didn't mention that are potentially positive, support the stock market at these prices?
As long as I think gross margins
198.31 got a hold.
History dictates being reasonably optimistic on equities is a good idea, and I can't find other asset classes that give me exposure to things like the top 20 U.S. equities. I mean, we talk about that all the time. The biggest 20 U.S. equities grow their net income at 15% per year. So what else do you see that's awesome, that big and liquid and all that? So I think it's a good risk reward. What am I worried about? Maybe China gets worse. That's really hard to wrap your arms around. Maybe the U.S. consumer slows. We've seen a little some little signs that the low-end consumer is slowing. You got to monitor that. I'm worried that that maybe you could get the balance sheet stuff from the Fed, kind of offsetting some of the accommodation of edge. I mean, nothing ever feels, you always, as we talked about a million times, you always sound smarter when you're bearish. But I think if you think margins are going up, you should stay optimistic. And I see so many things I want to buy in the equity market underneath.
Really? Yeah. Well, we'll get to that in a minute. Yeah. Before we go underneath, I want to stay above.
Okay.
So to speak.
Let's cruise at altitude.
The two E's, exuberance and euphoria. Yeah. You worried about either of those?
Look, what I do all day long is I talk to portfolio managers and CIOs and big, senior people at corporations. I don't see a lot of, champagne and Maybachs or whatever you want to call it. I think people are.
You looking around NVIDIA's corporate headquarters?
Yeah, well,
there's some Maybachs in
I think AI
in the corporate parking lot there.
I think you picked a stock that's been a monster, and we've talked about it a lot on your show that you need exposure to AI. If you're a fund manager and your boss says to you 5 years from now, what did you own for exposure to AI? And your answer is 0, you're fired. So you have to look around at the 9 or 10 businesses that participate. We're in the first inning of a multi-year trend, and they're a winner. Everyone thinks that they're the genius that's going to call the right part of that lightning bolt. They think
572 on SPY.
That stock's proven no wrong. Like that's an early trend. So I'm not smart enough to get that right. I just know we're headed. We talk about it.
But you're a former chip analyst.
Yeah.
I mean, you know chips better than most people.
Yeah.
And somebody else used the inning analogy with me earlier, saying this first inning of AI. I said, well, if you look at NVIDIA, they're doing like 9 innings worth of games in the first inning.
Yeah.
You can't keep that pace up.
No, you can't keep the pace up for sure in terms of the amount. But when I look at it, and we did a big note on it today, actually, like when is the time to toggle to the industrial-centric semis from the AI-centric semis? That's the title of our note today.
Like the NXPs and the
ADI coming up, Texan, Microchip.
semis.
Yeah, great businesses. They all guided down. They all have way too much inventory. They have more broad-based economic exposure and don't have a lot of AI. It's hard to own them when I don't think gross margins can go up and they have a lot of inventory. I could still sink my teeth into this AI trend for the time being. I think at some point you'll want exposure to them to the good businesses. I just think it's too early. So, look, our call coming in the year was to like software that is accelerating growth and to like AI-centric semis, avoid the industrials. I think that's still right. I do worry about the EV to gross profit or the valuation, but I know that's not the leading variable I can use to pick stocks.
It's really incredible. Yeah. Now, it's the market, as Mike Santoli's been pointing out, is broader than people want to paint.
Right.
Today's a good example of it, obviously, with the Russell up 1.5%. But when you look at the elevating prices and the valuations, but the prices,
specifically of the Mag 7, the NVIDIAs. We have the Dean of Valuation, NYU Stern, Aswat Damodaran. He's a smart dude. He owns all these stocks. He studies this stuff for a living. And he has a hard time looking at what's happened here. I want you to listen to what he told me the other day, and we can react. Here's Aswat Damodaran.
Today's prices, I mean, all of the stocks looked overpriced, but I think NVIDIA stands out as particularly overpriced. I mean, just to get a collective sense of what these 7 companies account for in the S&P 500, these 7 stocks alone account for 70% of the overall market cap of the index. They account for 11% of the revenues, but they do account for 27% of the gross profit. So they're very profitable, very profitable companies. And you can get pretty close to the current prices for the other companies. NVIDIA, I can't even get close.
Just curious what you make of that. I mean, he's not the only one saying it.
Yeah, I think people said that at 500 billion market cap and it went to 1.7 trillion, right? So I think, you know,
and he's an owner of the stock too,
yeah,
right? So he's enjoying the gains. Just makes him a little queasy.
I think I get it. It makes you nervous when you look at EV to gross profit. But I just think if I'm creating a portfolio long only to beat the S&P 500, I need some AI exposure. I can own Taiwan Semi. I can own Micron as a memory trade. I can own Cadence and Synopsys, which trade at 35 times forward. I can find stuff to own, but this is the best company with the best product early in the cycle. So I know it's going to be worth $3 trillion in a couple of years. It could go down to $300 billion in the interim, sure. As soon as they, miss on any expectation, it's going to down 15-20%. But as you know, because they come on your channel all the time, then the people will say, now it's cheap enough for me to buy it. They missed the first 1.7 trillion, but they victory lap on your show when they buy it at 1.4, right? Like that's not the right. So I want exposure to AI in a portfolio long only for sure. And I just don't know who's going to be smart enough to miss the 20% correction in the 500% move higher.
It's like ARM Holdings is another example. It's up 60% on the week. Someone comes on halftime today and says, I just bought ARM. Yeah, it's up 60%, which is why you have some making comparisons to 1999. Like the strategist at one of the major houses who did that, Jeremy Siegel, the Wharton professor, was on with me yesterday and said, this is not like 1999. Listen to what he told me. I get your reaction. Okay.
It's not worse than 1999. But one thing is very, very different. This is important. We had S&P selling at 30 times earnings at the beginning of 2000. And the tech sector even far more than that, 60, 70 times earnings. And by the way, interest rates were higher than they are today. Today we're selling at 20 times earnings. Now, that's not cheap, but certainly it is not a situation like 1999 or 2000.
All right, so I mean, you don't like when I mention the strategists, you rip on them. Well, so I bring out the professors.
Yeah, look, I mean, I don't rip on the strategists. I mean, I think it's just, when you force people to make a 2-week market call and they tell you with confidence they can do it when they demonstrably can't.
Okay,
over
many years.
99. It's not awesome. No, it's not 99. I don't think companies are going to run out of capital spending to fund the projects. I think every company's investing in productivity and efficiency, and I think the market, deserves in aggregate to trade where it is because these big businesses are highly profitable, have huge moats, and have long runways. I still think there's other things I can own, and again, being the S&P, you can own 25% of your fund in tech and still own lots of other stuff. There's stuff that's gotten annihilated this year underneath that maybe sets up better for 25, and you look at healthcare services, or you look at, tools, or you look at, there's things you can buy underneath that in a balanced portfolio could beat the S&P.
Tools? What do you mean, like Illinois Tool Works?
Like healthcare, tools, like the stuff that...
Oh, healthcare related.
Yeah, exactly. Because I think healthcare is really lagged.
We're talking about like hammers and screwdrivers. I mean...
well, no guns and butter.
We're talking about picks and shovels now. That's what people talk about.
Well, I do think there's things you can own. It's not all, by correlation to the go-go, tech stuff. But I do think, there's lots of opportunity. On the other hand, there's things I don't want to own, U.S. retail or stuff like that.
Why not? The consumer's doing great.
Yeah, it depends. If they're physical retailers, that it's just going to hard for them to mean revert on margins and on comps. So, stocks that have really recovered that I don't think deserve it, like Target or something, is one, I always pick on. But, to me, the comp negative online and in the store to have no new store growth, why would that be a good security?
All right, let's bring in CNBC contributor Shannon Sakosha to join the conversation of NB Private Wealth. Shannon, welcome. It's nice to see you on this Friday.
Hey, Shannon.
What might be a history-making day if we can close above 5,000 on the S&P for the first time ever. We're certainly on track to do it. Your take on the market is what?
Well, there's no ugly surprises, as an Evercore analyst put out today, and I think that's really what we're looking for here, Scott. We've gotten through the bulk of earnings season. We have the concentrated names that held up their end of the bargain for the most part, although there was obviously some dispersion in those results. And so now we're just looking forward to this continued drumbeat of what Chair Powell called confidence. They're building greater confidence, and to Adam's point, the broadening out of the market, and Mike has done a great job of covering this week. The broadening out of the market really does rely on greater confidence that this economic picture that's being painted, that is of a disinflationary trend with low unemployment and continued surprising growth, can be mirrored in the equity market in earnings growth, because we know top line's coming down. So if we can start to see this continued execution, I can't agree with Adam more on the gross margin point. Gross margins are improving, and they have room to go outside of the big names that we talk about every day. So I think that it's about building this greater confidence, and milestones like 5,000 help that. But I think it's more about just all of these data points coming together at the right time.
Now, you were neutral. This sounds like a more bullish Shannon Saccocia to me. Am I hearing you correctly on this Friday, Shannon?
Maybe you got me because it's Friday afternoon, and Adam's on, and so that's always positive. So I think honestly, honestly, we came into
The tone don't lie. I mean, I'm being serious. All jokes aside, it sounds to me like you become a little more positive on the market.
Yeah, so we're still neutral overall in equity, Scott, and so I don't want to reflect anything different. However, we went overweight in small caps to start the year. We moved our cash position from an overweight cash position to an underweight cash position, acknowledging more so that cash rates are coming down and that needs to go somewhere. Perhaps the bulk of that goes into longer duration bonds. But there is an opportunity here, and we do think, again, looking at this potential broadening out, I know there's been some fits and starts in January, and we're seeing some evidence of it. I do think that that's going to accelerate, and that gives us a nice home for some of this cash to go to.
All right, I mean, Russell, speaking of broadening, we're above 2,000 now. It's been a tough place to hold. We'll see what happens. Small and mid cap. You a fan?
Again, you need gross margins to go up. I think they will, but I'm not a fan of not owning a lot of the Mag 7. As you know, you can't beat the S&P 500 and be underweight that group. That's my view. You got to own big weights in the biggest, 10, 15, 20 stocks.
Oh, so okay, that's interesting.
I like everything.
Big weight. Well, that's important what you just said. Big weights in the biggest stocks. So you still want to go with the 2023 playbook of go big or go home.
Here's why. It's really more risk management than alpha, right? One, these stocks have very low company-specific risk. When the market goes up and large beats small and growth beats value, it explains 80% of Microsoft's returns. Two, there's 50, 60 sell-side analysts and 4,000 buy-side analysts who cover Microsoft and Apple and Google. So the idea that I could know something that nobody else does that's not in the price, I mean, that's rough. And then the third thing is I can't find a basket of stocks, 30 or 40 stocks that mirror their performance, that are correlated. I can't, kind of de-risk the one. So if I don't know anything anyone else does, they trade macro and they're not replicable, I got to own pretty close to the market weight. And yeah, maybe I love NVIDIA more than Tesla or whatever, and more than Apple, but that's not going to explain too much of my return. I've got to own a quarter of my portfolio long only in the big names. And so many people can't because they have mutual fund rules or risk rules that prevent them. And if you have the flexibility to do it, yeah, you should do it.
The other bit of fuel, Shan, towards the mega caps, if you need yet another reason why there's been such a flood of money in that direction, as Tony Pasquarello of Goldman Sachs, who covers hedge fund client coverage there, was talking about in his note today about the buybacks that these companies are doing. Extraordinary. Apple, $20.5 billion in Q4. Google, $16.1 in Q4.
That's good.
Meta, $6.3 in Q4.
And their big announcement.
And Microsoft, $4 billion.
Wow.
And by the way, there are still tens of billions of dollars from prior buyback announcements still sitting, waiting to act.
Scott, this is the story of 17 and 18, 16, 17, and 18, and it really created the market dynamic that we're living with today. And I think, again, if you think
I'm convinced.
about, the lever that exists for companies, not just these mega cap companies, but obviously we talk about their buybacks, look at the return of shareholder value in the form of buybacks that's been announced in the last year. It's not just in these companies, but I think the misconception was that in a higher rate environment, that they weren't going to be able to tap this type of cash flow to fuel this type of return to shareholders in the form of buybacks. And frankly, by terming out a lot of this debt over the course of several opportunities at zero rates, they have so much flexibility. And so when we look at companies we want to own, we look at balance sheet, we scrutinize the balance sheet. We think about the companies that have a lot of balance sheet flexibility. There's notable names that are in that mega cap tech space, but there are other names. Look at that and look at the flexibility and latitude that gives to these companies in this type of environment.
Where are you today on energy? You know, you come off that? I feel like you have.
No, we're just wrong. We've been wrong the last year on energy. You know, I still believe that we don't have enough capital spending to meet what will be the demand at some point, 2, 3, 4 years from now, just with the installed base of vehicles. If anything else, I mean, look at Tesla's chart. EV adoption has been a little bit weaker than people thought.
A lot weaker.
Right? And so that should support the demand-supply equation, you know, given, you know, where vehicles are. But, you know, supply has been a little bit better than people thought, given some geopolitical
Tesla's
stuff.
got a nice symmetrical flag today.
And oil prices, you know, a couple of deals have been announced without big premiums. So people are kind of negative sentiment. But I like it still because I just don't understand how we're going to get 107 million barrels, which is what we need to fuel the installed base. So it might take me 18 months to be right, but I think eventually oil goes way higher. And you know, in your portfolio, you can own 8-10% of your portfolio in energy, and I think it'll get paid. But it's been wrong. It's been wrong, no question.
So because this week has been heavy with Fed speak, we've had yet another speaker today, and everybody's kind of on message now. No March, but, you know, soon, or soon enough. We're going to do it probably this year. When do you think we get the first one, and how much do you think the timing actually matters?
I don't know. Is the answer to the first question, and it shouldn't is the answer to the second. Meaning, you know, I don't even know if they know when they're going to do it. I don't think the employment picture and the inflation picture and the economy are so desperate that I need to do a ton of cutting. And I've been surprised that there's 6 or 7 in the price when you look at what's implied. So I think the problem we all have is we study history. We try to say what historical period is a playbook that's going to unfold.
UPS.
History includes the TMT bubble unwind, the global financial crisis, and COVID.
So we had earnings, we had to bounce back.
Anywhere near as dire as those three.
Whatever that trend line is, it meant
those three
something.
things and tell you how many hikes they need to do. I don't know if that matters. I think as long as the consumer holds up okay and the economy's
that
good,
flag.
Sure, they'll do it a little bit, but they're going to do less than what people think.
Well, I mean, and also, Shan, there are some who suggest that they don't even need to cut, and maybe that they shouldn't anytime soon. That was
it's got a
Professor
1, 2, 3 UPS on the 180-day 4-hour.
Is that the market is so reliant on the idea of rate cuts. He suggested no, it's not, and at this particular moment, I don't even think they need to.
Oh, God.
I think there's pockets, Scott, of the economy that really could use a rate cut. We talked about low-income consumers. You know, there's a lot of delayed purchasing that's going.
Okay, my SPY is back to 196. You hope we can see 195 on Tesla today? Out of the SPY calls.
Anticipated. I mean, it was a little bit unprecedented on the way up here in terms of, you know, going more than 25 basis points. Maybe we see that on the way down too, and maybe they try to front unload this and in June or, you know, later in the summer, and then see how it goes for the rest of the year. There's really no telling because they have so much latitude in how they want to affect this policy, and so I think that could create some uncertainty, but also some opportunity.
I guess the dumb statement of the day for you is going to be this: the stock market leads the economy, and the stock market's telling you the economy is going to be decent. That's it. By the time the economists tell us that things are slowing, the market will already have been down 10-20%. So I think the market's telling you things are okay.
Okay, so on that note is where I wanted to end anyway.
Oh, perfect.
There are some who say, like Tom Lee, who's been bullish and correct and said stay big. He's been correct there. Says his 5,200 may be conservative, 54 to 5,500 seems reasonable for the upside. Make sense?
Depends on your time horizon. I mean, how could anybody
this year?
Yeah, I mean, look, 5,200 is only like 4%, less than 4% up. So yeah, you could be there at the current
We'll
rate
see you
by
next
next
Friday.
Wednesday. Exactly.
It is crazy.
Yeah, yeah.
All right, we'll leave it there. Speaking of, thanks so much for being here. I enjoyed that
have a good
conversation
weekend.
very much.
See you,
Adam
Shannon.
Parker. Shan, be well. Enjoy the weekend too. That's Shannon Sakosha. All right, let's head to Christina Platzinopoulos now for a look at the biggest names moving into this Friday's close. Christina.
Well, let's talk about Pinterest because its shares are lower right now after a miss on revenues and softer than expected revenue guidance for the current quarter we're in. The social media giant also saw lower average revenue per user, and that's lower than what analysts had expected, and that's why you're seeing shares sell off about 9.5% right now. Take-Two Interactive having its worst session since November 2000.
You're right. My head always turns into mush when I listen to these puntas. I mean, there's so many mixed messages. It's the same story every frickin' day. It doesn't matter anymore about the interest rates. Where it did. Well, that's what I told him. I said the same thing. I said, it don't matter. Not when you're in this kind of momentum run. I mean, look at the frickin' SPY this morning. I come in here first thing. I'd call out SPY right at open. And look at that baby. That's up 100%. If I just had the intelligence to hold the SPX, I would be filthy rich today. Another $1,000 runner. It's easy to call these dips when you're in a bull market, and these people just, I gotta really evaluate the way I look at things. Okay, here goes my oven. I mean, I probably, this year alone, well, plus the last couple of months of last year, I bet you I left it every bit of, I don't know, over $250,000 on the table. Especially when you get like calls that go to 300 to 2,000 or 300 to 2,500, and it's continuous, especially on these megaphone patterns. And I'm not even fearful about calling these breakouts in the morning. I mean, I just love trading these two. I could do it over and over and over again. I mean, the 51.15s that I got in at $4 ran to 15.62. There's a $1,000 gainer right there, and I get out at 5, and right now it's at 10.30.
To return to our shareholders, our share price has been up around 30% per year every year. But we still trade, if we're a member of the S&P 600, and if you just look at where we sit today on a forward multiple against that index and the consumer financial pieces of that index, or even the the Russell 2000 financials, we still feel like we're undervalued. So we took some steps to enlarge our buyback program, and going into 2024, we had a substantial amount of our market cap available for a buyback. And I think at these levels, we feel we will be a buyer, because we do feel like, given our historical performance and the outlook that we just talked about last week, that we still have some value to go, even though we've done really, really well over the past 6 or 7 years.
Okay. There is a moment right now where a lot of people are trying to figure out when the consumer will become overburdened. The idea that they can take on debt, pay it back when they've got pay it down because of their job, because of their strong employment outlook. Is that kind of your main sort of barometer for what you see in the future? Is it watching employment? Will you be sensitive if there are breaks and people go, you know what, I didn't make a payment this month?
Yeah, well, to get a consumer loan with Inova, you need a job or a verified source of income, and you need a checking account, since we are online only and only work through the ACH network. So we will be watching employment closely. And
you need a job.
It's been pretty robust. A lot
Who
of
the
our
hell are
customers
you?
play in spots where you're able to not only have one job, you can have multiple jobs if you so desire. They tend to be in the more of the hourly, non-white collar type job spaces, which have seen a lot of stability and strength. So we'll keep an eye on that. And I think the other piece of it is our portfolio turns over very quickly. So our payment frequencies tend to be every other week or faster versus monthly. And so we can keep an eye on defaults, whether they're in line or we're surprised by them one way or the other. And we can calibrate very quickly to either reduce risk or take on more opportunities, just given how quickly our book turns over and how quickly customers repay us.
I'm curious your thoughts on the regulatory standpoint. There was some chatter that maybe the CFPB would be applying more stringent regulations to so-called payday lending.
Don't do that yet.
That they might bring back a rule from 2017.
Bring back rules.
Lenders to confirm, quote, ability
That's
to
all we need.
repay, something that was knocked down by the Trump administration. Thoughts on that?
Yeah, so that's been in the works for many, many years. In fact,
Goldman Sachs is down.
Inova is no longer involved in payday
JP
lending
Morgan.
at all. Any pieces of that rule, if it was to be adopted, we're ready for it. Would have very little impact on us, just given the changes in our business.
Jets moved up a little bit. It wasn't red.
I think there's still some skepticism as to whether the courts are going to allow that to continue to go in. And just to be clear, we are supervised by the CFPB at the federal level.
Yeah.
Called this one out, but didn't take the trade.
So we think
feel like a fool on this here.
Prime lending, they've actually encouraged
Look at that run
parties to get involved
on
in
Mister
space versus not. And I think
it's up $60.
Focused on a few other things other than the subprime, non-prime.
Since I mentioned it.
Small business markets right now.
Okay. Hey, Steve, last thing, are you guys taking any of the breakthrough AI tech into your models? Is any utility of it there at all?
So, we've been very careful to separate the difference between machine learning and artificial intelligence. So we've been a machine learning shop for a very long time, which at the end of the day just helps our humans work more effectively and faster, more productive. AI, I think you have to pick your spots. There are pieces of generative AI that will work within our operations to make us more efficient, whether it might be in coding or in our broader customer service operations, but not so much in underwriting, given the complexities and the touches to consumer compliance.
All right. Thank you very much for your time, as always, Steve. Good to have you back.
Great to see you. Thanks.
Sure. Thanks, Steve Cunningham, CFO at Inova International, up about 10
Alrighty.
weeks. When we come back, going to trade some options, look at what happened in today's Cisco options market, Instacart and Shopify.
I remember when I first started flying, and we would experience
some turbulence, and I would always look to the stewardess up there, and if they were happy, I would be happy too. But then one day, I was in the bathroom, and I was taking a big shit, and I hit turbulence, and it went all over my butt. I didn't know what to do.
They call them dumps, big massive dumps.
Big massive dumps. Okay. Yeah, I really feel stupid not getting Mister. I really wanted to trade this one. I think it's good to get in here when you first open up and just watch your major stocks like I do with the SPX and the SPY and learn about them candlesticks. Okay, here's a good example right here. So we nailed the first one this morning, the first pullback. We had a pullback, breakout, then she came back down and consolidated, higher high, and then she came back and had the retest. And this is when I called this trade out. That's kind of a bullish pattern right there, a candle, because you have more of the wick underneath the body, the shadow. You know, the body I pay a lot of attention to. You had a hammer here. Then you had these three shooting stars or inverted hammers. Then you had a regular hammer. And the body of this hammer came up to equal weight of the body of this one, which is telling you that that's a bullish sign. That's a bullish hammer. And this was a bullish hammer. And I drew this trend line on the body of this candle and the body of this one. And that's where I found my support. Used the body and just extended it on out so I could at least get some kind of idea where support was. Then when we broke down below it into a hammer, that was almost a no-brainer. Then you come up here to 1, 2, 3, boom! Then it retests that resistance line. My best advice to you, when you see a reversal, look at the candlesticks and see what they're telling you. There's another hammer here, squeezing out. Another hammer here, squeezing out. We have a tweezer bottom here. Now these are bearish candles, but then you got that hammer. So it breaks out of the snake. Where was that at? So you do this, drawing your snake. Take to that body, to that next one. Then run it to this body right here. So you got your 1, 2, 3 breakout. She pulls back with a hammer and relishes on that resistance line, and boom. Another hammer. Then you take and draw your trend line from here. Let's say you missed this. She broke out and she's pulling back. Take and draw your trend line from the body of that to the body of that, right there. There's your head and shoulders. And then she comes right back and hits that right shoulder the second time. Boom. So that would have been a good idea to take that trade right there, knowing that that's the second touch on that right shoulder. I'll be right back. I don't think I put my... Yep, I'll be back.
For a post-COVID loser. Yeah. One of those hangover stocks for sure. I mean, Amazon after its earnings too, it seems like that has kind of lifted the spirits of all the e-commerce stuff, which it probably should. Last one you got Instacart. People buying stuff for the Super Bowl?
I think it's Maple Bear now, I want to say.
Oh, yeah.
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 I think this is actually the most interesting trade
I
of all
love that
here.
name, Maple Bear.
I like it. It sounds like a friendly
Yeah.
little character, you know?
Yeah, it sounds like a Canadian cartoon.
Definitely. But looking at this one here, so most unusual trade, definitely not something you see as frequently as the other ones. It's a short straddle. So minus 2,500, March 15th, 27 strike straddle. So we're selling a call and selling a put at the same strike price at a 576 credit. So a pretty decent sized credit here. This one is much shorter term than our other two trades. This one is March 15th, so 35 days, a little over a month here. And we can see as well that the break
March
even,
15.
you think it's a pretty far way off here. 21, 24, and 32.76, about 21% in either direction here. So
straddle.
you might think that's a pretty decent sized cushion here. This is a neutral play though, like an iron condor or an iron butterfly here. We don't want this trade price to be moving too far away from where we are right now. This was basically an at the money straddle here. The big difference is this one does not have risk definition here. Unlimited potential losses if we go to the
634.
upside, you know, catastrophic extreme losses to the downside, but that would be at least capped because it can only go to zero.
Write this down and see if I get it right.
$6.30 could take it well beyond the break even. So this trader is looking for a smaller than expected move based on this option series here. You know, for this, the statistics for this one, 17,000 options traded. Calls were about 61% of the market. This trade was more than 30% of the total market here, about 31% here. So if you consider both legs, 2,500 on each side would be 5,000 total options.
All right. So it's a pretty chunky trade and looking for it to kind of stay where it is, basically. Yeah. It's been basing for like 4 months, going sideways down here.
$1.4 million credit too. So this is a significant trade. This is some big money here, and the losses could really get out of control if it starts to move away from you on this one. You know, if you are thinking about putting on a similar trade at home, just be aware of that. You know, it can be a dicey situation if it goes the wrong way.
All right, Maple Bear. Aw, so cuddly and sweet. Thank you. Just like Rick Ducat. Thank you, Mr. Ducat, for the options trades. Coming back, we're going to chat some more about where the action is today. It's in BTC. Gold ain't coming along for the ride. It's a risk on.
I wonder how that would work.
But one stock is lagging behind. It's Moderna.
You got a butterfly put.
And some pretty important information on the Vax biz.
Did say 3 cents, and all of a sudden it had 15. 3 if I get it at 3.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power.
Oh, excuse me. Oh, man. How'd that sound? Does that sound professional?
I nailed it.
You're right. It did turn into mush. I like listening to Schwab because I can learn how to trade these options.
Go ahead.
Make my day.
Jimmy will. Oh, did I put that on 60 Minutes? I think I did. Yes. Well, I found a very good chicken pot pie.
It's time to look forward.
Fine.
I want to work there. I want to take the Chartist artist's job. So the spies pulled back to the 63 for the second time. If we close above 500, that's a good catalyst, like that lady said earlier today. Same thing with the SPX. If we close above 5,000, which I don't see a problem at all. Oh my gosh. Oh. No. No. Ugh. Okay, I was going to say, thought we were heading new highs. Yeah. 5,000 now becomes the new support level. We busted right past it. Somebody made a statement. I noticed that earlier. Someone just wanted to push that SPY over the 500. And they did. Probably one person did that. I like to watch these two. About my cruising stuff. I heard YouTube took down that Putin interview. I kind of like Putin more than I do Brandon.
We choose truth over facts.
Exactly.
Commodity or any other stock, it's more of a commodity. It trades with big swings. It's like you might as well be trading
Mike,
cocoa or sugar.
Did you call out the reversal on Bitcoin, or you just kind of... I wanted it to go a little lower, but I was wrong.
Affirmative.
You did call it out?
Affirmative.
Very good. Because I said I wanted to go a little bit lower to 36. Might end up seeing 75,000 again. They keep spending money like they do. Meta's pulled back some. Looks like we'd have more than 5 days on here.
Go to a decline. Moderna shares getting hit and resuming the downtrend of the last few years. Renita Young, our senior markets correspondent in the newsroom with the story, and I guess it pertains to vaccine efficacy. Is that right, Renita?
You're absolutely right. So there's been a huge buildup to Moderna's RSV vaccine because it's supposed to replace some of the revenue that the company lost since COVID-19 vaccine sales have plummeted, right? But today we hear news that the efficacy for the RSV vaccine is actually fading from the very first time that the company did do its trial. The results show an average follow-up with patients that's nearly 5 months longer than when it first got results last year. So they say after 8.6 months of follow-up, the vaccine was 63.3% effective against lower respiratory tract disease. And the earlier data from last year showed a median follow-up of 3.7 months with the vaccine at 83.7% efficacy. Now, it's not clear why the results have plunged this time around, but Moderna said it's pretty tough to compare these types of things that happen across seasons, and they warned against comparing it to other trials testing other RSV vaccines, but that didn't stop analysts from comparing to Pfizer and GlaxoSmithKline, which recently launched their RSVs last year as well. Of course, they're saying that those are faster, they're more effective, and they work better. But TD Cowen said that this data suggests efficacy of Moderna's RSV vaccine may fall quicker over time than its competitors.
Yeah, it's a pretty big drop from 82 to 63, just kind of within their own trials. So I can definitely see why the stock's getting hit. And a lot of times Moderna and Pfizer move in tandem, but not anymore.
Right.
So I think that also, we've kind of got a side story about Pfizer trying to break away from that category of news flow. An important update, though. All right, thanks a lot. Number two is the seasonality of COVID able to evade the vaccines to some extent. Thank
Dang,
you.
snow took off.
All right, when we come back, closing out with a big picture discussion for the week and looking ahead to next week. It was a very, very quiet week for economic data. That's going to change next week. Got some great guests on our Schwab panel today to take us into the bell, close out this week.
I was born on the south side of Chicago. It's a long road, but
he was born on the south side of Chicago. I got out of the hood. I remember I was going through the hood in Memphis. I wanted to take a shortcut and get up on the highway. And I was told not to drive through there, but I did. And so I see a big crowd of people walking down the street. I'm going, what the heck? I'm shaking my head. What did I get myself into?
It is contrary to all that you have taught me.
Yes. And so I'm sitting there looking. All of a sudden I see this black man totally naked run down the middle of the street. And everybody behind him was pointing fingers at him and laughing, and I guess he was high on crack. I had to stop. I mean, there's just swarms of everybody. There's probably 100 people. I didn't know if I got myself into. I still remember that day. I was kind of scared. But they were just laughing.
for big picture discussion. Also, a little look ahead to next week. Kathy Jones, Chief Fixed Income Strategist, and Kevin Gordon, Senior Investment Strategist. Great to see you guys on Friday. So we're
Kathy would look alike.
for Kevin, our earnings to thank for this latest leg of the rally.
I think that's part of it. I mean, you've also got pretty solid momentum, especially when you move up the cap spectrum. But I would also argue in some areas like small caps today, even where breadth might be lacking in an index like the S&P 500. So I think that's part of it. But I think it's also, the fact that CPI revisions for, last year and specifically for the last 3 months of 2023, this morning, there was sort of no news there, which was good news because you had seen a continued trend of disinflation. So I think it's really the market maybe settling down a bit and looking ahead to probably it's going to be, a really packed week for economic data this upcoming week.
Bonds seem to be getting slightly more interesting, Kathy, but everything went well with the auctions, so certainly no panic in this market, right?
Yeah, I think we're consolidating after the Fed meeting and after the strong employment report. The market's just kind of digesting the fact that we're not going to get as many rate cuts as soon as the expectations suggested. And so we're readjusting, and that the economy's been quite resilient. So even though inflation keeps coming down, we still continue to see some resilience in the economy. So that's pushed up yields, especially in the belly of the curve in that, 3 to 5 to 7 year area. We start to see some lift there, but it's been kind of a gradual readjustment, not a big sudden move like we've seen in the past.
We had a big, busy calendar for Fed speakers this week, but I feel like they were the most muted in terms of impact I can remember for a week that had 10 of them. What'd you make of the way the market interpreted their language, Kathy?
Yeah, I think they're finally accepting what Powell said, is that, we're not going to cut rates right away, and not as much as the market was anticipating. And that's sort of aligns with what our expectation had been. We've always said that we thought mid-year for the start of rate cuts, May, maybe June meeting, and then it would be, a gradual sort of slow approach as long as the economy is doing well. And that's where we are right now. So we're going to stick with that expectation, and I think that's why, there really wasn't, we're just kind of slowly adapting to the fact that the Fed is doing what it says it was going to do.
Okay. How much of that is helping the equity market confidence, Kevin, that yields are consolidating and the Fed generally pretty clear about now what their plan is?
Yeah, I mean, I think the clarity, at least in terms of the trajectory of policy, now that we know
head and shoulders on the SPX on the 5 minute,
and that it's probably not going to be as Kathy
was
saying, as aggressive at points that the market was pricing in. So I think that's definitely helped. I think what has also been helpful, maybe more marginally for large caps relative to small caps, and you and I talked about this recently, Oliver, is this the relationship between yields and stock prices and not being as aggressively negative
now listen
for
to this.
large caps relative to small
Percy.
caps. But at the same time, I think that if you get a little bit more...
I don't know if you got the same moving averages that I have on here. This is my new trial that I'm using. So Percy, jot these down on paper. 200 SMA. Let's just put them up here. So I want YouTubers follow me on. Now you don't have to. I mean, we all have different strategies, but so we got the 200 SMA. We got the 63 EMA. We got the 21 EMA. And we got the 9 EMA.
Most illogical.
Very logical. Spock. So there's your head at open. There's your left shoulder. And there's your right shoulder. And it came back and hit that shoulder line off the 63 EMA. So you can see it held support here. EMA. Support, support, support. Support, support, support. Boom. So inverse Head and Shoulders. Let's change this here color so I can see it better. Yeah. And then it's a Head and Shoulders on the top. Left shoulder, right shoulder. Head and Shoulders, inverse Head and Shoulders. Do I have to look like a redneck to work for Schwab?
That overall path is, but at the same time, you do have small companies that are more susceptible to shifts in rates. So if we are in a higher for longer environment, particularly in the real rate, arena, I think that is probably more of the differentiator for who does well and who doesn't, because you've still got, anywhere from 30 to 40%, depending on what time horizon you're using, whether it's the past year or the past couple of years, anywhere from 30 to 40% of the Russell 2000 that just doesn't have any earnings, and a similar percentage that are zombie companies that don't earn enough to pay what they owe on interest expense. So I think that's going to have to be a key factor that you look for, and why we've really just emphasized for anyone in the market, in the equity market, whether you're in large caps, whether you're in mid caps or small caps exclusively, just to have that quality lens and quality filter, because it's really going to matter regardless of what happens in the next year, the next 2 years. If you go into a recession, it's definitely going to matter. If you stay in a higher for longer environment, it'll matter because you can have a little bit more of an active bias in picking companies that work in that environment.
All right, makes sense. Great conversation, guys. Thank you very much for your time. Kathy Jones, Kevin Gordon, have a great weekend, team. Always a pleasure. We got our closing bell panel, Kevin Green, and Nicole Penelides. And coming around the corner, 2 minutes till the bell.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the
God. I'm glad she wasn't an alcoholic. Oh. Wow, that was fast. Well, today was a good day for being patient. I wasn't all into it today because I had a lot of things I had to do today, but as you can tell, I came back and successfully made a trade. It's all about chart patterns when it comes to Washboardjim and being in the now. And right now, I don't think anything matters. But I'm still going to be playing it one at a time. One adventure at a time. I wish this volume profile was turned around the other way. That way I don't have to show all this crap. Biden-Harris administration expects over $5 billion in semiconductor-related research. Make America great again. They're only good when the Democrat says it. So if we come in tomorrow and we got a pullback on the market, I'll be ready to get into the calls. Well, that's it. Everybody be careful. Patience. I think the key word is patience. Learn how to be patient and second guess every trade you make.
Live long and prosper.
Live long and prosper. Also, paper trade. If you're not confident, I've noticed Tony in here wrote, you know, have at least a 70% win rate. Trade the same stocks over and over again. Develop a strategy. I've got many different strategies. I have to kind of switch it around so I won't be so bored. But I've never felt so good from learning how to trade the snake. Because I've always been a knife catcher, but now I know why. Snake breakout, pull back, boom. I mean, it's hard. It's not that hard once you understand it, but you got to be patient. I hardly ever second guess. I cost average down because I'm pretty much spot on. And if I don't catch it, nobody catches it right all the time. But I'm getting to where I'm being a little bit more patient, and I really like this new chart I'm using. These moving averages, they're not cluttered up on my chart, and I still can use the 200, and then the 63's been acting like I used to be the 65, and it'd probably still work, but I got the 63 now because I want to follow this guy on Schwab. And the 21. I think that's all I really need on here. In my old charts, I had like 7 or 8 moving averages, and it got to where you couldn't hardly see anything. So I'd start eliminating. So yabba dabba doo, I'm going to watch my YouTubes.